and H is the hype coefficient equal to the ratio of expected future earnings to actual future earnings, H equals EE/E. Similarly for share prices, with EPS denoting expected future earnings per share, in perpetuity, EPS signifying actual future earnings per share, in perpetuity, and H standing for the hype coefficient equal to the ratio of expected to actual future earnings per share, so that H equals EEPS/EPS. According to this decomposition, the capitalization of an asset, or of a share in that asset, depends on two earnings-related factors. The first factor is the actual, ex post future earnings. These earnings are unknown when the assets are capitalized, but they will become known as time passes and the income gets recorded and announced. The second factor, the hype coefficient, represents the ex post collective error of capitalists when pricing the asset. This error, too, is unknown when the assets are priced, and is revealed only once the earnings are reported. The hype coefficient, expressed as a pure number, measures the extent to which capitalists are overly optimistic or overly pessimistic about future earnings. When they are excessively optimistic, the hype factor is greater than 1. When they are exceedingly pessimistic, hype is less than 1. And in the unlikely case that their collective projection turns out to be exactly correct, hype is equal to 1. The reader can now see that equations 1 and 2 are special cases of equations 3 and 4, respectively. The former equations assume, first, that earnings will continue to flow in perpetuity at current levels, and, second, that capitalist expectations regarding these earnings are neither overly optimistic nor overly pessimistic, so that hype is equal to 1. As we have shown, these simplifying assumptions work well for broad aggregates such as the S&P 500 and over the long run, but they are not very useful for shorter periods of time or when applied to narrower clusters of capital. Movers and shakers of hype. On the face of it, the introduction of hype may seem to seriously undermine the usefulness of the discounting formula. After all, with the exception of sure cases such as short-term government bonds whose future payments are considered more or less certain, the earnings expectations of capitalists can be anything and, by extension, so can be the level of capitalization. This has been a popular suspicion, particularly among critical political economists who like to deride the growing fictitiousness of capital. Over the years, many were happy to side with John Maynard Keynes, whose opinion, expressed somewhat tongue-in-cheek, was that capitalists value stocks not in relation to what they expect earnings to be, but recursively, based on what they expect other investors to expect. Professional investment may be likened to those newspaper competitions in which the competitors have to pick out the 6 prettiest faces from 100 photographs, the prize being awarded to the competitor whose choice most nearly corresponds to the average preferences of the competitors as a whole, so that each competitor has to pick, not those faces which he himself finds prettiest, but those which he thinks likeliest to catch the fancy of the other competitions, all of whom are looking at the problem from the same point of view. We have reached the third degree where we devote our intelligence to anticipating what average opinion expects the average opinion to be. And there are some, I believe, who practice the fourth, fifth, and higher degrees. Keynes 1936, 156. This infinite regress indeed seems persuasive when one focuses on the trading pit or looks at the day-to-day gyrations of the market. But it does not sit well with long-term facts. In Figure 11.1, asset prices for the S&P 500 companies are shown to oscillate around earnings, and similar patterns can be observed when examining the history of individual stocks over a long enough period of time. So we have two different vantage points, a promiscuous short-term perspective, according to which asset prices reflect Keynes-like recursive expectations, and a disciplined long-term viewpoint, which suggests that these expectations, whatever their initial level, eventually converge to actual earnings. Expressed in terms of equations 3 and 4, the two views mean that the hype coefficient, however arbitrary in the short or medium run, tends to revert to a long-term mean value of 1. Now, recall that hype is the ratio of expected earnings to earnings, EE/E, whereas the above impressions are based on the ratio of capitalization to earnings, K/E. The latter number reflects both hype and the discount rate, K/E equals H/R, so unless we know what capitalists expect, we remain unable to say anything specific about hype. But we can speculate. Suppose that there are indeed large and prolonged fluctuations in hype. Clearly, these fluctuations would be crucial for understanding capitalism. The bigger their magnitude, the more amplified the movement of capitalization and the greater its reverberations throughout the political economy. Now, assume further that the movements of hype are not only large and prolonged, but also fairly patterned. This situation would open the door for insiders to practically print their own money and therefore to try to manipulate hype to that end. Hype would then bear directly on power, making its analysis even more pertinent for our purpose. What do we mean by insiders? The conventional definition refers to a capitalist who knows something about future earnings that other capitalists do not. Typical examples would be a KKR partner who is secretly orchestrating a big leveraged buyout, a Halliburton executive who is about to sign a new contract with the Department of Defense, or a JP Morgan Chase financier who has been discreetly informed of an imminent Fed-financed bailout of Bear Stearns. This exclusive knowledge gives insiders a better sense of whether the asset in question is under or overhyped, and this confidence allows them to buy assets for which earning expectations fall short of true earnings and wait. Once their private insight becomes public knowledge, the imminent rise of hype pushes up the price and makes them rich. 7. These insiders are largely passive, they take a position expecting a change in hype. There is another type, though, less known but far more potent, the active insider. This type is doubly distinctive. First, it knows not only how to identify hype, but also how to shape its trajectory. Second, it tends to operate not individually, but in loosely organized packs of capitalists, public officials, pundits, and assorted opinion makers. The recent US subprime scam, for example, was energized by a coalition of leading banks, buttressed by political retainers, eyes wide shut regulators, compliant rating agencies and a cheering chorus of honest-to-God analysts. The active insiders in the scheme leveraged their positions and then stirred the capitalist imagination and frothed the hype to amplify their gains many times over. The more sophisticated insiders can also print money on the way down. By definition, a rise in hype inflates the fortunes of outsiders who unknowingly happen to ride the bandwagon. This free ride, though, is not all that bad for insiders. Since hype is a cyclical process, its reversion works both ways. And so, as the upswing builds momentum and hype becomes excessive, those in the know start selling the market short to those who are not in the know. Eventually, and if need be with a little inside push, the market tips. And as prices reverse direction, the short-positioned insiders see their fortunes swell as fast as the market sinks. Finally, when the market bottoms, the insider starts accumulating underhyped assets so that the process can start anew. These cyclical exploits, along with their broader consequences, are written in the annals of financial euphoria and crises, from the tulip mania of the 17th century and the Mississippi and South Sea schemes of the 18th century, to the new economy miracle of the 20th century and the subprime bubble of recent times. The histories of these episodes and countless others in between are highly revealing. They will tell you how huge fortunes have been made and many more lost. They will teach you the various techniques of public opinion making, rumor campaigns, orchestrated promotion and Ponzi schemes. And they will introduce you to the leading private investors, corporate coalitions, and government organs whose art of delusion has helped stir the greed and fear of capitalists, big and small. 8. However, there is one thing these stories cannot tell you, and that is the magnitude of hype. In every episode, investors were made to expect prices to go up or down, as the case may be. But price is not earnings, and as long as we do not know much about the earnings projections of capitalists, we remain ignorant of hype, even in retrospect. Random noise. This factual void has enabled orthodox theorists to practically wipe the hype and eliminate the insiders. Granted, few deny that earnings expectations can be wrong, but most insist they cannot be wrong for long. Whatever the errors, they are at worst temporary and always random. And since hype is transitory and never systematic, it leaves insiders little to prey on and therefore no ability to persist. The argument, known as the efficient market hypothesis, was formalized by Eugene Fama, 1965-1970, as an attempt to explain why financial markets seem to follow what Maurice Kendall, 1953, called a random walk, i.e. a path that cannot be predicted by its own history. The logic can be summarized as follows. At any point in time, asset prices are assumed optimal in the sense of incorporating all available information pertaining to the capitalizing process. Now, since current prices are already optimal relative to current knowledge, the arrival of new knowledge creates a mismatch. An unexpected announcement that British Petroleum has less oil reserves than previously reported, for example, or that the Chinese government has reversed its promise to enforce intellectual property rights, means that earlier profit expectations were wrong. And given that expectations have now been revised in light of the new information, asset prices have to be re-optimized accordingly. Note that, in this scheme, truly new information is by definition random, otherwise, it would be predictable and therefore already discounted in the price. So if markets incorporate new information efficiently, i.e. correctly and promptly, it follows that price movements must look as random as the new information they incorporate. And since, technical analysis notwithstanding, current price movements do seem random relative to their past moments, the theorist can happily close the circle and conclude that this must be so because new information is being discounted efficiently. Point 9. There is a critical bit that needs to be added to the story, though. As it stands, the presumed efficiency of the asset market hangs crucially on the existence of smart money and its hired experts. The reason is obvious. Most individual investors are blissfully unaware of new developments that are relevant to earnings, few can appreciate their implications, and even fewer can do so accurately and quickly. However, since any mismatch between new information and existing prices is an unexploited profit opportunity, investors all have an incentive to obtain, analyze, and act on this new information. And given that they themselves are ill-equipped for the job, they hire financial analysts and strategists to do it for them. These analysts and strategists are the engineers of market efficiency. They have access to all available information, they are schooled in the most up-to-date models of economics and finance, and there are enough of them in the beehive to find and eliminate occasional mistakes in judgment. The big corporations, the large institutional investors, the leading capitalists' smart money all employ their services. Individual investors' folly is smart money's opportunity. By constantly taking advantage of what others do not know, the pundits advertise their insight and keep the market on an efficient keel. And since by definition no one knows more than they do, there is nobody left to systematically outsmart the market. This, at any rate, is the official theology. Flocks of experts and the inefficiency of markets. The problem is with the facts. As noted, until recently nothing much was known about expectations and hype, so the theory could never be put to the test. But the situation has changed. In 1971, a brokerage firm named Lynch, Jones, and Ryan, LJR, started to collect earning estimates made by other brokers. The initial coverage was modest in scope and limited in reach. It consisted of projections by 34 analysts pertaining to some 600 individual firms, forecasts that LJR summarized and printed for the benefit of its own clients. But the service known as the Institutional Brokers Estimate System, or IBES, expanded quickly and by the 1980s became a widely used electronic data provider. The system currently tracks the forecasts of some 90,000 analysts and strategists worldwide, regarding an array of corporate income statements and cash flow items. The forecasts cover both individual firms and broad market indices and are projected for different periods of time from the next quarter through to the vaguely defined long term. The estimates go back to 1976 for US-based firms and to 1987 for international companies and market indices. And so, for the first time since the beginning of discounting more than half a millennium ago, there is now a factual basis to assess the pattern and accuracy of expert projections. This new source of data has not been lost on the experts. Given that any new information is a potential profit opportunity, along with IBs there emerged a Borgianing mini-science of hype, a systematic attempt to foretell the fortune tellers. Point 10. So far, the conclusions of this mini-science hardly flatter the forecasters and seriously damn their theorists. In fact, judging by the efficacy of estimates, the efficient market hypothesis should be shelved silently. It turns out that analysts and strategists are rather wasteful of the information they use. Their forecast errors tend to be large, persistent, and very similar to those of their peers. They do not seem to learn from their own mistakes, they act as a herd, and when they do respond to circumstances, their adjustment is painfully lethargic. A recent comprehensive study of individual analyst forecasts by Goy and Bouchard, 2005, paints a dismal picture. The study covers 2,812 corporate stocks in the United States, the European Union, the United Kingdom and Japan, using monthly data for the period 1987 to 2004. Of its many findings, 3 stand out. First, the average forecast errors are so big that even a simple no-change projection, with future earnings assumed equal to current levels, would be more accurate. Second, the forecasts are not only highly biased, but also skewed in the same direction. Looking 12 months ahead, the average analyst overestimates the earnings of a typical corporation by as much as 60%. If analysts erred equally in both directions, the average error would be 0. Although the enthusiasm cools down as the earning announcement date gets closer, it remains large enough to keep the average forecast error as high as 10% or as late American Samoa 1 month before the reports are out. Finally, and perhaps most importantly, the projections are anything but random. The dispersion of forecasts among the analysts is very small, measuring between 1/3 and 1/10 the size of their forecast errors. This difference suggests, in line with Keynes, that analysts pay far more attention to the changing sentiment of other analysts than to the changing facts. Behavioral theorists of finance often blame these optimistic, herd-like projections on the nature of the analyst's job. The analysts, they argue, tend to forge non-arm's-length relationships with the corporations they cover, and this intimacy leads them to err on the upside. Moreover, the analyst's preoccupation with individual corporate performance causes them to lose sight of the broader macro picture, creating a blank spot that further biases their forecast. These shortcomings are said to be avoided by strategists. Unlike analysts who deal with individual firms, strategists examine broad clusters of corporations, such as the S&P 500 or the Dow Jones Industrial Average. They also use different methods. In contrast to the analysts who build their projections from the bottom up, based on company fundamentals, strategists construct theirs from the top down, based on aggregate macroeconomic models spiced up with political analysis. Finally, being more detached and closely attuned to the overall circumstances supposedly makes them less susceptible to cognitive biases. Yet this approach does not seem very efficient either. Darrow and Russell, 2002, compare the performance of bottom-up analysts to top-down strategists in estimating next year's earnings per share for the S&P 500 and Dow Jones Industrial Average over the period 1987 to 99.11. They show that although strategists are less hyped than analysts, their estimates are still very inaccurate and path-dependent. They are also far more lethargic than analysts in revising their forecasts. Being locked into their macro models, they often continue to project incorrect results retroactively, after the earnings have already been reported. The appendix to this chapter examines the temporal pattern of strategist estimates. It demonstrates not only that their forecast errors are very large, but that they follow a highly stylized, cyclical pattern. Their hype cycle is several times longer than the forecast period itself, and its trajectory is systematically correlated with the direction of earnings. Let there be hype. And so the Maginot Line of market efficiency crumbles. The analysts and strategists know full well that it is better for reputation to fail conventionally than to succeed unconventionally, as Keynes once put it, 1936, 158. Consequently, rather than ridding each other of the smallest of errors, they much prefer the trotted path of an obedient flock. Ironically, this preference is greatly strengthened by the fact that most of them actually believe in market efficiency. Ultimately, the market must be right, and since it is their recommendations that keep the market on track, it follows that to deviate from their own consensus is to bet against the house. Better to run with the herd. This inherent complacency, amplified by the folly of so-called dumb money, means that there is no built-in mechanism to stop the insiders. In fact, the very opposite is the case. Since the experts tend to move in a flock, it is enough to influence or co-opt those who lead, the mean estimate, in order to shift the entire pack, the distribution of estimates. And the temptation to do so must be enormous. Fluctuations in hype can be several times larger than the growth of actual earnings, so everything else being equal, $1 invested in changing earning expectations could yield a return far greater than $1 spent on increasing the earnings themselves. Pressed to the wall, mainstream finance responded to these anomalies by opening the door to various theories of irrationality, from Herbert Simon's bounded rationality, 1955, 1979, through Daniel Ellsberg's ambiguity aversion, 1961, to Daniel Kahneman and Amos Tversky's prospect theory, 1979, to Richard Thaler's broader delineation of behavioral finance, de Bond and Thaler, 1985. These explanations, though, remain safely within the consensus. Like their orthodox counterparts, they too focus on the powerless individual who passively responds to given circumstances. Unlike his 19th-century predecessor, this agent is admittedly imperfect. He is no longer fully informed and totally consistent, he tends to harbor strange preferences and peculiar notions of utility, and may even substitute satisficing for maximizing, and he sometimes lets his mood cloud his better judgment. These deviations, argue their theorists, fly in the face of market efficiency. They show that irrational hype can both exist and persist. But that conclusion, the theorists are quick to add, does not bring the world to an end. As noted in Chapter 10, individual irrationality, no matter how rampant, is assumed to be bounded and therefore predictable. And since predictable processes, no matter how irrational, can be modeled, the theorists can happily keep their jobs. Of course, what the models cannot tell us, and the financial modelers are careful never to ask, is how these various irrationalities are being shaped, by whom, to what ends and with what consequences. These aspects of capital accumulation have nothing to do with material technology and individual utility. They are matters of organized power. And on this subject, finance theorists and capitalist insiders are understandably tight-lipped. The only way to find out is to develop a radical political economy of hype independent of both. The discount rate. If putting a number on future income and wealth seems difficult, knowing how much to trust one's prediction is next to impossible, or, at least that is how it was for much of human history. When Croesus, the fabulously rich king of Lydia, asked Solon of Athens if ever he had known a happier man than he, the latter refused to be impressed by the monarch's present wealth. The gods, O king, have given the Greeks all other gifts in moderate degree, and so our wisdom, too, is a cheerful and a homely, not a noble and kingly wisdom, and this, observing the numerous misfortunes that attend all conditions, forbids us to grow insolent upon our present enjoyments, or to admire any man's happiness that may yet, in course of time, suffer change. For the uncertain future has yet to come, with every possible variety of fortune, and him only to whom the divinity has continued happiness unto the end, we call happy. To salute as happy one that is still in the midst of life and hazard, we think as little safe and conclusive as to crown and proclaim as victorious the wrestler that is yet in the ring. Plutarch 1859, Volume 1, 196-97, emphasis added. Solon's caution was not unfounded, for in due course the hubristic Croesus lost his son, wife, and kingdom. And in this respect, we can say that little has changed. The future is still uncertain, but the capitalist rulers, like their royal predecessors, continue to convince themselves that somehow they can circumvent this uncertainty. The main difference is in the methods they use. In pre-capitalist times, uncertainty was mitigated by the soothing words of astrologists and prophets, whereas nowadays the job is delegated to the oracles of probability and statistics. Capitalist uncertainty is built right into the discounting formula. To see why, recall our derivation of this formula in equations 1, 2, 6, in Chapter 9. We started by defining the rate of return, R, as the ratio of the known earnings stream, E, to the known dollar value of the invested capital, K, such that R equals E/K. The expression is straightforward. It has one equation, one unknown and an obvious solution. Next, we rearranged the equation. Since the rate of interest can be calculated on the basis of the earnings and the original investment, it follows that the original investment can be calculated based on the rate of return and the earnings, so that K equals E/R. The result is the discount formula, the social habit of thinking with which capitalists began pricing their capital in the 14th century. Mathematically, the two formulations seem identical, if not circular, recall the Cambridge controversy. But in reality there is a big difference between them. The first expression is ex post. It computes the realized rate of return based on knowing both the initial investment and the subsequent earnings. The second expression is ex ante. It calculates the present value of capital based on the future magnitude of earnings. These future earnings, however, cannot be known in advance. Furthermore, since capitalists do not know their future earnings, they cannot know the rate of return these earnings will eventually represent. Analytically, then, they are faced with the seemingly impossible task of solving one equation with three unknowns. In practice, of course, that is rarely a problem. Capitalists simply conjure up two of the unknown numbers and use them to compute the third. The question for us is how they do it and what the process means for accumulation. The previous section took us through the first step, predicting future earnings. As we saw, these predictions are always wrong. But we also learned that the errors are not unbounded, and that, over a sufficiently long period of time, the estimates tend to oscillate around the actual numbers. The second step, to which we now turn, is articulating the discount rate, the rate that the asset is expected to yield with the forecasted earnings. And it turns out that the two steps are intimately connected. The discount rate mirrors the confidence fortune-telling capitalists have in their own forecasts. The greater their uncertainty, the higher the discount rate, and vice versa. The normal and the risky. What is the proper discount rate? The answer has a very long history, dating back to Mesopotamia in the 3rd millennium BCE, a topic to which we return in the next chapter. Point 12. Conceptually, the computation has always involved two components, a benchmark rate plus a deviation. The meaning of these two components, though, has changed markedly over time. Until the emergence of capitalization in the 14th century, both components were seen as a matter of state decree, sanctioned by religion and tradition, and modified by necessity. The nobility and clergy set the just lending rates as well as the tolerated zone of private divergence, and they often kept them fixed for very long periods of time. Hudson 2000a, 2000b. Neoclassicists never tire of denying this societal determination. Scratch the pre-capitalist surface, they insist, and underneath you will find the eternal laws of economics. From the ancient civilizations and early empires, to the feudal world, to our own day and age, the underlying logic has always been the same: the productivity of capital determines the normal rate of return, and the uncertainty of markets determines the deviations from that normal. This confidence seems unwarranted. We have already seen that the neoclassical theory of profit is problematic, to put it politely. But even if the theory were true to the letter, it would still be difficult to fathom how its purely capitalist concepts could possibly come to bear on a pre-capitalist discount rate. First, prior to the emergence of capitalization in the 14th century, the productivity doctrine was not simply unknown, it was unthinkable. Second, there were no theoretical tools to conceive, let alone quantify, uncertainty. And, finally, there were no systematic data on either productivity or uncertainty to make sense of it all. In this total blackout, how could anyone calculate the so-called economic discount rate? Probability and statistics. These concepts have become meaningful only since the Renaissance. The turning point occurred in the 17th century, with the twin invention of probability and statistics. 13 In France, Blaise Pascal and Pierre de Fermat, mesmerized by the abiding logic of a game of chance, began to articulate the mathematical law of bourgeois morality. Probability was justice. In the words of Pascal, the rule determining that which will belong to them, the players, will be proportional to that which they had the right to expect from fortune. His just distribution is known as the division, cited in Bernstein 1996, 67, emphases added, point 14. At about the same time, Englishmen John Grunt, William Petty, and Edmund Halley took the first steps in defining the field of practical statistics. The term itself connotes the original goal, to collect, classify, and analyze facts bearing on matters of state. And indeed, Grunt, whose 1662 estimate of the population of London launched the scientific art of sampling, was very much attuned to the administrative needs of the emerging capitalist order. His practical language would have been music to the ears of today's chief executives and finance ministers. It may be now asked, to what purpose tends all this laborious bustling and groping? I answer that whereas the art of governing, and the true politique, is how to preserve the subject in peace and plenty, that men study only that part of it, which hate how to supplant, and overreach one another, and how, not by fair outrunning, but by tripping up each other's heels, to win the prize. Now, the foundation, or elements of this honest harmless policy is to understand the land, and the hands of the territory to be governed, according to all their intrinsic, and accidental differences. It is no less necessary to know how many people there be of each sex, state, age, religious, trade rank, or degree, and see by the knowing whereof trade and government may be made more certain, and regular, for, if men know the people as aforesaid, they might know the consumption they would make, so as trade might not be hoped for where it is impossible. Grunt 1662, 72-73, original emphases. Although initially independent, probability and statistics were quickly intertwined, and in more than one way. The new order of capitalism unleashed multiple dynamics that amplified social uncertainty. Instead of the stable and clear hierarchies of feudalism came a new ethic of autonomous individualism and invisible market forces. The slow cycle of agriculture gave rise to bustling industrial cities and rapidly growing populations. The relatively simple structures of personal loyalty succumbed to the impersonal roller coaster of accumulation and the complex imperatives of government finances and regulations. More and more processes seemed in flux. But then, with everything constantly changing, how could one tell fact from fiction? What was the yardstick for truth on the path to societal happiness and personal wealth? The very same difficulty besieged the new sciences of nature. In every field, from astronomy and physics to chemistry and biology, there was an explosion of measurement. But the measurements rarely turned out to be the same, so where was truth? With so many inaccuracies, how could one pin down the ultimate laws of nature? The solution, in both society and science, came from marrying logical probability with empirical statistics. According to this solution, truth is hidden in the actual statistical facts, and probability theory is the special prism through which the scientist can see it. Any one measurement may be in error. but when the errors are random they tend to cancel each other out, and if we increase the size of the sample we can get as close to the truth as we wish. Moreover, and crucially for our purpose here, probability theory can also tell us how wrong our pronouncement of truth is likely to be. It tosses the Al-Zahir Arabic 4 dice to reckon the hazards. This marriage of logic and measurement changed the concept of the unknown, making it seem less intimidating. Of course, the fear is still very much there. Unless you are running scared all the time, you're gone, explains the quintessential forward-looking capitalist, Bill Gates, 1994. But the unknown, having been mediated through probability and statistics, has become less mysterious and, in that sense, less menacing. For the first time in history, uncertainty has been given a shape, it has a distribution. Probability and statistics draw a clear relationship between the normal and the dispersion around it, between what is supposedly natural and true and what is distorted and devious, between the rulers at the center and the rebels and radicals at the margins. They translate the unknown into seemingly precise standard deviations, and by so doing give human beings a comforting measure of their ignorance. The effect of this newly found confidence has been nothing short of revolutionary. It has opened the door to massive advances in the natural sciences. Virtually every field from geodesy and astronomy, to classical and quantum statistical mechanics, to the biostatistics of evolution and medicine has been rewritten by the new technique. And the same has happened in political economy. Every aspect of capitalism from insurance, to engineering, to production, salesmanship, finance, public management, weapon development, population control, healthcare, mass psychology, the media and education, to name a few has been re-articulated and further developed to leverage the power of probability and statistics. The belief that one can at least sketch the unknown has encouraged social imitative and intellectual creativity. The sense of knowing the odds has made it much easier to dare to take a risk. Averting risk, the Bernoullian grip. For the running scared capitalist, though, probability and statistics are a mere starting point. They pretend to give the odds, but the odds alone are still devoid of meaning. And that is where utilitarianism comes into the picture. The issue can be illustrated with a simple example. Suppose Bill Gates considers acquiring one of two software companies, CivilSoft and WeaponSoft. CivilSoft sells in the open market and is a bit volatile. The analysts tell Gates that, in their view, it has a 50% chance of generating annual earnings of $50 million and a 50% chance of generating annual earnings of $150 million. WeaponSoft is different. It sells to the military and has recently managed to secure a long-term contract with the U.S. Department of Defense. According to the analysts, it is certain to generate $100 million annually. Now, probability calculations make the two firms equally attractive. Mathematically, both have expected annual earnings of $100.15 and, so, if Gates believes his analysts, he should be indifferent as to which of the two he should acquire. Not so, argued Daniel Bernoulli, 1738. In his seminal paper, published more than 2 centuries before Gates was born, he stipulated that the measurement of risk involves more than the mere statistical odds. It requires that we put a moral judgment on the expected dollars and cents, a judgment that he insisted must be based on diminishing marginal utility. According to this logic, Gates, like the rest of us, should contemplate not the expected dollar earnings the companies will generate, but the expected utility he will get from consuming those earnings. This modification makes a big difference. A New York increase in wealth, no matter how insignificant, wrote Bernoulli, will always result in an increase in utility which is inversely proportionate to the quantity of goods already possessed, p. 25. So the first dollar Gates earns generates more utility than the second more than the third, and so on all the way to the billionth dollar and beyond. To illustrate the consequence of this stipulation, let us split the expected earnings into $50 million chunks and assume for simplicity that with diminishing marginal utility the first chunk gives Gates 3,000 udils, the second 2,000 udils and the third 1,000 udils. With this assumption, the takeover targets no longer look equally attractive. The less risky weapon soft is expected to generate 5,000 utils, whereas the more volatile civil soft is likely to give only 4,500.16, and since ultimately all Mr. Gates cares about is hedonic consumption, it is better for him to acquire the military contractor. It is likely to give him 500 more utils per annum. Finance theory has never managed to shake loose of the Bernoulli grip. His paper triggered a deluge of publications on risk, many of which modified and revised his original formulation. But most remain locked behind his three subjectivist tenets. First, risk ultimately is a personal matter. Second, attitude to risk is rooted in the individual's hedonic preferences. And third, because of diminishing marginal utility, most individuals tend to be risk-averse. This grip keeps the risk analysis of contemporary capitalist power hostage to the 18th century belief in individual utilitarianism. The unknowable. Of course, most theorists of capitalism ignore power. So before continuing, we should point out that Bernoulli's mechanical hedonism may be inappropriate for the study of risk quite apart from the absence of power. First, there is the question of the odds. Capitalists are concerned with the future, yet statistical estimates of probabilities can only be drawn from the past. This is a crucial mismatch. As David Hume's Treatise of Human Nature, 1739, tells us, the mere fact that all past experiments have found water to boil at 100 degrees Celsius does not mean that the same will happen next time we put the kettle on the stove. Natural scientists have managed to assume this challenge away by stipulating the stability of natural laws, whether deterministic or stochastic, but this stipulation seems a bit stretched when applied to society. The inherent difficulty of calculating the social odds was heightened during the first half of the 20th century. The combined onslaught of revolutions, financial crises, a Great Depression and 2 world wars suggested that the problem was not merely one of assigning odds to possible outcomes, but of specifying what those outcomes might be in the first place. According to Frank Knight, 1921, risk calculations presuppose a known set of odds. But in society, the future contains an element of novelty, and novelty cannot be pre-assigned a probability, it is unique and therefore inherently uncertain. Even Keynes, whose belief in the existence of so-called objective social probability survived the First World War, caved in after the Second. In matters of society, he confessed, the future is largely unknowable. By uncertain knowledge, let me explain, I do not mean merely to distinguish what is known for certain from what is only probable. The game of roulette is not subject, in this sense, to uncertainty, nor is the prospect of a victory bond being drawn. Or, again, the expectation of life is only slightly uncertain. Even the weather is only moderately uncertain. The sense in which I am using the term is that in which the prospect of a European war is uncertain, or the price of copper and the rate of interest 20 years hence, or the obsolescence of a new invention, or the position of private wealth owners in the social system in 1970. About these matters there is no scientific basis on which to form any calculable probability whatever. We simply do not know. Keynes 1937, 213-14, emphasis added. And then there is the second problem. Even if we convince ourselves that the mathematical odds exist and that we can somehow know them, there is still the task of assigning to these odds utilitarian weights. Without these weights, there is no point talking about Bernoullian risk. Yet these weights, made up of utils, vary from person to person and from moment to moment, and this fluidity has implications. Any given asset must be seen as having not one, but many quantities of risk, as many as there are potential capitalists. Furthermore, the quantity of risk, being partly subjective, will change with preferences even if the so-called objective odds remain unaltered. This ever-shifting multiplicity makes it difficult to pin down the correct risk premium and therefore to specify the proper discount rate. And with this rate hanging in the air, how are capitalists to compute an asset's true present value? The capital asset pricing model. These logical challenges proved no match for the capitalist nomos. Although investors may be unable to calculate risk on their own, they can ask the know-all market to do it for them. All they need is a bureaucratic blueprint disguised as theory, and Lord Keynes was prescient enough to anticipate what it would take to produce one. His checklist was short: 1. Believe that the present odds are a reliable guide to future ones, 2. Assume that other investors got those odds right, and 3. Conclude that their relevant computations are already reflected in asset prices. Keynes 1937, 214. The instructions were simple enough, and when a year later Paul Samuelson, 1938, announced that prices reveal to us what we desire but cannot express, revealed preferences, the road for an operational theory of risk was finally wide open. The glory went to Harry Markowitz and William Sharpe. Markowitz, 1952-1959, gave investors a quantitative definition of risk and told them how to optimize risk and return through diversification. Sharpe, 1964, building on Markowitz's insight, showed capitalists how to tease out of the market the true risk premium with which to discount their assets. These contributions closed the circle. The capitalization ritual was now fully articulated, and the two inventors went on to collect the Sveriges Prize in Economic Sciences in memory of Alfred Nobel. Portfolio selection. Markowitz's manuals focused on the Bernoullian individual, the risk-averse investor. In buying and selling financial assets, he said, the investor does, or should, consider expected return a desirable thing and variance of return an undesirable thing. 1952, 77, original emphasis. And the best method to achieve both goals, he concluded, is to diversify. Although Markowitz himself spoke merely of the variance of returns defined as the squared deviation of the rate of price change from its own mean value, the term was quickly adopted as a synonym for risk. This in itself was a major achievement. Until Markowitz, there was no quantitative definition for risk, let alone one that everyone agreed on. Point 17. So the fact that he was able to galvanize the investment community around this concept, even if he never intended to, is already worth a Nobel. But Markowitz did much more than that. By showing why risk should be handled through diversification, he provided the justification for an old practice and helped underwrite the new trend of institutional investing. To illustrate his logic, consider a portfolio comprising different financial assets. If the market prices of these assets do not move completely in tandem, so that the correlations between their rates of change are less than 1, their unique fluctuations will partly offset one another. This partial offsetting has a great benefit: it causes the price volatility of the portfolio as a whole to be smaller than the average volatility of the individual assets. By owning a portfolio of different assets, therefore, the capitalist can enjoy their average return while suffering less than their average risk. Diversification, it now seemed, offered an entirely free lunch. Which portfolio should the capitalist own? Conceptually, it is possible to plot on a two-dimensional chart the return/variance attributes of all possible portfolios. Of these endless combinations, there is a subset that Markowitz identified as efficient. These are the best deals. Each efficient portfolio offers the minimum variance for a given return, or, alternatively, the maximum return for a given variance. The only way to do better on one attribute is to give up on the other, and vice versa. Conveniently, all efficient portfolios lie on a well-defined efficient frontier, and the Bernoullian capitalist simply needs to pick the one that equilibrates her very own greed and fear. A few years after Markowitz made his mark, James Tobin, 1958, offered an even sweeter deal. If investors are able to borrow and lend at a risk-free rate of interest, such as the rate on US T-bills, they can in fact outperform the efficient frontier. All it takes is two easy steps. First, they need to single out on the efficient frontier that particular portfolio, labeled M for convenience, which, when combined with borrowing or lending, yields the highest return for every level of volatility. And then they make their move. Those who are more risk-averse can invest part of their money in M, putting the rest of it into risk-free assets, i.e. lending it to the central bank. And those who are less risk-averse can borrow at the risk-free interest rate and invest the extra cash in additional units of M. Life has never been simpler. CAPM. These guidelines, though, are still limited. Their target is the individual investor who already possesses definite expectations on return and variance and merely awaits instructions on how to diversify. The guidelines are silent, however, on how investors formed these expectations to begin with, and on the market consequences should they all follow the diversification advice. These latter questions were taken up by William Sharpe, 1964, and John Lintner, 1965, in their Capital Asset Pricing Model, or CAPM for short. On the face of it, the questions seem unanswerable. Since individual investors are assumed to be autonomous, their return/variance expectations are open-ended and can take any value whatsoever. And given that the expectations are unbounded, the consequences of acting on them become unpredictable. So Sharpe and Lintner decided to simplify. What would happen, they asked, if all investors happened to share the same expectations regarding return and variance and, moreover, if their expectations were the same as the true distribution of outcomes, i.e. if investors knew the stochastic generator of history? The scenario is admittedly odd. After all, what can one learn about uncertainty by assuming it away? Indeed, what would generate a future variance if all capitalists were the same and if all knew the future variance? Recall, however, that we are dealing here with the articulation of the capitalist nomos. The ultimate task is not to theorize capitalists, but to give them a bureaucratic blueprint. And if you revisit the previous section you will see that, in pursuing this goal, Sharpe and Lintner were merely following Keynes' checklist. And indeed, the answers they gave emerged directly from their assumptions. If investors all see the world eye to eye, they will all own the same efficient portfolio M, and nothing but M. And since they all own only units of M, every owned stock in the market must be part of M. The only portfolio that satisfies these conditions is the market as a whole. So in Sharpe and Lintner's world, investors are fully diversified, each holding onto a proportion of the entire market. Now, recall that diversification reduces volatility because the price movements of different assets partly offset each other. Why is the offsetting only partial? The reason is that price volatility is seen as stemming from two distinct sources, one that is unique to the asset itself, and another that is common to the market as a whole. A sufficiently diverse portfolio which M obviously is eliminates all unique volatility. Thus, following Sharpe and Lintner, portfolio investors can disregard all price volatility that is out of sync with the market. But no matter how diverse their portfolio, they can never eliminate market volatility, by definition. In other words, every asset carries in its genes a definite quantum of market volatility, a quantum which in turn is passed on to the portfolio as a whole. The risk of a well-diversified portfolio, declare Brealey, Myers, and Allen in their Principles of Corporate Finance, 2008, 193, depends on the market risk of the securities included in the portfolio. This is not something one argues about. Tattoo that statement on your forehead if you can't remember it any other way, they warn. It is one of the most important ideas in this book. Conveniently, this logic is fully invertible. Since individual assets contribute to the market portfolio their own market risk, their contribution can be deduced from the market. Recall that unique risk has been diversified away, so the only thing that makes one asset more or less risky than another is its sensitivity to the overall market. This sensitivity is called beta, and it can easily be measured, or so we are told. The greater the market risk of the asset, the higher beta and vice versa. Point 18. Now, if the measured historical beta is equal to the true timeless beta, as the CAPM proclaims, we can calculate the asset's risk premium. By definition, beta expresses the ratio between, on the one hand, the excess return of the asset over and above risk-free assets, asset excess return equals R, RRF, and, on the other hand, the excess return of the market over and above risk-free assets, market excess return equals RMRRF. Rearranging equation, 5, the capitalist can obtain the risk premium for the asset. And, finally, with one more reshuffle, the overall discount rate, R. The first component on the right is the risk-free benchmark, RRF, while the second component is the compensation for the asset's risky deviations, beta, RM, RRF. And that is pretty much it. All that the capitalist now has to do is take the risk-free rate of interest, RRF, the market return, RM, and the estimated beta and plug them into equation 7. And since all capitalists are assumed to be drones and therefore to do the very same maths with the very same numbers, they all end up with the same discount rate, R. 0.19. This number is then put into the denominator of the discount formula in equations 3 and 4, to give the true capitalized value of the asset. Circularity. CAPM has been a smashing business success. Within a few decades, it has become the basis on which corporate finance courses are structured. Often, it is the only model that MBA students rehearse in some detail. And as the students turn into managers, executives, and government officials, they apply what they learned. In the early 1980s, less than one-third of large U.S. firms used the CAPM to compute the cost of equity. By the early 2000s, the proportion was well over 70%, or although, to be on the safe side, other formulae are used as well, Gitman and Mercurio 1982, Graham and Harvey 2001. This success is all the more remarkable given the model's dismal empirical showing. Recall that Sharpe and Lintner assumed that investors know the true variance of returns, and therefore also the true beta, yet that, in practice, they all take a shortcut and use the historical beta instead. No wonder the model crumbles. First, there is the equity premium puzzle. It turns out that, taken as an asset class, equities outperform government bonds by much more than their extra volatility would demand, Murrah and Prescott 1985. And then the puzzle becomes embarrassing. Comparisons of different classes of equities often show returns to be uncorrelated and sometimes negatively correlated with beta values. The problems are serious enough, conclude efficient market theorists Fama and French, to invalidate most applications of the CAPM, 2004, 43. Given these difficulties, the CAPM has been refurbished, extended, and modified with new and improved techniques and a never-ending flow of fresh data. 20. But the new models share with the old one key feature, circularity. Excess return is the compensation for risk, while risk is measured by excess return. This correspondence holds simply because it should. Few people quarrel with the idea that investors require some extra return for taking on risk. That is why common stocks have given on average a higher return than U.S. Treasury bills. Who would want to invest in risky common stocks if they offered only the same expected returns as bills? Brealey, Myers, and Allen 2008, 217, first emphasis added. It is just like Lamarckian evolution. A giraffe grows its neck to reach the high leaves on the tree, and so does the market. It makes prices of volatile assets rise faster in order to give investors a reason to own them. Risk and power. The issue here is not circularity as such, but the worldview that underlies it. The framework of mainstream financial theories is neoclassical. Its basic units are risk-averse, utility-maximizing investors. These individuals are powerless. They are too small to affect the circumstances and hence take them as given. Their only possible course of action is reaction, buying stocks whose return/risk attributes are attractive and selling those that are unattractive, that is, until the market equilibrates their prices to their natural levels. Their focus is price, and only price. The price tells them everything they need to know about return and risk. Whatever lies beneath it is irrelevant. And so the discount formula disappears. The CAPM reasons the link between return and risk in moral terms. The capitalist deserves higher returns to compensate for higher risk. But if we abandon the fairy tale of perfect competition and efficient markets and return to the real world of organized capitalist power, the capitalization formula comes back into focus and the relationship between risk and return assumes a rather different meaning. Back on Earth, the sequence is as follows: earnings are a matter of power and conflict, the conflict over earnings invites resistance, and resistance breeds volatility and uncertainty. In this way, the capitalist's struggle to increase earnings is inextricably bound up with uncertainty regarding their eventual level. The numerator of the capitalization formula becomes intimately tied to its denominator, the degree of confidence. Recall that in capitalism the ownership of an asset is a claim on future earnings. The price of the asset, expressed as present value, is merely the capitalist assessment of those earnings. Underlying this assessment are two key considerations. One is the level of earnings capitalists expect to receive, the other is the degree of confidence capitalists have in their own predictions. In order to make this degree of confidence explicit, we rewrite equations 3 and 4, such that, in this reformulation, capitalist confidence is expressed in two basic ways. At any given social conjunction, there is a certain benchmark, a rate of return that capitalists feel confident they can get. We denote it accordingly by RC. Finance theory refers to this rate as risk-free yet explains neither why it is free of risk nor what determines its level. Neoclassicists must resist the temptation to equate this rate to the marginal productivity of capital, not only because the latter is logically impossible and empirically invisible, but also because the absence of risk here is secured by the government. As we shall argue in the next part of the book, what enables capitalist governments to set a risk-free rate in the first place and what makes capitalists view this rate with approval and confidence is neither productivity nor status distortions, but the overall structure of power in society. Of course, with the exception of short-term government instruments, capitalist income is always uncertain, hence the ever-present hype. The conflict that underlies earnings is multifaceted and can develop in many directions. Sometimes capitalist power is sufficiently secure to make capitalists certain of their strategy and the earnings it will generate, at other times, their power is tenuous and future predictions more hesitant. The degree of confidence that emerges from these considerations is expressed, inversely, by the risk coefficient, delta. When capitalists are fully confident, delta is 1. Otherwise, delta is bigger than 1, and it increases as confidence decreases. Note that this risk coefficient is not the same as the so-called risk premium of finance theory. First, whereas the risk premium pertains to the asset price on the left-hand side of the capitalization equation, the risk coefficient pertains to earnings on the right-hand side. Since the price of the asset involves more than earnings, the two risk concepts cannot be the same. Second, whereas the risk premium is the designated return for actual volatility, the risk coefficient denotes the confidence capitalists have in their predictions. Of course, volatility and confidence are related, but their correspondence is anything but simple. To start with, volatility per se does not generate uncertainty. It is the pattern of volatility that does. The annual earnings cycle of ski resorts may be much more volatile yet far more certain than the profits of airlines. Insofar as seasonal weather variations prove easier to predict than the vagaries of world travel, capitalists will judge the larger volatility of the former less risky than the smaller volatility of the latter. The other reason is that the past is only a partial guide to the future. This fact has been pointed out by Knight and Keynes, but it takes on a whole new dimension once we bring power into the picture. In the next part of the book we argue that the very purpose of power-driven capitalist accumulation is to reshape society. Capitalists realize that the very nature of their enterprise is to defy prediction, and they therefore take even the most successful forecasting models with a grain of salt. Lastly, whereas in financial theory a higher risk begets a higher risk premium, higher earnings volatility does not imply higher earnings growth, or vice versa. Over the past half-century, the earnings of General Electric rose 10 times faster than those of General Motors, though the volatility of GE's earning growth was far smaller than GM's, Bichler and Nitzan 2006. Contrary to Lamarckian finance, earnings volatility does not entail a premium. And the reason, again, is at least partly associated with power. Bernoulli's capitalists are risk-averse because their goal is hedonic consumption. Their next yacht is assumed to be slightly less enjoyable than the previous one. But power-driven capitalists are very different. As we shall see, their goal is not more income, but a larger distributive share of income. Redistribution, however, does not obey the laws of diminishing marginal utility, so there is no longer reason to assume that capitalists are risk-averse. Most of the world's leading capitalists, including some of the biggest so-called portfolio investors, are not very diversified. In fact, many are highly focused. The reason they have made it is that, unlike the passive individuals that populate the CAPM, they are active. Speculating and playing with power is more exciting than playing roulette, writes Travin in The White Rose. At roulette influence cannot be exercised, 1929, 96. Big capitalists do not take the odds as given, they try to change them. They struggle to increase their earnings and surrounding hype, and they similarly try to tame volatility. They are not only risk takers, they are also risk shapers. And as they embrace risk rather than shy away from it, the moral link between earnings volatility and earnings growth breaks down. For the large capitalists, reducing earning volatility is a major obsession. But the reason is not hedonic payoff, but predictability and control. Knight and Keynes identified the problem, the unbridgeable gap between uncertainty and risk. Organized capitalist power is an attempt to defy the problem, if only in appearance. By shaping society, capitalist power translates undefined uncertainty into seemingly quantitative risk. Capitalism is uncertain partly because the conflictual power logic of accumulation makes it so. But power also means ordering, and from the standpoint of capitalists this ordering is the degree to which they can contain their own uncertainty. Partly objective, partly intersubjective, this degree is captured inversely by the risk coefficient. Toward a political economy of risk. Clearly, there is an urgent need for a critical political economy of risk. Yet both orthodox economics and heterodox Marxism are unable to develop such a political economy from within their own frameworks. Neoclassical theorists are ambivalent about the subject. On the one hand, risk-taking is one of the key justifications for riches and wealth. On the other hand, to recognize risk and uncertainty is to accept that foresight is flawed and information inherently incomplete, if not absent. This ambivalence may explain why in their textbook, Samuelson Incorporated devote 2 pages out 932 to the notion of risk enough to pay tribute to the issue without undermining everything else. Samuelson and Nordhaus 1992, 673-74. The situation is not much better with Marxist theory and radical institutionalism. Although earnings and risk are two sides of the same power process, Marxists have had plenty to say on the former and almost nothing on the latter. Marx's own work emphasizes the iron laws of history and is indifferent to its uncertainties. The concept of risk is neither covered nor indexed in Bottomore's Dictionary of Marxist Thought, 1991. There is no entry for risk in the Elgar Companion to Radical Political Economy, Arstis and Sawyer 1994. Risk is indexed twice in reference to decision-making and to utility, both subjects of minor interest to radical political economists. It is similarly absent from the Elgar Companion to Institutional and Evolutionary Economics, Hodgson, Samuels, and Toole 1994, point 21. In both the neoclassical and Marxist cases, the neglect is rooted in the materialistic notion of accumulation. Capital in these frameworks is a material entity, denominated in productive/hedonic units, and so risk, by its very immaterial nature, must be external to that entity. Risk can certainly influence accumulation, but it can never be integral to it. It is only when we conceive of capital as power that risk can be made inherent to accumulation. Summing up. In the 3 chapters of this part of the book, We have argued that political economists have been barking up the wrong tree. Capital is neither a hedonic entity nor a social amalgam of abstract labor, but a capitalization of expected future earnings. The process of capitalization, having emerged in Italy during the 14th century, has since expanded and developed to become the most adhered to convention of the capitalist nomos. It encompasses more and more aspects of human life, from the individual, to social relations, to society's broader interactions with the environment. The process of capitalization differs from the material amassment of capital goods not only conceptually, but also empirically. We have seen that, historically, the growth trajectories of pecuniary capitalization and the capital stock have oscillated in opposite directions. Both mainstream and Marxian theories explain this mismatch either as a mismeasurement, or simply as the distortion of real by fictitious capital. But the fact of the matter is that there is nothing to distort or mismeasure. The two concepts are fundamentally different, so there is no reason why they should be equal in magnitude or move in the same direction to start with. Material capital is backward-looking. It is a stock of past, plowed-back earnings corrected for depreciation, assuming the whole thing is measurable to begin with. Capitalization is forward-looking. It discounts the earnings of the future. Moreover, whereas material capital is one-dimensional, based on earnings only, capitalization is multidimensional. It consists of four elementary particles: actual future earnings, HYPE, a confident rate of return, and a risk coefficient. Finally, material capital is seen either as distorted by power, in the neoclassical case, or supported by power, in the Marxian case, yet in both cases, power is external to capital itself. By contrast, the elementary particles of capitalization are all about power. These broad contours of capitalization are the sketch from which one can begin to theorize and research the architecture of capitalist power. Of course, a full account of this architecture cannot be attempted in a single volume. Therefore, in the remainder of the book, we focus on what seems to be the most salient dimension: the power underpinnings and implications of capitalist earnings. Hopefully, this analysis will provide insight and raise questions to encourage further explorations into the subject. Appendix to Chapter 11, Strategists' Estimates of S&P Earnings per Share. Figure 11.2 presents earnings-related data for the S&P 500 group of companies over the period between 1988 and 2006. The chart contrasts the actual level of earnings per share, EPS, with the consensus estimates of strategists made 1 to 2 years earlier. The figure also plots a HYPE index, calculated as the ratio of estimated to actual earnings. Figure 11.2, S&P 500, Earnings, Earning Estimates, and HYPE. Note, EPS denotes earnings per share. The HYPE index is the ratio between the consensus EPS estimate and the actual EPS. Source, IBs through WRDS. The thin line in the upper part of the figure plots the actual EPS. The data pertain to annual earnings, which usually are reported during the first quarter of the following year. For example, the annual EPS data for 1999 would be reported during the first 3 months of 2000. The thicker broken line in the upper part of the chart shows the corresponding consensus estimates. The data points on this line are monthly readings, denoting the consensus forecasts made during the previous year. For instance, the data point for January 1999 is the estimate, made in January 1998, for the 1999 annual earnings. The data point for February 1999 is the estimate, made in February 1998, for the 1999 annual earnings, and so on. The last estimate for each year is made in December of the previous year. This setup gives us up to 11 observations for each year's earnings. Some months do not have reported estimates. The first estimate is made 23 months prior to the last month of the projected year, for instance, in January 1999 for the year ending December 2000, and the last estimate is made 12 months before that year's end, in December 1999 for the year ending December 2000. The series appears broken since every December the forecast shifts to next year's earnings. The thicker line at the bottom of the figure computes a monthly hype index based on the two earnings series. Each observation measures the ratio between the consensus forecast made in the same month during the previous year and the actual EPS for the entire year. For example, the data point for January 1999 would express the ratio between the forecast made in January 1998 for 1999 EPS and the actual EPS in 1999. The figure depicts several clear patterns. Part 4. Bringing power back in. 12. Accumulation and sabotage. The truly great fortunes are made only by those who grab hold of the nation's nerve strings. B. Travin, The White Rose. The Categories of Power. In the introductory chapter to his Grundriss, 1857, ch. 1, Marx struggles with the difficulty of picking a theoretical starting point. The choice of categories, he points out, is complicated by considerations of abstraction and specificity, as well by questions of historical progression. The capitalist order, like any other social order, enfolds its preceding histories. Each of its categories, Marx observes, embodies not only contemporaneous relations with other categories, but also deep lineages to a past from which it emerged and which it negates. Our own story of capital focuses on power. But in order to get to power we first had to critique the existing categories, relations, and histories of political economy. Common to these theories and explanations is their unwillingness or inability to deal with the power underpinnings of capital. Our journey to explore this difficulty has taken us through various territories: the social myths of Newtonian mechanics, the bifurcation of politics and economics and the academic splintering of the social sciences, the creed of efficiency and the impossibility of quantifying productivity, the distinction between the real and the nominal and the tortured relationship between tangible wealth and financial markets, and, finally, the history of capitalization from Middle-Age discounting to present-day asset pricing. Capitalization stands at the center of contemporary capitalism. The discounting to present value of expected future earnings is now the organizing economic principle that shapes and directs daily life on our planet. But as our journey has repeatedly suggested, capitalization is not merely an economic category. It is an encompassing mode of power. Until the emergence of capitalism, power was largely separate from and situated above the processes of production and consumption. It was administered by large doses of force sprinkled with small promises, mostly for afterlife fulfillment. The new regime of capital introduced a whole new technology of power, one that penetrates and shapes the very souls of its subjects. It invented the concept of ideology and the institution of public education. It developed mass psychology, mass culture, and mass consumption. It gave rise to a one-dimensional man. It opened up domains that prior rulers could not even fathom. These inventions have made capital the most invasive, encompassing and flexible form of organized power ever known to humanity. And since these power processes all bear on profitability and therefore are all discounted into asset prices, to study capitalization is to study the nature and evolution of organized power in contemporary capitalism. Thus, our starting point in this part of the book is that the capitalization of earnings is not a narrow offshoot of production but a broad representation of power. Pecuniary earnings, we argue, do not have a material source, whether counted in utils or labor time. Instead, they are the symbolic representation of a struggle, a conflict between dominant capital groups, acting against opposition, to shape and restructure the course of social reproduction at large. In this struggle, what gets accumulated is not productivity as such, but the ability to subjugate creativity to power. Theorizing this capitalized struggle, however, is anything but trivial. The immediate problem, again, is the categories themselves. Nowadays, almost every concept that pertains to capital embodies or connotes production and consumption. The notions of business and industry, investment and private ownership, the normal rate of return and the natural rate of unemployment, commodity pricing and wealth maximizing, equity and debt, profit and interest, the corporation and its material and immaterial assets, accumulation and circulation, and, finally, the so-called fractions of capital are all articulated, understood, and used as economic entities. This prejudice may serve neoclassical and Marxist arguments, but it undermines our own. Given our focus on power, the economic bias of these concepts makes it impossible for us to use any of them as is. And so, just as Marx had to peer through the voluntary equivalences of liberalism in order to articulate exploitation, we too find ourselves having to tear through the economic language of capital in order to see the real picture of capital as power. And the task is certainly tricky. On the one hand, we need to translate the existing categories, one by one and in relation to each other, so that slowly, out of the facade of material productivity there can emerge the power nature of capital. On the other hand, we must keep in mind the conventional meaning of these categories, so that we can refer to prevailing explanations and measures. And then there are several ideas that require new categories altogether. A new language can easily be misunderstood, so we tread as carefully as we can. We articulate our argument at length, in detail, and with occasional repetition, and we ask our reader to suspend judgment. You are likely to find the argument easier to assess when you reach the end of our story. Perhaps the first attempt to develop a power theory of capital was offered at the turn of the century by Thorstein Veblen. Later, his student and colleague, Louis Mumford, expanded some of Veblen's themes into a sweeping theory of power civilizations. Both frameworks build on the primal interaction between creativity and power. Veblen, whom we deal with in the present chapter, associated this interaction with a distinction between industry and business. Mumford, to whom we turn in the next chapter, saw this interaction as part of a conflict between democratic and totalitarian technologies. Their profound insights, unduly neglected by political economists, deserve closer scrutiny and offer basis for further development. Veblen's world. Veblen's view stood in sharp contrast to the utilitarian dogma of his day. While his neoclassical peers preached the gospel of hedonic pleasure and equilibrium as the governing mechanism, or at least the underlying ideal, of all societies, Veblen focused on conflict. Unlike Marx, though, he emphasized not only the conflict between owners and non-owners, but also what he saw as a broader clash between creativity and power. In his opinion, this wider conflict pervades all societies, appearing in different guises at different times. In the modern capitalist order, it takes the form of a fundamental distinction between industry and business. Industry and business. For Veblen, industry and business are two increasingly distinct spheres of human activity. Industry constitutes the material context of capitalism, although industry is not unique to capitalism. When considered in isolation from contemporary business institutions, the principal goal of industry, its raison d'être according to Veblen, is the efficient production of quality goods and services for the betterment of human life. The hallmark of industry is the so-called machine process, a process that Veblen equated not merely with the use of machines, but more broadly with the systematic organization of production and the reasoned application of knowledge. Above all, Veblen accentuated the holistic nature of industry. The neoclassical emphasis on individualism and its Robinson Crusoe analogies of the innovative entrepreneur and single consumer are misleading myths. The machine process is a communal activity. Its productivity derives, first and foremost, from cooperation and integration. The reasons are both historical and spatial. First, modern industrial production is contingent on what Veblen called the technological heritage of society, the general body of community knowledge grounded in the accumulated wisdom of the past, Veblen 1908, 326-29. Second, over time the gradual accumulation of knowledge makes production more spatially interdependent. Evidently, writes Veblen, the state of industrial arts is of the nature of a joint stock, worked out, held, carried forward, and made use of by those who live within the sweep of the industrial community. In this bearing the industrial community is a joint going concern, 1923, 64. Following Werner Sombart, he emphasized the comprehensive and encompassing nature of industry, in that it draws into its scope and turns to account all branches of knowledge that have to do with the material sciences, and the whole makes a more or less delicately balanced complex of sub-processes, 1904, 7-8. Given this growing interdependency of both knowledge and processes, says Veblen, the efficiency of industrial production increasingly hinges on synchronization and standardization of both production and wants, an issue resurrected half a century later by Galbraith with his revised sequence and attack on consumer sovereignty. As a highly integrated system, industry is strongly disposed toward elaborate planning and close cooperation. Ultimately, it calls for solidarity in the administration of any group of related industries and, more generally, for solidarity in the management of the entire industrial traffic of the community, Veblen 1904, 17. Although Veblen's emphasis on integration and synchronization hardly seems earth-shaking, mainstream and to some extent Marxist economists have systematically managed to ignore two of its key implications. One implication of integration and synchronization is that distribution cannot possibly be based on individual factor productivity or atomized labor time. Consequent to this conclusion, the other implication is that distribution should be sought in the realm of power. This is where business comes into the picture. According to Veblen, business differs from industry in both methods and goals. Business enterprise means investment for profit when it proceeds through purchase and sale toward the ulterior end of accumulated pecuniary wealth. While industry is a manifestation of the instinct of workmanship, business is a matter of ownership and power, whereas the former requires integration, cooperation, and planning throughout society. The latter depends and thrives on conflict and antagonism among owners and between owners and the underlying population. The two languages. These profound differences have crystallized into two separate languages. Unlike industrial activity, with its tangible, material categories, business traffic and achievements are counted strictly in pecuniary terms. Economists insist on reducing nominal business magnitudes to real, utilitarian units, though that insistence merely attests to their pre-capitalist habit of thinking. As we have seen earlier in the book, this reduction is impossible to achieve. But even if the conversion proved feasible, according to Veblen the capitalists couldn't care less. Under the price system, he pointed out, men have come to the conviction that money values are more real and substantial than any of the material facts in this transitory world. So much so that the final purpose of any business-like undertaking is always a sale, by which the seller comes in for the price of his goods, and when a person has sold his goods, and so becomes in effect a creditor by that much, he is said to have realized his wealth, or to have realized his holdings. In the business world the price of things is a more substantial fact than the things themselves. Veblen 1923, 88-89, emphases added. The pecuniary nature of business terminology is not a mere accounting convention, it is the very gist of business enterprise. At first sight, Veblen's separation between industry and business seems to resemble Marx's distinction between simple reproduction of use value, CMC, and expanded reproduction of exchange value, MCM, the former representing the life cycle of the workers/creators, the latter of the capitalists/rulers. There is a crucial difference, however. Marx used a single material unit abstract labor to measure both processes. By contrast, Veblen began at the outset with two distinct categories, heterogeneous material units for industry and a universal pecuniary unit for business. This duality enabled him to avoid the Marxist transformation problem altogether. Prices and accumulation are business magnitudes, and hence their determination cannot be attributed, at least not in any straightforward way, to the complex and largely intractable sphere of industrial interactions. According to Veblen, unlike industry in the abstract, capitalist industry is subordinated to business ends. Its aim is no longer serviceability and livelihood, but profit. Simple as it seems, this hierarchy inverts conventional economic reasoning. Being a quest for profit, argues Veblen, business enterprise is a claim on pecuniary earnings. It is wholly and only an act of distribution. The objects over which profits constitute an effective claim are created elsewhere, in the industrial sphere, as well as in nature. Yet, given that capitalist industry is carried on for the sake of business, it follows that the primary line of causality runs not from production to distribution, but from distribution to production. And if causality is a guide for analysis, the study of capitalism should begin with business, not industry. Indeed, on its own, industry provides no insight into distribution. Anticipating and dismissing the Cambridge controversy more than half a century before it arose, Veblen pointed out quite bluntly that J.B. Clark's marginal productivity theory was wishful thinking. In order to explain distribution by productivity, we must first identify the productivity of each individual factor of production. Yet this identification, he said, could not be achieved because the so-called economic inputs did not possess any individual productivity to begin with. The immaterial equipment. As already noted, Veblen viewed industrial activity as an integrated community process centered on the technological heritage of society. On the surface, this view may look similar to prevailing convictions, popular since Galbraith, 1958, 1967, that emphasize the growing significance of technology vis-a-vis the traditional factors of production, i.e. land, labor, and capital. That is not what Veblen had in mind, however. In his opinion, technology, or the immaterial equipment of society, as he liked to call it, was not just another factor of production, however important. Instead, it was the vital cultural substance that made raw materials, machines, and physical human labor useful in the first place. To say that these minerals, plants, and animals are meaningful, in other words, that they are economic goods, means that they have been brought within the sweep of the community's knowledge of ways and means. Veblen 1908, 329. Without this immaterial equipment, he argued, the physical factors of production were economically meaningless objects. For instance, the usefulness of any given computer depends crucially on the current state of technology. With the arrival of new software, the hardware quickly ends up in the junk heap. The new technology makes it socially obsolete, and although it may have lost none of its operational features, it is no longer a capital good. Or rolling history in reverse, a modern factory producing semiconductors would have been a worthless, and indeed meaningless, collection of physical objects during Veblen's time. First, because it could not have been operated, and second, because its output would have had no perceptible use. In these and all other cases, the transformation of a physical object into an economically useful capital good can neither lead nor lag the existing state of industrial arts. The same logic applies to labor power and raw materials. A jungle tribesman would be lost in a modern factory, much as a bank manager would be lost in the Sahara Desert. Similarly, ancient stone utensils are as useless today as was petroleum before the invention of modern combustion engines. Labor, land, and capital goods are obviously essential for production, but only because they are part of a comprehensive social and cultural process. It hence seems bootless to ask, argued Veblen, although few neoclassicists were listening, how much of the products of industry or of its productivity is to be imputed to these brute forces, human and non-human, as contrasted with the specifically human factors that make technological efficiency. 1908, 349-50. In short, as the industrial system grows in complexity, the productivity theory of distribution becomes an oxymoron. To illustrate the holistic nature of contemporary industry, consider the automobile sector. Its research and development process incorporates knowledge from fields as diverse as mathematics, physics, chemistry, biology, metallurgy, economics, demography, sociology, and politics. Its production relies on coordinating the interaction of raw materials, labor, assembly facilities, infrastructure, transportation, and distribution systems in numerous countries. Finally, development, production and consumption are all path-dependent. For example, the emergence of large-scale petroleum refining, suburbanization and the highway system accelerated automobile production in the 20th century, while congestion and environmental limits will likely hinder it in the 21st. In this increasingly complex context, with technology being temporally cumulative, spatially interdependent, and intermingled with politics, it is practically impossible as well as theoretically inconceivable to even identify all inputs, let alone determine their separate productive contributions. And that is merely the first step. The hand of power. Our automobile example shows that the industrial process is comprehensive and integrated. But that in itself does not make it efficient. The added difficulty emerges because, according to Veblen, industry is subjugated to business. The compass that directs the production of automobiles in our example is corporate earnings, yet contrary to the various doctrines of political economy, says Veblen, these earnings depend not on efficiency, but on sabotage. Most generally, the income of an owner is proportionate not to the specific productive contribution of his or her input, and not even to the exploitation of productive workers, but rather to the overall damage that an owner can inflict on the industrial process at large. The implication is that every bit of the industrial process is touched by the hand of power. In the case of automobile production, every aspect from environmental considerations, suburbanization, and the highway system, through the global coordination of manufacturing and the conditioning of workers and consumers, to the development process and the basic science is intermingled with power. And so, even if we were somehow able to miraculously conjure up the distinct connections between these many inputs and their automobile output, the result would reflect not productivity per se, but the control of productivity for capitalist ends. From this viewpoint, it is impossible to speak of a depoliticized economy as the liberals do, or of a separation between economic exploitation and political oppression as the Marxists articulate. The basic distinction, rather, is between power and creativity, and the task is to analytically disentangle their specifically capitalist incarnations of industry and business. The social hologram. The whole picture. Metaphorically, the interaction of industry and business can be thought of as a social hologram. The concept of the hologram, alluded to earlier in the book, was invented in the late 1940s by the Hungarian, British physicist Denis Gabor, an invention for which he later won the Nobel Prize. Technically, the hologram is a photographic method that uses a laser beam to record and then read and project the interference pattern of incidental waves. But it is much more than a mere technical gadget. Seen as a conceptual approach, the hologram has immense potential implications that go far beyond photography. To illustrate the underlying principle, think of a pond into which 3 pebbles are dropped simultaneously. These 3 incidental events create a structure of evenly spreading and intersecting waves throughout the pond. Now, suppose that we were to freeze the pond instantaneously, pick up the top sheet of ice containing the wave pattern, and then drop it to the ground so that it shatters to pieces. Because of the curvature of the waves, each piece, no matter how small or from which part of the pond, will contain enough information, a bit fuzzy but nonetheless complete, to trace the 3 events. All we need to do is to extend the partial arcs on the piece into complete circles and then find their centers. Our ability to do so turns each piece into a hologram, the ancient Greek for the whole picture. Point 2. Since its invention, Gabor's hologrammic concept has been extended to the study of physics and neuropsychology, among other areas. Point 3. Without implying comparable precision, it seems that Veblen's conception of industry and business could also benefit from the hologrammic metaphor. In this metaphor, society is the pond, and each human pulls a new idea, a realignment of institutions, people, or machines. A particular social transformation of matter and energy is a drop of a pebble. The resulting social hologram is temporal as well as spatial. In its most generalized conceptualization, it encompasses the whole spectrum of contemporary human activity along with all of its historical lineages. Now, in this metaphor, every social creation and therefore every good and service can be thought of as a slice of this hologram. To the naked eye, these slices may appear as distinct particles. Yet each and every one of them embodies the entire wave-like interaction of all human pulses, past and present, positive or negative. Seen from this perspective, the conventional input-output ideology becomes a misleading simplification. It focuses on first-order relations between the observed, or rather seemingly observable, quantities of the individual particles, while ignoring the invisible but far more important multilayered fusion of social, political, and technological impulses without which the individual particles could not be thought of as inputs or outputs in the first place. Unfortunately, though, the social impulses that make up this hologramic fusion cannot be assigned objective individual weights commensurate with their separate contributions, whether productive or counterproductive. Unlike natural events, these impulses are social in nature and intersubjective in interpretation. Although each of them is present in every social product, the extent of that presence is impossible to quantify objectively. And that impossibility pretty much seals the fate of any theory attempting to root distribution in objective productivity. The quantitative input-output structure of production cannot be mapped because it does not exist, and what does not exist cannot be a basis for theory that purports to measure it. Resonance and dissonance. The alternative is to think of this hologramic interaction in its totality. A single pulse still means little. A repeated pulse creates a pattern. A repeated pulse coming at a regular interval, i.e. at a given frequency, creates a stylized oscillating pattern. Oscillators pulsing at their so-called natural frequency tend to speak easily with other oscillators that beat at the same or similar frequency. Their co-vibrations are said to resonate. Resonance systems are energy efficient, requiring minimal energy both to sustain and amplify their vibrations. They are also self-synchronizing, tending to recalibrate and pull in outliers that beat at slightly different frequencies. Finally, they pervade the universe all the way from the structure of the atom, through living systems, to the movement of celestial bodies. Metaphorically, we can think of Veblen's industry as a resonance system. Its purpose is to better human life efficiently, and that purpose can best be achieved through reasoned coordination and integration, that is, through a resonance system whose numerous social pulses are organized so that they beat at purposeful and mutually reinforcing frequencies. What constitutes a resonant industry and, indeed, the very good life its resonance tries to achieve is of course open-ended. It is up to society to decide these things. And such decisions, since they concern society as a whole, become more meaningful as they grow more democratic. This articulation of industry yields a notion of productivity that is very different from the one used in conventional political economy. Neoclassicists and Marxists think of productive efficiency in terms of objective inputs and outputs. The goal is output, and efficient processes are those that produce a given output with the minimal amount of inputs. This definition, though, cannot be applied to the analytical notion of a resonant industry for two basic reasons. First, the ends and means of industry do not have objective quanta. When a single person assesses the relationship of a well-defined set of inputs and a single output, the measurement may seem unambiguous. But as we have seen in Chapter 8, the illusion of objectivity quickly dissipates once we start to aggregate, and it disappears completely when we deal with society as whole. At that level, the magnitudes can only be measured intersubjectively. This intersubjectivity can take various forms. It can be enforced by a dictator or an oligarchy, it can be imposed by capitalist power through the guise of voluntary exchange, or it can be decided openly and democratically, through a broad participatory process in which a resonance-seeking society conscientiously assigns quantities to its preferences and methods. The last measure, representing our articulation of industry, obviously is inconsistent with any objective definition of efficiency. The second reason is that the ends are not necessarily separate from the means. Standard measures of efficiency treat inputs as something to be minimized and outputs as something to be maximized, but that approach is meaningful only if the two categories are mutually exclusive. From the viewpoint of a resonant industry, though, the ends and means are not mutually exclusive, the creativity, joy, and comfort of those who produce are as important as what they produce. And since the very process of bettering human life is part and parcel of that better life, the inputs get mingled with the outputs and the conventional concept of efficiency breaks down. Instead of an objectively given ratio of outputs to inputs, productivity becomes what society makes it to be, the democratically articulated good life per person. With this alternative concept in mind, consider now the realm of business. Although endlessly crisscrossing that of industry, the sphere of business tends to pulse at different frequencies different from each other and different from that of industry. The main purpose of business is differential return. At the disaggregate level, this goal compels capitalists, as individuals and in groups, to act at cross purposes, such that each tends to beat at a different frequency. The aggregate picture is somewhat different. As we have seen in Part 3, at its most general level business has its own super-resonance, so to speak, a resonance manifested through the religious adherence of all capitalists to the universal commands of capitalization. But this super-resonance of business conflicts with that of industry. It has to. Now, it is true, and here we differ from Veblen and side with Marx, that business can and does propel industry. It pushes human beings, organizations, and institutions into a state of hyperactivity, constantly shaping and restructuring their interactions. But this propulsion, and here Veblen was right, does not and cannot make industry productive, by definition. If the propulsion resonates with industry, that is, if it serves the intersubjectively defined good life, it becomes part of industry. But then, since industry is open to all and therefore inherently non-profitable, the propulsion ceases to be a business proposition. The only way to make a profit is through dissonance. It is only by propelling industry in ways that interfere with and partly hamper its open integration, coordination, and the well-being of its participants that business earnings can be appropriated and capital accumulated. Of course, like all metaphors, this one too shouldn't be taken literally, but as a mental framework to help us imagine alternative explanations. The task now is to explore precisely how business undermines industry and the way in which their interaction can inform a concrete theory of capital as power. Absentee ownership and strategic sabotage. The natural right of investment. Over the long term, argued Veblen, output depends mostly on the size of the population and the scope of the industrial arts. Tangible assets are relatively insignificant. Throughout history, the occasional destruction of material equipment and resources has usually been a relatively minor inconvenience. In Ireland, for example, the encouragement of illiteracy by the British occupiers hindered development much more effectively than the destruction of the country's infrastructure. Even in the 20th century, when physical accumulation had reached unprecedented levels, it took war-stricken Germany and Japan only a few years to launch their economic miracles. In the short term, however, tangible equipment is significant, and it is here, according to Veblen, that ownership comes into the picture. For the transient time being, therefore, any person who has the legal right to withhold any part of the necessary industrial apparatus or materials from current use will be in a position to impose terms and exact obedience, on pain of rendering the community's joint stock of technology inoperative for that extent. Ownership of industrial equipment and natural resources confers such a right legally to enforce unemployment, and so to make the community's workmanship useless to that extent. This is the natural right of investment. Veblen 1923, 65-66, emphasis added. A modern reader may find this definition of investment puzzling, so it is perhaps useful to put the term in historical context. Originally, the meaning of investment had nothing to do with money and even less to do with production. Investment was a matter of power, pure and simple. Investio in Latin means to dress, and in Europe of the Middle Ages it was a signifier of feudal property rights. Lords would typically give their vassals a suit of clothing or vests as part of their keep and as a sign of honor. The symbolic ceremony of transferring property rights from the lord to the vassal was known as investiture. The property in question could have been an estate, an office, a monastery, or simply a stipend, feodum de bursa. The ceremony vested the vassal with the fief, conferring on him tenure or season a legal seizure protected against invasion from any quarter. Block 1961, 173, 349, Ganshof 1964, 97, 126. According to the Oxford English Dictionary, the word investment entered commercial use only in the early 17th century with the East India trade, and its contemporary connotation of converting money capital into tangible income-yielding assets appeared only in the middle of the 18th century. In other words, throughout the early history of the term, the causal link ran not from the creation of earnings to the right of ownership, but from vested ownership to the appropriation of earnings. And according to Veblen, the same principle continues to hold in the capitalist epoch. Capital goods yield profit not because of their individual productivity, but because they are privately owned to begin with, that is, owned against others. Private ownership and institutionalized exclusion. How does private ownership generate earnings? By necessity, every social order is created and sustained through a certain mixture of cooperation and power. In simple egalitarian societies, cooperation was paramount. In capitalism, power is the governing principle. The power principle of capitalism is rooted in the centrality of private ownership. The word private comes from the Latin privatus, meaning restricted, and from privare, which means to deprive. As Jean-Jacques Rousseau tells us, the first man, who, after enclosing a piece of ground, took it into his head to say, "This is mine," and found people simple enough to believe him, was the true founder of civil society. Rousseau 1754, Part 3. The most important feature of private ownership is not that it enables those who own, but that it disables those who do not. Technically, anyone can get into someone else's car and drive away, or give an order to sell all of Warren Buffett's shares in Berkshire Hathaway. The sole purpose of private ownership is to prevent us from doing so. In this sense, private ownership is wholly and only an institution of exclusion, and institutional exclusion is a matter of organized power. Exclusion does not have to be exercised. What matters is the right to exclude and the ability to exact terms for not exercising that right. This right and ability are the foundation of accumulation. Business enterprise thrives on the implicit threat or explicit exercise of power embedded in ownership, with capitalist income being the ransom for allowing industry to resonate. Plainly, ownership would be nothing better than an idle gesture without this legal right of sabotage. Without the power of discretionary idleness, without the right to keep the work out of the hands of the workman and the product out of the market, investment and business enterprise would cease. This is the larger meaning of the security of property. Veblen 1923, 66-67, emphasis added. Of course, the role of power is hardly unique to capitalism. According to Veblen, all forms of ownership are based on the same principle of coercive appropriation, which in his view dates back to the early stages of barbarism and the initial emergence of predatory social customs. The differentiating factor, he says, is technological. The institutionalization of forceful seizure is intimately linked to the nature of tangible implements and to their relative significance in production. In the earlier stages of social development, forced appropriation was limited because there was little to appropriate and most objects were easily replaceable. But as society's immaterial assets started to accumulate, so did the benefit from controlling its key material assets. The right to property. The first form of property rights, according to Veblen, 1898, 1899a, was the ownership of people, particularly women. Etymologically, the English word husband and the Mesopotamian word Baal both share the double meaning of ownership and marriage and, in the latter case, also sexual exploit and the superior male god of the West Semitic pantheon. 4. Subsequently, the focus of ownership shifted, although not necessarily linearly, from slaves, to animals, to land. The specific trajectory depended on the nature of technological development, and it was only recently that it moved primarily to produced means of production. 5 Notably, Prior to capitalism, neither slave ownership nor landed wealth were ever justified on grounds of productive contributions, both were institutionalized as a right by virtue of divine will or sheer force, but never as a consequence of creativity. Now, clearly, the mere ownership of capital is no more productive than the ownership of slaves or land, so why do economists insist it is? The answer, according to Veblen, is that economic theory had been unduly influenced by the transitory institutions of handicraft that existed during the transformation from feudalism to capitalism. Common sense suggested that craftsmen, working for themselves with their own material appliances, had a natural right to own what they had made. It also implied that they could dispense with their product as they saw fit, that is, sell it for an income. 6 Handicraft and petty trade thus helped institutionalize pecuniary earnings as a natural extension of ownership by creativity. With exchange seen as a natural right of ownership, the very earning of income became a proof of productivity. But this common sense is misleading for two reasons. First, even at the handicraft stage, production was an integrated societal process. Thus, despite the myth of individualism, private ownership was at least partly dependent on the dynamics of organized power, with the exclusionary practices of guilds offering a conspicuous illustration. Second, and more significantly, the institutions of handicraft were short-lived. As Veblen pointed out, technical change ushered in by the onset of the Industrial Revolution meant that production had to be conducted on a large scale, which in turn implied the progressive separation of ownership from production. The absentee ownership of power. During the earlier stages of capitalism, production and business were still partly interwoven. 7 Indeed, even as late as the 19th century, U.S. captains of industry such as Cornelius Vanderbilt and Andrew Carnegie were seen as creative forces, acting as master workmen as well as astute businessmen. This duality did not last for long, however, and as business became increasingly separate from industry, the implication was no less than profound. Gradually, capitalism came to mean not merely the amassment of capital goods under private ownership, but more profoundly a division between business and industry effected through the rise of absentee ownership. The institution of absentee ownership has altered the very nature and meaning of capital. Not unlike the European lords of the Middle Ages, who gradually withdrew from the direct management of their estates, modern capitalists have become investors of funds, absentee owners of pecuniary wealth with no direct industrial dealings. The complete delinking of capital from capital goods is well illustrated by comical extremes. In the summer of 1928, the world's largest oil companies signed the secret Red Line Agreement, parceling the Middle East between them for years to come. To celebrate the occasion, the architect of the deal, Calouste Gulbenkian, or Mr. 5% as he was otherwise known, chartered a boat to cruise the Mediterranean with his daughter Rita. Off the coast of Morocco, he caught sight of a type of ship he had never seen before. It looked very strange to him, with its funnel jutting up at the extreme stern of the long hull. He asked what it was. An oil tanker, Rita told him. He was 59 years old, he had just made one of the greatest oil deals of the century, he was the Talleyrand of oil, and he had never before seen an oil tanker. Jürgen 1991, 206. This illustration is not an outlier. Currently, roughly half of all capitalist assets are owned indirectly through institutional investors such as pension and mutual funds, hedge and sovereign funds, insurance companies, banks, and corporations. The ultimate owners of these assets, whether big or small, exercise little voice in the management of the underlying production processes. For the most part, they merely buy and sell shares of these assets and collect the flow of dividends. Often, their diversification is so extensive that they don't know exactly what they own. And that characterization is by no means limited to portfolio owners. Many of the largest direct investors, including the capitalist dons whose names populate the Forbes listing of the super-rich, are equally removed from any industrial dealings. Most of their energies are spent on the high politics of sabotage and the fine art of cutting and pasting assets through endless deals of divestment and merger activities that they commonly carry out, just like Gulbenkian, without ever seeing a single capital good. Whereas most economists continue to view capital as an amalgamation of machines, structures, semi-finished commodities, and measure of their ignorance technology, for the business investor capital has long been stripped of any physical characteristics. In the eyes of modern owners, whatever their gender, color, religion, sexual inclination, ethnicity, culture, nationality, creed, height, weight, or age, capital means one thing and one thing only: a pecuniary capitalization of earning capacity. It consists not of the owned factories, mines, aeroplanes, retail establishments, or computer hardware and software, but of the present value of profits expected to be earned by virtue of such ownership. Of course, neoclassicists have never had a quarrel with capital as the present value of future earnings. In the long run, they assure us, demand and supply make this present value equal to the cost of producing that capital, assuming competitive markets, perfect foresight, and the rest of the hedonic fairy tale. But as Veblen, 1908, acutely observed long before the Cambridge controversy, and as we have seen in Part 3, this explanation was logically faulty from the very start. If capital and capital goods were indeed the same thing, he asked, how could capital move from one industry to another, while capital goods, the abiding entity of capital, remained locked in their original position? Similarly, how could a business crisis diminish the value of capital when, as a material productive substance, the underlying capital goods remained unaltered? Or how could existing capital be denominated in terms of its productivity, when technological progress seemed to destroy its pecuniary value? For Veblen, the answer was straightforward: capital simply is not a double-sided entity. It is a pecuniary magnitude, and only a pecuniary magnitude, and its magnitude depends not on the capacity to produce but the ability to incapacitate. In the final analysis, the modern capitalist is nothing more than an absentee owner of power. Strategic sabotage. What exactly is this power to incapacitate? Where does it come from, what form does it take, and how does it yield profit? According to Veblen, the answer remained obscure partly because the historical consolidation of capitalist property rights slowly substituted ideological manipulation and legal authority for brute force and religious sanctity. With the twin emergence of the modern corporation and the modern state, capitalism has acquired a civilized face, absentee ownership has become a legitimate norm, open violence has been replaced by latent threats underwritten by hefty advertising budgets, bloated security services and overflowing jails, and power has solidified into a mystical structure, at least for those subjected to it. In this new order, the power to incapacitate or sabotage, as Veblen liked to call it, becomes a fully legitimate convention, carried out routinely and invisibly through the very subordination of industry to business. The blueprints of capitalist production are already programmed for business limitation, its hired managers are schooled in the art of invisible restriction, and its top executives are remunerated in proportion to profit. In order to merely earn the normal rate of return, all the owner has to do is own. But then where is the sabotage? Is it not true that in order to profit, business enterprise needs to promote industrial creativity, productive ingenuity, and best practices? The answer is not really. Strictly speaking, business cannot promote industry. At most, it can unleash it, and even that it does only up to a point and under very specific conditions. Earnings do depend on output, but not on any type of output and not only on output. Moreover, the dependency is nonlinear and sometimes inverted, which is why Veblen referred specifically to strategic sabotage. Seen as an entire social order, business enterprise certainly is far more productive than any earlier mode of social organization. 8 Yet, in Veblen's opinion, the immense productive vitality of this social order is an industrial, not a business phenomenon. Business enterprise is possible only in conjunction with large-scale industry, though the reverse is not true, as illustrated by socialist industry or giant cooperatives such as Mondragon. The practices of business, of course, are closely related to industry, but only in point of control, never in terms of production and creativity. From this a priori vantage point, business per se is distinct from industry and therefore cannot boost industry, by definition. Even companies in possession of cutting-edge technology cannot promote industrial creativity. Instead, they can merely relax, usually for a hefty fee, some of the constraints that would otherwise limit creativity. This interpretation of the hyperproductivity of capitalism is quite different from that of Marx. In our view, Marx was correct to stress the dialectical imperative of technical change, an emphasis that the evolutionist Veblen preferred to disregard. Over the longer haul, capitalists indeed find themselves compelled and in turn force their society to constantly revolutionize the pattern of social reproduction. They continually invest in having industry develop for them new methods and products and in expanding their capacity to produce them. Yet all of this they do in the expectation of adequate differential returns, and differential returns are possible only through restriction. Free is not a business model, explains the representative of eBay China, Dickey 2006. Money spent on having your engineers invent open source technology or on making your workers create physical capacity that everyone can freely use is money gone down the drain. The only way such spending can become a profit-yielding investment is if others are prohibited from freely utilizing its outcome. In this sense, capitalist investment, regardless of how productive it may appear or how much growth it seems to generate, remains what it always was, an act of limitation. The direction of industry. The limitation takes two general forms. The more important but also more elusive and harder to delineate concerns the very direction of industrial development. This restriction, of course, is hardly unique to capitalism, being inherent to the very development of any system of hierarchical production. According to the historical evidence marshaled by Stephen Margolin, 1974, rulers almost invariably fight to impose techniques that secure and amplify their power, often at the expense of efficiency, conventionally measured. This was true when the Romans forced slaves into brick and pottery factories, just as it was true when European feudal lords imposed water mills and prohibited hand mills, when post-bellum American planters forced a credit-based system of sharecropping on small farmers, and when Stalin collectivized Soviet agriculture. The purpose of these technological impositions, Margolin argues, was divide and conquer. And in his opinion, the same remains true with capitalist production. This is why British capitalists retained demonstrably inefficient mining techniques, why they introduced the factory system well before the arrival of machines, and why they insisted on a minute division of labor that was debilitating to the point of becoming technically counterproductive. At first sight, this capitalist imposition of inefficiency may seem surprising, if not counterintuitive. After all, capitalists seek profit, profit increases as cost falls, and cost falls as efficiency rises, so isn't it in capitalists' best interest to adopt the most productive techniques? What exactly is the point of increasing power if the end result is lower profit? The question may sound biting, but it is the wrong one to ask. In fact, there is no contradiction at all. In reality, power means not less profit but more profit. The confusion is easy to sort out. The idea that profit maximization necessitates cost minimization and that cost minimization requires efficient production holds only in the fairy tale of perfectly competitive equilibrium. In this fictitious context, where prices and wages are set by mother market to equilibrate marginal productivity and utility, it certainly makes sense for the representative capitalist to adopt the most efficient techniques. 9. But once we get rid of the fiction and move to the real world where prices represent not utility and productivity but power, these imperatives immediately break down on their own terms. Productive efficiency, minimum inputs per unit of output, no longer implies economic efficiency, minimum cost per unit of output, and economic efficiency no longer means maximum profit. In this imperfect context, it makes perfect sense for capitalists to impose inefficient techniques. Their very inefficiency is the power leverage through which profits are generated. Let's illustrate this principle with more contemporary examples. Take transportation. On the face of it, a well-designed public transit seems much more conducive to human welfare and the natural environment than private transit. Yet, in the US and elsewhere, capitalist transportation has tended to move away from the public and toward the private. And the reason is not hard to grasp. Public transportation resonates with the integrated operation of industry and therefore doesn't sit well with regular flow of business profit. This is perhaps the reason why early in the 20th century the automobile companies bought and dismantled 100 electric railway systems in 45 U.S. cities, Barnett 1980, ch. And it is also why these companies have long shunned any radical change in energy sources. The electric car, first invented in the 1830s, predates its gasoline and diesel counterparts by half a century, and for a while was more popular than both, Wakefield 1994. But by the early 20th century, having proved less profitable than the gas guzzlers, it fell out of favor and was forcefully erased from the collective memory. Then came intolerable pollution, which in the 1990s led the state of California to mandate a gradual transition of automobiles to alternative energy. Complying with the new regulations, General Motors had its engineers quickly develop a highly efficient electric car, the EV1. But fearing that this gem of a car would undermine profit from their gas guzzlers, the company's owners, along with owners of other concerned corporations in the automotive and oil business, also invested in an orchestrated attempt to defeat the California bill. When the regulation was finally overturned, every specimen of the EV1 was recalled and literally shredded, Payne 2006.10. A similar pattern emerges in the setting of broad electronic standards. In theory, the goal of such standards is to have as many different electronic components and processes resonate as seamlessly and effortlessly as possible. In practice, though, the debate is not over industrial resonance but business profit. It is not the technical blueprint that matters, but who will control it. The production of digital audio tapes, DAT, in the early 1990s, for instance, had been postponed, to the point of making the technology outdated, because several large firms could not reach a consensus regarding its effect on recording profits, a saga that has since been replayed in the format wars over digital versatile discs, DVD, and high-definition optical discs. These examples can easily be extended. Other broad industrial diversions include the development by pharmaceutical companies of expensive remedies for invented medical conditions instead of drugs to cure real disease for which the afflicted are too poor to pay, the development by high-tech companies of weapon technologies instead of alternative clean energies, the development by chemical and biotechnology corporations of one-size-fits-all genetically modified vegetation and animals instead of biodiversified ones, the forced expansion by governments and realtors of socially fractured suburban sprawl instead of participatory and sustainable urbanization, the development by television networks of lowest denominator programming that washes the brain instead of promoting its critical faculties, and so on. Of course, as we repeatedly noted, the line separating the socially desirable and productive from the undesirable and counterproductive is intersubjective and contestable. But taken together, these examples nonetheless suggest that a significant proportion of business-driven growth is wasteful if not destructive, and that the sabotage underlying these socially negative trajectories is exactly what makes them so profitable. The pace of industry. The other limitation, perhaps less important but easier to approximate, concerns the growth of industrial capacity and output, whatever their purpose. The conventional view, both popular and academic, is that business loves growth. The more utilized the capacity and the faster its expansion, the greater the profit, or at least that's what we are told. The facts, though, tell a very different story. In reality, business can tolerate neither full capacity utilization nor maximum growth. And why the aversion? Because otherwise profit would collapse to zero. Consider again the automobile sector. Were the large car companies to decide to produce as much as possible rather than as much as the traffic can bear, their output could probably double on fairly short notice. And this potential is hardly unique to automobiles. Almost every modern industrial undertaking, from petroleum, through electronics, to clothing, machine tools, telecommunication, pharmaceuticals, construction, food processing and film, to name a few, tends to operate far below its full technological capacity, not to be confused with full business capacity. Point 11. If all industrial undertakings were to follow the reckless example of automobiles, the relentless pressure of oncoming goods and services would undermine tacit agreements and open cooperation among dominant firms and government agencies, trigger massive downward price spirals, and sooner or later end up in a Great Depression and a threat of political disintegration. Speculating in a similar vein, Veblen, 1923, 373, concluded that it was therefore hardly surprising that such a free run of production has not been had nor aimed at, nor is it at all expedient, as a business proposition, that anything of the kind should be allowed. Point 12. Profits are inconceivable without production, but they are also impossible under a free run of production. For profits to exist, business enterprise needs not only to control the direction of industrial activity, but also to restrict its pace below its full potential. Business as usual. Conceptually, we would expect there to exist a nonlinear relationship between the income share of capitalists on the one hand and their limitation of the pace of industry on the other. Point 13. This relationship is illustrated hypothetically in Figure 12.1. The chart depicts the utilization of industrial capacity on the horizontal axis against the capitalist share of income on the vertical axis. Up to a point, the two move together. After that point, the relationship becomes negative. Figure 12.1, Business and Industry. The reason is easy to explain by looking at extremes. If industry came to a complete standstill, capitalist earnings would be nil, bottom left point in Figure 12.1. But capitalist earnings would also be zero if industry always and everywhere operated at full socio-technological capacity, bottom right point. Under this latter scenario, industrial considerations rather than business decisions would be paramount. Production would no longer need the consent of owners, and these owners would then be unable to extract their tribute earnings. Point 14. In a capitalist society, business as usual means oscillating between these two hypothetical extremes, with absentee owners limiting industrial activity to a greater or lesser extent. When business sabotage becomes excessive, pushing output toward the zero mark, the result is recession and low capitalist earnings. When sabotage grows too loose, industry expands toward its societal potential, but that too is not good for business, since loss of control means glut and falling capitalist earnings. For owners of capital, the ideal condition, indicated by the top arc segment in Figure 12.1, lies somewhere in between, with high capitalist earnings being received in return for letting industry operate, though only at less than full potential. Achieving this optimal point requires Goldilocks tactics, neither too warm nor too cold, or what Veblen sardonically called the conscious withdrawal of efficiency. This theoretical relationship receives an astounding empirical confirmation from the recent history of the United States, depicted in Figure 12.2. The chart contrasts the success of business on the vertical scale with the limitation of industry on the horizontal. The former is measured by the income share of capitalists, profit and interest, the latter by the rate of unemployment, inverted from right to left. Point 15. The data clearly show the negative effect on business both of excessive industrial sabotage until the early 1940s and of insufficient sabotage during the Second World War. Business as usual was restored only after the war, with growing industrial limitations helping capitalists move up and to the left on the chart, toward their optimal income share. Point 16. Figure 12.2, Business and Industry in the United States. Note, series are shown as 5-year moving averages. Source, U.S. Department of Commerce through Global Insight, series codes, INT Natamisk for interest, ZBCON for profit, YN for national income, RUC for the rate of unemployment. Taking stock and looking ahead. Building on Veblen, our discussion so far has illustrated how business and industry could be thought of as fused yet distinct spheres of capitalism. According to this framework, industry is an integrated creative process whose productivity derives from the totality of its purposefully resonating pulses. By contrast, business is a power process carried out through the prerogatives of ownership. Owning per se is an idle act. It has no productivity and therefore no bearing on industry, either positive or negative. Owners of course can impact industry indirectly. But for this impact to be profitable it has to be negative. It is only by stirring the development of industry in directions that are wasteful and harmful yet easier to control, or by strategically limiting its pace so that their own discretion doesn't become redundant, that profit can be earned. It is this threat of dissonance that enables absentee owners to lay claim to a process to which they do not directly contribute. That is how capitalist earnings are generated. In what follows, we concentrate specifically on the way in which business limits the pace of industry. Extending Veblen, we identify two types of sabotage: 1. Universal business as usual limitations that are carried out routinely and uniformly by all firms, and 2. Limitations that are unique to a single company or group of companies. Corresponding to these two types of limitations are two rates of return: 1. A normal rate of return that all capitalists believe they deserve, and 2. A differential rate of return that capitalists seek over and above the normal. Pricing for power. Begin with the universal methods of sabotage. To the uninitiated, these are practically invisible. They involve no violence and force, no fire and blood, no hunger and deprivation. They do not even seem to restrict industry. For the most part, their path is clean and detached. And the reason is simple: they operate not directly, but indirectly, through the fundamental unit of the capitalist order, price. From price taking to price making. According to received liberal dogma, firms are price takers, they accept whatever price mother market gives them. The reality, though, seems to suggest the exact opposite. The standard practice, documented extensively and repeatedly since the 1930s, shows that most modern firms are price makers. They set their own price and then sell as much as possible at that price. Neoclassicists have fought tooth and nail to deny this inverted reality. They had no other choice. To recognize price making would have pulled the rug from under conventional price theory and brought down the rest of economics. Substantively, their counterattack was a failure. Although led by some of the heaviest guns, it hardly dented the facts: price making was here to stay. Pedagogically, though, the attack was highly successful. It managed to expunge the whole debate from introductory economics textbooks, with the result that today's students know little or nothing about the controversy. A brief outline therefore seems appropriate. Point 17. The first to question seriously the competitive price-taking model and to emphasize the tendency toward oligopoly and monopoly was Veblen. Point 18. During the Roaring Twenties his interventions were duly ignored, but by the 1930s, with the Great Depression having opened the door to intellectual dissent, his insights began to echo. Within a few years, the neoclassicists found themselves confronted with two sets of challenges. The first were the theories of imperfect competition, by Robinson 1933, and monopolistic competition, by Chamberlain 1933. Many neoclassicists considered these deviations scandalous, but in due course they managed to domesticate and absorb them into their creed. Their task, though, wasn't nearly as easy with the second set of challenges. These were empirical, and they proved impossible to tame. The debate opened with Gardner Means' path-breaking work on industrial prices in the United States, 1935a, 1935b. Means showed that there were in fact not one but two types of prices. The first were the familiar market prices, relatively flexible, moving up and down with supply and demand and prevalent in competitive industries. But there was also a second and heretofore unfamiliar type of administered prices, relatively inflexible, changing only infrequently, responding slowly to market conditions and typical of concentrated industries. This duality had two far-reaching implications. The first was that prices were intimately connected to crisis and in more than one way. Means showed that during the Great Depression, competitive industries saw massive declines in their market prices, but only moderate drops in their output and employment. The situation in concentrated industries, though, was exactly the opposite. prices declined slightly, while production and payroll collapsed, sometimes by as much as 80%. In other words, the Great Depression occurred mostly in concentrated industries whose prices proved relatively inflexible. Seen from a Vebelnian perspective, administered prices were nothing but a mechanism of industrial sabotage. The second implication was theoretical and general. Profit maximization requires that firms make the best out of the circumstances they face. Administered prices, though, respond only partly or not at all to market conditions. This discrepancy means that companies that set such prices do not make the best out of the circumstances, and, therefore, that they do not maximize their profit. The conclusion was simple and painful: the more prevalent administered prices become, the greater the irrelevance of standard price dogma. And since, according to study after study, most prices are administered, the agony must be considerable. 19. The markup and the target rate of return. The first explicit confirmation of this painful conclusion came a few years later, with the publication of Hall and Hitch's work on business behavior, 1939. Whereas Means focused on the pattern of prices, Hall and Hitch investigated those who set them. They interviewed company officials in Britain, asking them to explain how they determined prices. And their conclusions were stunning, at least by neoclassical standards. It turned out that firms did not follow the neoclassical recipe of equating marginal revenues and cost, that they did not know what these marginal magnitudes meant, and, most embarrassingly, that they did not care about profit maximization to begin with. The process that firms did follow was totally different. They started by calculating what they considered to be normal unit cost, namely the cost at normal levels of output. They tacked onto this cost a conventional markup, and they kept the resulting price stable in the face of cyclical variations in demand. Later on, these findings were augmented by the notion of a target rate of return. According to the empirical research of Kaplan, Derlam, and Lanzelotti, 1958, modern firms, particularly the leading ones, begin with a long-term target rate of profit, and then back-calculate the markup necessary to realize this rate of return over the longer haul. 20. This method seems straightforward, and it probably is for the price-setting firm. But not so for the theorist. Whereas the former merely has to act, the latter has to reason. And as it turns out, the pricing formula cannot be explained easily. The main problem is the target rate of return and the associated conventional markup. Since these no longer obey the rules of profit maximization, there is no way to find their unique values. In theoretical parlance, they become indeterminate. Hall and Hitch, 1939, 28, tried to solve the problem by making the markup a reflection of the community of outlook of businessmen, while others, such as Eichner, 1976, anchored the target rate of return in the firm's investment plans. However, conventional economic theory does not know how to theorize airy concepts such as the community of outlook and investment plans, as a result of which economic science has not yet solved its first problem: what determines the price of a commodity. Robinson, 1966, 79. A possible way out of this puzzle was pointed out by Michael Kalecki, 1943a, whom we have mentioned in Chapter 4. For Kalecki, the markup was not simply a vague social convention, but a measure of power. He called it the degree of monopoly. 21. Monopoly power, like every other form of power, can be known only by its consequences. And for Kalecki, that consequence was the markup. The higher the markup and its associated rate of return, the greater the implied power of those who set it, and vice versa. Pricing and incapacitating. And so the circle closes and sabotage becomes invisible. The vast majority of modern capitalists, or their managers, are price makers. They fix the price of their product and then let market forces do the rest for them. To the naked eye they all seem keen on producing and selling as much as possible, but beyond the facade the picture is very different. The specific level at which they set the price already embodies the power to incapacitate. On the one hand, The profit target and markup built into the price reflect the firm's power, while, on the other hand, that power, exercised by the high price, serves to restrict industry below its full capacity. The sabotage and the power to inflict it remain concealed, but their consequences are very real. Is free competition free of power? Now, up to this point, our discussion has been limited to the mainstream of administered prices. It should be added, however, that even in those isolated cases where free competition is said to reign, the power to incapacitate is not at all absent. To see why this is so, consider a neoclassical perfectly competitive firm, but instead of focusing on what it does, think of what it is unwilling to do. For illustration, take the case of mining, where prices are presumably set by global supply and demand. A reader schooled in neoclassical theory may be tempted to conclude that, at least in such cases, the presence of market prices excludes sabotage. But it ain't necessarily so. Mining output, much like any other output, is controlled by business. The actual production of a single firm and the number of firms in operation therefore are bounded not by the state of industrial arts, but by what can be sold at a reasonable profit. In fact, this is exactly what standard neoclassical manuals tell the owner of a perfectly competitive firm: in the long run, have your company produce only if you expect to earn at least the normal rate of return. Otherwise, shut down. For neoclassicists who insist on equating the normal rate of return with the marginal revenue product of capital, this stipulation simply assures efficient resource allocation. From a Webelnian standpoint, though, this unwillingness to produce for less than some conventional rate of return is the very manifestation of industrial sabotage. Thus, although perfectly competitive firms may not set prices, their productive activity individually and in the aggregate nevertheless is limited by the imperative of earning a normal rate of return. The capitalist norm. The normal rate of return and the natural rate of unemployment. The normal rate of return, of course, is a fuzzy magnitude, a convention that varies among business owners and over time. The important point, however, is that this normal rate exists in the first place. With the gradual penetration of capitalist institutions, owners have come to believe that the flow of profit is a natural, orderly phenomenon. As such, profit is seen as having a more or less predetermined mean growth rate and a dispersion that varies with circumstances, expressed by the standard deviation from this mean. According to Veblen, this development is hardly trivial. Until a few hundred years ago, profit was seen more as a coincidence than a regular feature of ownership. The main goal was to retain property, and owners of land, slaves, or gold rarely expected their assets to grow on their own. But under capitalism, where the business limitation of industry grows increasingly universal, the consequent profit is regarded as natural and its rate of expansion as normal. In this way, the strategic limitation of industry can prevail even in the absence of explicit binding arrangements. The normality of profit has been so thoroughly accepted that the industrial limitation from which it derives is no longer self-evident. Consider the fact that since 1890, the first year for which aggregate data are available, the official U.S. rate of unemployment averaged 7% or 5.7% without the 1930s. Economists, however, remain unimpressed by this fact. Indeed, that is exactly what they expect. Given that this average rate has been associated with business as usual, most now take it to represent the natural rate of unemployment. In an unconscious Orwellian bent, modern textbooks casually talk about the full employment-unemployment rate, unemployment equilibrium, and overfull employment, generally without quotation marks. See for example Parkin and Bade 1986, 282-83, and Branson 1989, 188. Even Carlyle could not have foreseen the dismal state of a society subjugated to the economic science. Antecedents, return and sabotage in antiquity. The power features of the capitalist normal rate of return are not without precedent. Their origins can be traced to the early emergence of the rate of interest in the Middle East some 4,500 years ago. The ancient interest rate, just like today's normal rate of return, was a matter of power and sabotage. But its institutional and societal underpinnings were radically different and are worth exploring so as to put our discussion in context. Point 22. The roots of the pecuniary standard are inherently negative. In almost every language, the concept of debt is associated with guilt and sin. Originally, proto-money was used for the settling of obligations, including reparations. Pay and pacify share the same root in both English and Hebrew: marriage debts, communal fines, religious offerings and, eventually, royal taxes. The mas, the Sumerian term for interest, means kid and calf, a term that developed from the earlier religious proto-tax of the mas fee. Mina in Hebrew means herd narrowly and movable property more broadly. Similarly, the words pecuniary, fee and feudal all derive from the Latin pecus, a concept that later came to denote cattle, but that originally referred more broadly to personal chattels and movable wealth. Livestock etymologies and growth metaphors have led neoclassicists to conclude that ancient interest payments on debt were natural returns on productive agricultural yield. This is an erroneous interpretation for two reasons. First, although debt, along with many other concepts, was often counted in pastoral units, it was considered barren throughout antiquity. Second, and more straightforwardly, most lending in antiquity had nothing to do with investment and therefore had no return from which to deduct interest. The institution of interest was first invented in Sumer during the 3rd millennium BCE, from where it later spread to the eastern Mediterranean, Greece, and Rome. From their very inception, debt, credit, and interest were matters of organized power. The Sumerian proto-monetary architecture was fundamentally statist. Point 23. It developed as a royal method of administration and accounting, a system with which the palace and temple allocated material provisions, organized production, and collected taxes. Commercial and long-term trade accounting, wherever they existed, were part and parcel of this statist architecture. The Sumerian debt system was very different from the capitalist one. Capitalist borrowers are usually thought of positively, as entrepreneurs who leverage their own money in order to make more money. By contrast, most Sumerian borrowers were farmers in distress, on the brink subjects whose dire circumstances forced them to mortgage, or death pledge, their cattle and even family members just to make ends meet. These peasants did not invest their loans, they used them simply to stay alive. And since the borrowers made no productive advances, there was no reason for the interest they paid to bear any relationship to the efficiency of their chattel or the yield of their fields. Point 24. And, indeed, contrary to the ever-fluctuating capitalist normal rate of return, the standard Sumerian rate of interest never changed. It was fixed at 1/60th per month, or 20% annually, and did not budge for more than a millennium. The Greek interest rate of 1/10 per annum and the Roman rate of 1/12, although not nearly as durable as the Sumerian, were also set for long periods of time. The stability of these ancient rates reflected the pattern of agricultural seasons, a system of mathematical fractions and a set of religious myths, a combination that the ruling elites gradually synthesized and locked into an inflexible architecture of pecuniary rules. This pre-capitalist architecture, just like the capitalist one, was rooted in organized power and inflicted plenty of damage. Exorbitant interest rates dispossessed and enslaved numerous borrowers. In fact, the sabotage was so severe that ancient rulers had to announce periodic debt moratoriums, or clean slates, to avoid social disintegration. But this is where the similarity ends. Pecuniary power, ancient versus capitalist. In antiquity, organized power was enforced directly by royal decree and increased by the open use of force. Wealth was a subset of power, an entity whose magnitude depended on the whim of gods and the dose of violence. It had no predetermined pace of growth, positive or negative, natural or religious. And whatever its erratic rate of expansion, it obviously could not have depended on a fixed rate of the interest. The latter was seen primarily as an administrative device. The ancients even forbade its compounding. The capitalist order puts this logic on its head. On the surface, organized power seems to have vanished. With autonomous, growth-seeking agents engaged in voluntary transactions, the normal rate of return no longer connotes destitution and enslavement. But this is no more than an optical illusion. Paraphrasing Anatole France, the main novelty is that now everyone is free to sleep under the bridge. Organized power is still very much there, albeit in a totally different form. Instead of open violence administered by state rulers, we have administered prices openly imposed by private absentee owners. On the consensual surface of the market, no one seems to hold that power. But the unshaken belief in the normal rate of return and its associated natural rate of unemployment attests to the omnipresence of power. Unlike its ancient predecessor, the normal rate of return is no longer a mere administrative device. Whereas in antiquity the rate of interest was a subsidiary of state power, under the system of business enterprise the capitalist state itself is gradually subsumed by the logic of the normal rate of return. Government deliberations and decisions are constantly under the long shadow of the bond market, and even central bankers, who ostensibly determine the short-term risk-free rate of interest, in fact take their cue from the market. 25 The normal rate becomes a central feature of the capitalist nomos. It is the yardstick on which capitalization is based and the principal evidence that not only the level of organized power, but also its augmentation, is natural, inherent and just. The differential underpinnings of universal sabotage. Where does the capitalist normal rate of return come from? Paradoxically, the universality of profit and the regularity of its expansion are based on the specific institutions of differential sabotage. Indeed, a normal rate of return can exist only because owners are never satisfied with it. What owners believe they are entitled to under normal circumstances is not what they seek in practice. The primal drive of modern business enterprise is not to meet but to beat the average. Business performance is denominated in relative, not absolute terms, and it is getting ahead of the competition that constitutes the final aim of all business undertakings. This compelling desire to outperform, to earn more, to grow larger, to expand faster than others is perhaps the most fundamental urge of contemporary business. In that sense, even members of the tightest oligopolistic coalition are fiercely competitive. Paul Johnson, 1983, ch. associates this relativism with the 20th century vulgarization of Einstein's theory. In his view, the misplaced socialization of physics ushered in a total meltdown of the absolute values, both religious and ethical, that characterized the 19th century. But such cultural emphasis, however appealing, misses the structural imperative of accumulation. Understood as a power institution, capital is inherently differential, a crucial aspect to which we turn below. For the moment, though, our focus is on how the differential limitation of industry forms the basis for the normal rate of return. Differential returns mean above-average profit growth. Such returns usually require raising one's own profit growth, though that in itself is rarely feasible without also limiting the average growth of profit. The problem is simple. Profit is a product of sales and the profit share in sales. Individual firms can try to raise their sales volume faster than the average, but that alone will not guarantee differential profit growth, since sales and the profit share are not independent. If all firms push their sales up, the consequence is an overall loss of business control over industry and a resulting drop in the overall profit share of income. The conclusion, well known since antiquity but broadly institutionalized only since the late 19th century, is the imperative of restricted access, for the profits of one owner, or a coalition of owners, to beat the average, others must be prevented from accessing the same earnings. Whereas the conventional logic of profit maximization focuses only on the capitalist's own lot, the quest for differential profit also involves the lot of other capitalists. The means of achieving this differential end are numerous, transcending both business and politics and spanning the societal spectrum from the individual to the global. These means include direct limitations, such as predatory pricing, formal and informal collusion, advertising, and exclusive contracts. They also include broader strategies like targeted education, patent and copyright laws, industrial policies, financial regulations, preferential tax treatment, legal monopolies, labor legislation, trade and investment pacts and barriers and, of course, the use of force, including military, for differential business ends. The negative industrial impact here is often indirect. For the benefiting owner, the differential gain accrues because the necessary industrial limitation is borne by other owners. For instance, historically the large petroleum companies have gained from expanding world demand at least partly because they have been politically able to keep smaller independent companies largely out of the loop, Blair 1976. On the other hand, when exclusion cannot be ensured, like in the case of software development or the manufacturing of microchips, soaring production often overshoots into excess capacity and falling profits. In general, then, the negative impact of business on industry is both indirect and nonlinear, while profits usually correlate positively with one's own industrial activity. Beyond a certain point this correlation is maintained only insofar as the production controlled by others is contained. In sum, business profits are possible because absentee owners can strategically limit industry to their own ends. Such control is carried out routinely, either by pricing products toward earning a target rate of return at some standard capacity utilization, or by making industrial activity conditional on earning a normal rate of return. Underlying these universal business principles are numerous differential practices, with owners, individually or in groups, trying to redistribute income via institutional and organizational change. The specific aim of most, though not all, differential tactics is to restrict the industrial activity controlled by existing or potential rivals. Their aggregate consequence is dissonance that undermines the industrial community at large, yielding a natural rate of unemployment on the one hand and a corresponding normal rate of return on the other. The link between differential and universal industrial sabotage is closely related to the twin conflicts pervading the regime of business enterprise, one between absentee owners and the industrial community, the other between absentee owners themselves. These two conflicts resemble Marx's distinction between the class struggle and intra-capitalist competition, but with a big difference. Whereas for Marx the class struggle was conceptually prior to the intra-class relationship among capitalists, in our view they are two sides of the same process. The dominance of capital over society depends on a pecking order among capitalists themselves, and vice versa. On a disaggregate level, the distribution of profit among absentee owners is roughly related to the balance of business damage they can inflict on each other. And on the aggregate level, the overall industrial sabotage arising from their internal business warfare determines their overall profit share, although not in any linear way and along with other factors. In other words, the goals of business owners revolve around the distribution of profit, while the methods of business sabotage ensure that such profit is made available in the first place. Capital and the corporation. Capital as negation. One reason why Veblen's analysis never became too popular is that it made business capital a negative industrial magnitude. This view of the business-industry nexus is alien to both neoclassical and Marxian thinking. For neoclassicists, who emphasize harmony and equilibrium, the positive social value of capital is hardly in doubt. Contrary to this view, Marx accentuated the antagonistic social basis of capital, linking accumulation to exploitation. However, just like his liberal counterparts, he too stressed the relentless pressure to improve productivity, pressure that stems not from the lure of monopoly and imperative of power, but from the discipline of competition. And so despite the antagonism, or perhaps because of it, capitalists according to Marx must use their capital in the most productive way possible. Even British contributors to the Cambridge controversy were still ambiguous on the industrial footing of capital. As Joan Robinson, 1971, pointed out, Sraffa broke the conspiracy of silence by destroying the presumption that the profit rate measured the contribution of investment to national income, let alone to human welfare, by calling into question the positive connotation of both accumulation and growth, and by refocusing attention on distribution. But although Robinson later realized that Veblen had anticipated much of this critique, she never took the next step to explore the possibility that distributive power and industrial production were not simply uncorrelated, but negatively correlated, 1967, 60, 1975, 115 to 16. The difference is subtle but crucial. While the Cambridge controversy raised the possibility that capital could be unproductive, Veblen contended that, from an industrial point of view, it was necessarily counterproductive. This claim is not easy to dismiss. Business, like other power institutions throughout history, can force people to act, but it cannot make them productive. Moreover, productivity as such, being socially hologramic and therefore open and unrestricted, cannot generate a profit. The only way for capitalists to profit from productivity is by subjugating and limiting it. And since business earnings hinge on strategic sabotage, their capitalization represents nothing but incapacitation. In this particular sense, capital, by its very construction, is a negative industrial magnitude. The rise of the modern corporation. The emergence of capital as a business limitation of industry was greatly facilitated by the rise of the modern corporation and the larger use of credit as ownership. Now, on the face of it, this claim sounds counterintuitive. In fact, most readers would probably expect the exact opposite to be true, namely, that the corporation emerged precisely because of its productivity. But as with many other productivist categories, there is more here than meets the eye. Perhaps the first to contemplate the broad social significance of incorporation was Karl Marx. Prescient as usual, he suggested that the corporation may mark the dawn of a new capitalist regime. The capitalist stock companies as well as the cooperative factories, he wrote, may be considered as forms of transition from the capitalist mode of production to the associated one. Marx 1909, Volume 3, 521. Yet, in his opinion, this transition was driven by the imperative of efficiency. The corporation helped concentrate the means of production and in so doing enabled capitalists to further increase productivity and hasten accumulation. The liberal view is different, but not by much. According to mainstream economics, the corporation is the most effective way for society, not just its capitalists, to reap the benefits of large-scale production. The following pronouncement by Samuelson Incorporated is typical. Large-scale production is technically efficient, and a large corporation is an advantageous way for investors to pool the irreducible risks of business life. Without limited liability and the corporation, a market economy simply could not reap the benefit that comes when large supplies of capital need to be attracted to efficient-sized corporations. Samuelson, Nordhaus, and McCallum 1988, 453. From a Vebelnian standpoint, though, this productivist logic makes no sense. The corporation is a business institution, not an industrial unit, and so the reason for its emergence and continuous success must go beyond economies of scale and scope. First, although incorporation certainly reduces risk, as we have argued in Chapter 11 and will show further in Chapter 13, risk reduction has more to do with power than with efficiency. In fact, the focus on power was there from the very start. The purpose of the proto-corporations that first emerged in Italy of the 10th century was to bypass or at least mitigate feudal sabotage and the dangers of piracy. These early investment brotherhoods had two basic structures, one maritime, the other landed. The maritime organization, known as the Commenda, was a short-lived joint venture between an investor, commendator, and an operator. Its whole terminology connotes power. The voyage itself was called taxidion, meaning a military expedition. The task of the leader was called prosedere, meaning to engage in struggle, and the investments were called iactere, meaning rolling the dice. The comparable landed organization was the compania, meaning sharing of bread. In contrast to the one-time commenda, here the investment was locked for a number of years and ostensibly was less risky. But many compania owners, such as the Peruzzis of Florence, were pulled into the lucrative business of princely war finance, a highly unproductive enterprise whose business consequences often proved far more disastrous than the hazards of the sea. Piron 1937, 122-23, Lopez 1967, 141 to 42, 295 to 98. The second difficulty with the common rationale is that large-scale production is a sound business practice only if it serves to raise profits, yet contrary to popular conviction one does not necessarily imply the other. Since the 1890s, the modern corporation has outgrown its largest industrial unit, suggesting that economies of scale are no longer the paramount determinant of business size, if they ever were. Schurer 1975, 334 to 36. Edwards 1979, 217 to 18. A typical modern firm now owns numerous, in some cases hundreds of industrial establishments, often in unrelated industries. And while the corporation continues to grow in size, its industrial units do not. 26 The fact that industrial size is not a necessity for business success has been demonstrated forcefully with the growing significance of outsourcing. Many of today's corporate giants have successfully reinstated the putting out system of the Industrial Revolution, with the typical result being rising profit coupled with falling payroll. The rise of the corporation of course is related to the emergence of large-scale industry, but causality may well run opposite to what mainstream economics argues. The corporation emerged not to enable large-scale industry, but rather to prevent it from becoming excessively productive. In the case of the United States, this rationale is illustrated by the two principal processes charted in Figure 12.3. Between 1790 and the Civil War, population growth averaged 3% annually. With the conquering of the western frontier, this rate fell to 2.2% between the Civil War and the turn of the 20th century, and further down to 1.6% between the turn of the century and the onset of the Great Depression. The second significant development occurring at the same time was a rapid acceleration in, officially measured, labor productivity. In manufacturing, the growth of output per employee rose from less than 0.5% in the 1860s to over 3% by the turn of the century. 27. Figure 12.3, the productivity threat. Asterisk measured labor productivity in manufacturing, based on the Fricke index spliced with the FRB index and divided by the number of manufacturing production workers. The average productivity growth during the 1910s was 0%. Source: U.S. Department of Commerce. The crucial intersection of these two opposing trends occurred during the last decade of the 19th century. Until then, with population expanding faster than productivity, the main concern for individual firms was how to satisfy soaring demand. Sales could therefore grow at maximum potential without threatening markups and profitability. This was the golden age of free competition. But then things began to change. After the Civil War, the state of the industrial arts benefited from improved transportation and communication, an unprecedented increase in the use of new raw materials, the development and assimilation of numerous innovations, new production techniques and growing product diversity. The net result was a marked acceleration in the growth of productive capacity. Given that this process coincided with slowing population growth, the threat was that sooner or later the industrial system would become inordinately productive, as Veblen would have put it. If the earlier pattern of competitive production were to continue, industry would tend to generate much more output than could be profitably sold, bringing pricing down and business enterprise to a halt. It was at this point that the modern business corporation as we know it came into its own. Until then, business combination largely took the form of pools and trusts whose primary purpose was to constrain aggregate output to what the traffic could bear at profitable prices. Yet as Olson, 1965, 1982, convincingly argues, collaboration is usually difficult and often impossible in large groups, and an excessive number of firms was indeed a primary reason for the relative fragility of these early combinations. Cochrane and Miller 1961, 140-46, Chandler 1977, 317-18. There was a pressing need to reduce the number of firms, and the most effective method was merger. Mergers, however, were not only structural transformations, but also financial transactions. They involved buying and selling capital, which in turn meant that firms had to have a pecuniary value. In short, capital itself had to be made vendible. The developments that followed were quick and swift. During the 1890s, the United States saw the widespread incorporation of business firms, the rapid growth of stock and bond markets, and the expanding use of credit as a form of ownership. It was during that period that the separation of business from industry was finally completed. Firms were turned into corporations and investors into absentee owners of discounted future earnings. From then on, the predicament of excess capacity remained a more or less permanent feature of U.S. capitalism. As Figure 12.3 shows, official productivity growth continued to run ahead of population growth. Industrial limitation therefore remained a business necessity, carried out by progressive corporate centralization and the relentless restructuring of broader power institutions. Productive wealth and corporate finance. Equity versus debt. With the corporation seen as a means of limiting industrial activity for business gain, accumulation can no longer be understood in terms of the underlying productive apparatus of the firm. We have already seen the temporal dimension of this rupture. As a forward-looking entity, capital accumulates upfront, that is, before the profit is earned and usually before any material equipment is created. But the rupture persists even without the timing issue. Simply put, rising capacity brings more industrial production, but then too much industrial production is bad for business and disastrous for accumulation. This twisted link between accumulation and production becomes evident from a closer examination of equity and debt. For the archaic captain of industry, capital meant equity, debt did not provide the direct control necessary to run industry. For the modern captain of solvency, however, the difference is no longer clear-cut. As an absentee owner, the contemporary investor views both equity and debt as undifferentiated, self-expanding claims on the asset side of the balance sheet, universal capitals qualified only by their risk/reward profiles. Although entries on the liabilities side of the balance sheet do not stand against specific entries on the assets side, it is generally accepted that equity capitalizes mostly the corporation's immaterial assets, whereas debt discounts mainly its material assets. The conventional accounting creed is that both assets are valuable because of their productivity. The former represents the company's unique knowledge, client loyalty, and other aspects of its supposed industrial superiority, the latter denotes its undifferentiated plant and equipment. We shall now see that these accounting conventions hold little water, even on their own terms. Immaterial assets. Consider first the immaterial assets. The popular conception is that these represent the unique productivity of the firm's own industrial apparatus. But do they? Take inventions and innovations. Both are deemed productive, though given the hologramic nature of knowledge, it isn't easy to sort out how much of this productivity originates in the firm that owns them. 28. Think of a Microsoft software package. This package, essentially a coded set of ideas, could not have been developed without similar codes having been written by others, or indeed without computer languages, the microchip, semiconductivity, binary logic, mathematical functions, or human language for that matter. Such knowledge owes its existence to society at large. Much of it was invented for its own sake, often with no immediate applications, and all of it is available free of charge. In this sense, most of Microsoft's inventions and innovations are not really Microsoft's, and this delinking means that the productivity of these innovations, whatever it may be, isn't Microsoft's either, and therefore cannot account for its immaterial assets. In fact, had Microsoft followed the productivity doctrine of distribution to the letter, paying royalties on the use of such knowledge, it would probably have no immaterial assets whatsoever and an infinitely large debt. In practice, though, none of this matters. The real issue is not whether Microsoft's knowledge originates inside or outside the company, but whether that knowledge, whatever its source, can be protected. Note that on its books, Microsoft, like any other corporation, capitalizes not the invention itself, but the patent or copyright that defends it. And by now the reason shouldn't be surprising: unless the innovation is protected, everyone can use it, and what everyone can use nobody can profit from. Conclusion: a corporation, no matter how innovative it claims to be, can only capitalize the protection of knowledge, never the knowledge itself. Point 29. Moving from legally sanctioned intellectual property rights to unsanctioned items, the alleged productivity of immaterial assets becomes even more dubious. Unsanctioned items are commonly classified under goodwill. The accounting meaning of goodwill, though, is quite different from its original connotation of customer loyalty based on intimate knowledge in a small community. On the company books, goodwill is usually used, or abused, as a catch-all term for the unsanctioned power to strategically limit industry for differential business gains. A good case in point is corporate merger, a business transaction that has the occult ability to make the whole grow bigger than its parts. When two companies amalgamate, their post-merger capitalization almost always exceeds their separate pre-merger capitalizations put together. Some attribute this miracle to productive synergy. When fused, the two companies supposedly complement and boost each other's efficiency. As we shall see in Chapter 15, though, this explanation is very thin on evidence. Worse still, it is largely irrelevant for the common practice of conglomerate amalgamation, and it is totally undermined by the widespread practice of post-merger downsizing to shed excess capacity. The real cause is very different. In the final analysis, what makes the combined capitalization greater than the sum of its parts is the additional social power generated by the merger, the power to increase differential earnings, raise differential hype and reduce differential uncertainty. Of course, the power underpinnings of this added value cannot be admitted in public. So, instead, the extra capitalization is minted on the balance sheet as fresh goodwill. In conclusion, equity accumulation capitalizes not differential productivity but differential power. In this sense, any institutional arrangement leading to higher profit expectations and lower risk perceptions, be it favorable political rearrangements, the creation of new consumer wants, the reorganization of collusion, or the weakening of competitors, will sooner or later lead to higher equity values backed by new goodwill. Material assets. But then what about debt? Is it not true that, unlike equity, debt is commonly backed by a material apparatus whose productive essence can hardly be denied? And doesn't this fact suggest that capital income, at least partly, is a function of productivity? The answer, again, is negative. Plant and equipment are productive in the hologrammic context of industry at large. And it is only because of that broader context that the ownership of machines yields the ability to threaten industry and the right to appropriate part of society's income. Only under these circumstances can machines be capitalized. To illustrate, consider a tanker vessel. Its ability to transfer crude petroleum changes very gradually and predictably over time. By contrast, its dollar value as a capital good tends to vary dramatically with the price of oil. This latter price is affected by very broad social circumstances, including the relative cohesion of OPEC and the large petroleum companies, Middle East wars, the ups and downs of global production, and changes in energy efficiency. When these circumstances change, so does the price of oil. When the price of oil goes up or down, a greater or smaller share of global income goes to the vessel's owner, and as the profit from the vessel fluctuates, so does the vessel's capitalized value, and yet this entire sequence occurs without there being any perceptible change in the vessel's productivity. 30. This example is by no means unique. The very same principle applies to aircraft, factories, office space, and every other piece of capital equipment on Earth. Their capitalized value depends not on their intrinsic productivity, but on the general political, institutional, and business circumstances within which they operate. Now, on the company books, physical assets are recorded not at current market value, but at cost. This is what accountants call book value. Consciously or not, there is an attempt here to separate the portion attributable to social power from the so-called true value of the asset as measured by its historical cost. As it turns out, though, even this presumably objective convention is unable to expunge power from prices. The reason is that, at any point in time, the very cost of producing plant and equipment is already a manifestation of systemic conflict and struggle. Consider again our example of tanker vessels. If ownership of such tankers confers large profits, some of these will likely be appropriated by the companies producing them, as well as by their workers, depending on their own bargaining position. The acquiring shipping line will record the book value of the vessel as an undifferentiated quantum, a cost item stripped of any power consideration. But this cost already reflects a redistributional power struggle that enabled the shipyard to up the price of the newly launched vessel to begin with. Moreover, even in the unlikely absence of differential earning capacity, the cost of producing tangible equipment already embodies the normal rate of return and therefore the average limitation of industry by business. To sum up, the distinction between stocks and bonds is rooted in power considerations, not industrial circumstances. Both forms of capital rest on power, though the nature of power is different in each case. Most generally, equity capitalizes the firm's differential ability to restrict industry for its own benefit, whereas debt capitalizes the average ability of all owners to limit industry at large. The maturity of capitalism. The power distinction between debt and equity can also be viewed by contrasting their respective returns and the industrial limitations from which they derive. Interest on debt represents average sabotage, while profit on equity denotes differential sabotage. From this viewpoint, long-term swings in the ratio of interest to profit can be interpreted as a proxy for the maturity of capitalism. Our notion of maturity here refers loosely to the strength and solidity of existing power institutions, and this strength and solidity, we argue, is intimately linked to the nature of earning expectations and their associated forms of capitalization. Frankel, 1980, sees the basic difference between equity and debt as a question of trust. The former represents an expected return, the latter a promise of return. But then, under business enterprise, the degree of trust among owners depends on the normalization of their power. 31. For this reason, we can expect that as capitalism matures and industrial control increasingly petrifies into accepted institutions, perceptions of risk decline, trust rises, and debt becomes an increasingly acceptable form of accumulation. Conversely, when changing circumstances work to loosen the previous grip of existing conventions and understandings, and in that sense invigorate capitalism, debt becomes relatively more difficult to issue and the more risky equity investment again is used as the primary vehicle of capitalization. Seen in this light, the maturity of capitalism does not develop linearly, and in fact has no preset direction. It may increase as well as decrease, depending on the trajectory of its power institutions, organizations, and processes. Following this logic, we expect the maturity of capitalism, approximated by the ratio of interest to profit, to be positively correlated with the extent of industrial sabotage. And, indeed, as illustrated in Figure 12.4, this correlation seems to exist in the United States. Since the 1930s, our index of maturity has been closely correlated with the unemployment rate, a readily available, albeit imperfect and partial, proxy for industrial limitation. Figure 12.4, Business Trust and Industrial Sabotage in the United States. Note, series are expressed as 5-year moving averages. The ratio of net interest to corporate profit compares the already smoothed series. Source, U.S. Department of Commerce through Global Insight, Series Codes, RUC for the rate of unemployment, INT-NATAMISC for net interest and miscellaneous payments, ZBCON for pre-tax corporate profit with capital consumption allowance and inventory valuation adjustment. At first sight, the relationship may seem intuitive and not particularly significant. After all, economic fluctuations affect profit more than interest, so when unemployment rises so should the ratio of interest to profit. However, this triviality holds only in the short term. In the longer haul, interest payments are much more flexible, so there is no technical reason for the interest to profit ratio to correlate positively with unemployment. Note that Figure 12.4 smooths the two series as 5-year moving averages. In this light, the fact that their long-term gyrations are so similar is highly significant. The 1930s and 1940s were marked by great turbulence. As the figure indicates, during the Great Depression business control over industry had become excessive, while later, with the war-induced boom, it became too loose. See also figure 12.2. The 1950 to 1980 period was much more stable. Business slowly regained control over industry, boosting confidence in the regular flow of capital income and trust among lenders and borrowers. The consequence was a gradual rise in unemployment on the one hand and a shift from profit to fixed income on the other. Since the mid-1980s, however, the trend seems to have reversed. The increasing globalization of business enterprise and the progressive opening of the U.S. political economy have put existing business institutions under duress and transformed the very way in which business controls industry. And as the promise of return weakened relative to the mere expectation of return, unemployment fell together with the maturity ratio of interest to capital income. Fractions of capital. The institution of absentee ownership and the notion that profit and accumulation derive from business limitations on industry suggest that all capital is intrinsically unproductive. This view contrasts sharply with Marx's fraction taxonomy, a logic that differentiates productive from unproductive capitals. According to Marx, capital accumulates through a circulation scheme. In this scheme, financial capital, money M, turns into commercial capital, commodities C, to be made into industrial capital, work in progress, or productive capital P, producing more industrial capital, P, converted again into commercial capital, more commodities C, and finally into financial capital, more money M. Although the circulation of capital is a single process, during the 19th century each stage appeared to be dominated by a different group, or fraction of the capitalist class. The conversion of MM was dominated by the financial fraction, CC by the commercial fraction and PP by the industrial fraction. As we have seen, the industrial fraction was deemed productive, it was considered the engine of accumulation, the site where value was determined and surplus value created. The financial and commercial fractions, by contrast, were seen as unproductive, deriving their profit through an intra-capitalist redistributional struggle. During the 1970s and 1980s, many structural Marxists labored to map the political economy of these fractions, a tradition that has since resurfaced in the fashionable study of financialization. 32 In our view, though, this framework is inadequate for understanding the contemporary capitalist regime. The problem is straightforward. Even if Marx's notion of capital were problem-free and even if profit had everything to do with productive surplus and nothing to do with sabotage, the fractions of capital could still not be identified. Severing accumulation from circulation. The first, analytical, difficulty concerns the link between Marxian circulation and the reality of accumulation. Conceptually, circulation happens on the assets side of the balance sheet, while accumulation occurs on the liabilities side. Since Marx counted all commodities in the same backward-looking unit of abstract labor, it was only logical for him to consider the two processes as mirror images. The firm advances the items on the assets side, money, raw materials, semi-finished goods, proprietary knowledge, and the depreciated portion of its machinery and structures. These items get augmented by surplus value. And as the surplus value gets plowed back, the book value of the debt and shareholders' equity on the liabilities side expands by the same amount as the items on the assets side. Circulation and accumulation grow and, occasionally, contract in tandem. But what seemed sensible to Marx has become irrelevant in the new order of capitalist power. Accounting book value is backward-looking and therefore extraneous. In the calculus of power, what matters is the corporation's forward-looking capitalization on the bond and stock markets. This capitalization is a symbolic valuation and therefore cannot be circulated, by definition. Moreover, calculated as the risk-adjusted discounted value of expected future earnings, it bears little relation, and, as we have seen in Chapter 10, often a negative relation, to the cost of the circulated assets. And here lies the problem. The fractions of capital are anchored in the conceptual identity of circulation and accumulation. But with forward-looking accumulation having been severed from backward-looking circulation, production no longer bears directly on capital. And with capital out of the productive loop, the definition of the different fractions loses its meaning. Where have all the fractions gone? The second difficulty is empirical and historical. The vendibility of capital enables even relatively small corporations to operate in many different areas, and this diversification makes it impossible to decide which fraction they belong to even if the definition of the fractions themselves was crystal clear. For example, how are we to classify conglomerates such as General Electric, Daimler Chrysler, or Philip Morris? These firms operate in hundreds of different sectors across the entire business spectrum, from financial intermediation, through raw materials, to trade, manufacturing, entertainment, advertising and distribution. So what should we call them? Although these examples are admittedly extreme, corporate diversification has become so widespread that the problem is now very general. And that is merely the beginning. The difficulty is not only that diversified firms produce and sell many different products, but also that there is no objective method to determine what part of their profit comes from which line of production. In addition to being unable to measure productivity so as to pin down the ultimate source of profit, we are faced here with the intractable maze of non-arm's length transactions and transfer pricing between different branches of the same firm. For example, if GE Capital subsidizes GE's jet engine division by supplying it with cheap credit, the result is to lower profit in the former and raise it in the latter, and all of that without there being any change in production or sales. 33. And the problem only grows as we aggregate. In the national accounts, manufacturing profits denote the earnings not of manufacturing establishments, but of so-called manufacturing firms. Unlike the former, which often produce a well-defined set of commodities, the latter are a hybrid. They comprise firms whose largest single line of business, measured in terms of sales, is manufacturing. But given that manufacturing represents only part and sometimes a fairly small part of the firm's overall sales, the result is that the bulk of manufacturing profit may very well come from activities other than manufacturing. 34. These considerations suggest that the fraction view cannot be treated as a universal feature of capitalism. It may have been a useful rough classification during the pre-diversification phase, particularly for purposes of political alliances, etc. But it has dubious theoretical value and little empirical relevance in an era of hypercapitalization, absentee ownership, and conglomeration. Toward fractions of power. These difficulties have led some orthodox Marxists to throw in the fractions towel, at least for the time being. Thus Duminil and Levy admit that large non-financial corporations engage in financial activities and that extensive diversification means that the term finance can now be used to denote capitalist owners in general, as opposed to their managers. Yet, unwilling to give up Marx's scheme, they prefer to see these as problems to be solved. In our opinion, they say, the analysis of the various fractions of the ruling classes, and the related institutions, still needs to be completed. 2005, 21-22. We do not share this optimism. The difficulties here are not soluble, at least not within the framework of conventional economics, whether Marxist or neoclassical. The deadlock was candidly acknowledged by Paul Sweezy in his assessment of monopoly capital, 1966, a deservingly famous book that he wrote together with Paul Barron 25 years earlier. His observations are worth quoting at some length because they show both the problem and why economics cannot solve it. Why did monopoly capital fail to anticipate the changes in the structure and functioning of the system that have taken place in the last 25 years? Basically, I think the answer is that its conceptualization of the capital accumulation process is one-sided and incomplete. In the established tradition of both mainstream and Marxian economics, we treated capital accumulation as being essentially a matter of adding to the stock of existing capital goods. But in reality this is only one aspect of the process. Accumulation is also a matter of adding to the stock of financial assets. The two aspects are of course interrelated, but the nature of this interrelation is problematic to say the least. The traditional way of handling the problem has been in effect to assume it away, for example, buying stocks and bonds, two of the simpler forms of financial assets, is assumed to be merely an indirect way of buying real capital goods. This is hardly ever true, and it can be totally misleading. This is not the place to try to point the way to a more satisfactory conceptualization of the capital accumulation process. It is at best an extremely complicated and difficult problem, and I am frank to say that I have no clues to its solution. But I can say with some confidence that achieving a better understanding of the monopoly capitalist society of today will be possible only on the basis of a more adequate theory of capital accumulation, with special emphasis on the interaction of its real and financial aspects, than we now possess. Sweezy 1991, emphasis added. The stumbling block sits right at the end of the paragraph, the interaction between the real and financial aspects. Sweezy recognized that the problem lies in the very concept of capital, yet he could not solve it precisely because he continued to bifurcate it into real and financial aspects. And that shouldn't surprise us. Whatever happens, writes Hegel, 1821, 11, every individual is a child of his time, so philosophy too is its own time apprehended in thoughts. It is just as absurd to fancy that a philosophy can transcend its contemporary world as it is to fancy that an individual can overleap his own age, jump over roads. Sweezy and his monthly review group had pushed the frontier of Marxist research for much of the post-war period, but by the 1990s their ammunition ran out. They recognized the all-imposing reality of finance, but their bifurcated world could not properly accommodate it. In reality, there is no bifurcation. All capital is finance, and only finance. And every type of capital, including that which is formally associated with industry, is inherently unproductive. From a power perspective, the very classification of capitals along lines of industrial activity, even in the absence of diversification and forward-looking capitalization, is misconceived. Production is always a socio-hologramic activity, carried through the integrated realm of industry. The business corporation, by contrast, is a differential legal construct. Being a legal entity, General Motors does not, and indeed cannot, produce cars. It merely controls the production of cars. But then so do firms such as Mitsubishi Trading and Deutsche Bank. Through different forms of power, each of these corporations controls key aspects of the production of cars, and that control in turn enables them to command undifferentiated parts of the total societal profit. The way to classify firms, therefore, is not on the narrow basis of production, but along broader lines of power, of which production is merely one aspect. Unless noted otherwise, we use profit loosely to denote capital income in general, right arrow curving left. One of the earliest and most highly imaginative extensions of the hologramic model into understanding both consciousness and the cosmos is Itzhak Bentoff stalking the wild pendulum, 1977. The pond metaphor is taken from his book Right Arrow Curving Left. In physics, the innovator was David Bohm, Bohm 1980, Bohm and Pete 1987, Hilly and Pete 1987. In neuropsychology it was Karl Pribram, 1971, Right arrow curving left. This was also the view of the early Marxists. According to Engels, the origin of the family, private property, and the state, 1884, classes and the hierarchic state both evolved from private property, which in turn originated in the appropriation of women by men, right arrow curving left. Early evidence of such shifts is found throughout the many debates over slavery and the parceling of family estates in the Book of Numbers, right arrow curving left. As John Locke put it in the 17th century, the natural liberty of man is to be free from any superior power on earth, to have only the law of nature for his rule. The measure of property, nature has well set, by the extent of men's labor, and the conveniency of life, 1690, 22, 324 and 36, 334, Original emphases, right arrow curving left. For a literary reflection of this fusion, see for instance The Silent Men, a short story in Camus' Exile and the Kingdom, 1958, right arrow curving left. This statement refers not to measured increases in utility or abstract labor, but to the unprecedented social transformations, massive technical change and neck-breaking pace of energy conversion that came with the capitalist epoch right arrow curving left. It is worth noting that this adoption merely keeps the capitalist running on empty, since perfect competition allows no profits beyond the marginal productivity of capital right arrow curving left. Of course, business circumstances change, and when in the 2000s global warming and peak oil emerged as lucrative profit opportunities, GM suddenly rediscovered its zeal for electric propulsion and quickly reinvented what it had previously shredded, read 2008, right arrow curving left. The difference is fundamental. Conventional capacity measures consider what is feasible under the existing social order of business enterprise and production for profit, and usually estimate normal utilization to be in the 70 to 90% range. Alternative conjectures based on a material/technological limit, however, are likely to suggest far lower capacity utilization. Veblen, for one, estimated this utilization to fall short of 25%, or, Veblen 1919, 81, a figure not much different from later estimates reported in Blair, 1972, 474, and Foster, 1986, ch. 5. Interestingly, though not surprisingly, U.S. military contractors, engaged in the most destructive form of business enterprise, sometimes operate at as little as 10% of their capacity while earning superior rates of return, U.S. Congress 1991, 38, right arrow curving left. A glimpse into what such a free run might look like is offered by the recent experience of Japan. The underlying problem facing many Japanese companies, writes the Financial Times, is that they have misallocated capital over a long period. Instead of regarding it as a scarce resource to be used as efficiently as possible, they have pursued engineering excellence. Japanese production lines are often models of automated efficiency, but less attention has been paid to whether the goods on them should be produced at all. Many companies have poured cash into projects that will never generate a return above the cost of capital, Abrahams and Harney 1999, right arrow curving left. Business limitations on the direction of industry are much more difficult to delineate and shall not be examined here right arrow curving left. This hypothetical possibility was contemplated with great horror more than a century ago by the Spectator of London. In discussing workers' cooperatives, the newspaper concluded, they showed that associations of workmen could manage shops, mills, and all forms of industry with success, and they immensely improved the conditions of the men, but they did not leave a clear place for the masters. May 26, 1866, quoted in Margolin 1974, 73, emphasis added, right arrow curving left. In their empirical work, many radical political economists consider as capitalist all non-labor income including profit, interest, proprietor's income, and rent. We find this encompassing perspective deeply misleading for two reasons. The first is technical. Many proprietors work for a living, while a significant proportion of rent is imputed to owners' occupied dwellings. As a result, it is never quite clear what part of these incomes is capitalist. The second and perhaps more important reason is that the bulk of profits and interest is earned by large capitalist organizations, while most proprietors' income and rent is earned by individual owners. The former exercise enormous power, while the latter have little or none right arrow curving left. A similar nonlinear pattern emerges if we substitute the official rate of economic growth for the rate of unemployment, on an inverted scale. However, given our mistrust of real measurements, we forego this illustration right arrow curving left. For critical reviews of the pricing debate, see Blair, 1972, Part 4, Lee, 1984, Nitzan, 1990, and Lee and Irvin Lessman, 1992, right arrow curving left. It is very doubtful if there are any successful business ventures within the range of the modern industries from which the monopoly element is wholly absent. They are, at any rate, few and not of great magnitude. And the endeavor of all such enterprises that look to a permanent continuance of their business is to establish as much of a monopoly as may be. Veblen 1904, 54. Right arrow curving left. For up-to-date surveys of the evidence, see Blinder et al. 1998, and Fabiani et al. 2006. Right arrow curving left. For instance, a firm that wants to achieve an average 20% return on an investment of $1 billion needs to earn an average of $200 million in profit. If the normal volume is 100 million units and the normal unit cost is $20, the firm needs to add a 10% markup and set its unit price at $22. With these assumptions, keeping the price fixed while letting sales fluctuate with demand will yield the target rate of return over the longer term. Right arrow curving left. The precise definition was a bit more involved, but that should not detract us here. Right arrow curving left. Our account of the origin of interest in this subsection draws on the work of Michael Hudson, 1992, 2000A, 2004. Right arrow curving left. A proper, coin-denominated monetary system appeared much later, in Lydia of the 7th century BCE. The term money is even more recent, coming from the Roman temple of Juno Moneta, where silver and gold coins were minted during the Punic Wars. Right arrow curving left. It seems that many poor farmers are still unable to internalize the neoclassical entrepreneurial spirit. In India, small peasants, squeezed between high input prices and low output prices, continue to borrow simply to make ends meet. Just like their Sumerian predecessors, they do not invest their loans properly. And since that makes them unable to meet their interest payments, many thousands end up killing themselves every year. Mehta and Rajavoloshan 2006. Right arrow curving left. This subjugation is illustrated by the fact that, since the 1980s, the fund rate set by the U.S. Federal Reserve Board and the 3-month rate on government T-bills have both followed rather than led the market-determined yield on long-term bonds. Right arrow curving left. According to the statistics of U.S. Business Program, SUSB, the size of establishments, defined as production locations, does not differ much between super-large firms, with over 10,000 employees, and medium-sized ones, with 100 to 999 employees. In 2005, both groups had an average establishment size of 52 employees. The real difference was in the number of establishments. In that year, a typical large firm owned an average of 658 establishments, whereas its medium-sized counterpart had only 4.6. U.S. Department of Commerce. Bureau of the Census. Right arrow curving left. The precise productivity growth figures are dubious for the reasons outlined in Chapter 8, but the quantum technological leaps that underlay them were very real. Right arrow curving left. For the sake of simplicity, we treat here the firm and its employees as synonymous. Insofar as they are not, the origin of knowledge becomes even fuzzier. Right arrow curving left. Much like in Bud Skolberg's classic tale of modern America, What Makes Sammy Run? 1941, the success of many techno-entrepreneurs often owes more to their ruthless power than creative acumen. Their common strategy is known as fast following, being the first to spot new ideas created by others, to wrestle them away from their creators and to quickly turn them into the fast follower's own property. Bill Gates' MS-DOS operating system, for instance, is surprisingly similar to a previous system named QDOS, a system written by one Tim Peterson, to whom Gates paid $50,000 so that he would give up any future claims to it. Likewise, the idea for Gates' Windows system was reputably taken, this time gratis, from Stephen Jobs of Apple, who tried in vain to block it in court, after himself having borrowed it, along with the computer mouse, from developers at Xerox. Even Jim Clark, the legendary Silicon Valley innovator, owes almost his entire fortune to simple, back-of-the-envelope ideas. The idea to use the Mosaic browser developed by Marc Andreessen as a basis for Netscape, and the idea to use the Internet as a basis for Healthian's integration of the U.S. healthcare industry. The actual development and implementation of both ideas were done entirely by others. According to Michael Lewis, 2017, many of Silicon Valley's greatest innovations, including its so-called new things, are rarely earth-shattering or even novel. Rather, they are notions poised to be taken seriously in the marketplace, ideas that have been worked out almost entirely, and are only a tiny push away from general acceptance, that is, a tiny push away from being legally packaged so that others cannot use them unless they pay right arrow curving left. The list of assets affected by oil prices can easily be extended. The efficiency of oil traders, for instance, does not change much faster than that of sea vessels. Their human capital, though, measured by their sign-on fees, fluctuates, as if by magic, with the price of oil and the Baltic Dirty Tanker Index, Morrison 2006. Similarly, for the governments of oil-producing countries, their oil drilling expertise changes only gradually, while the value of their sovereign wealth funds swells and contracts with the ups and downs of petroleum prices. Farrell and Lund 2008. Right arrow curving left. It is perhaps worth noting here that the terms commitment and trust have rather violent origins. The anarchy of private warfare during the early period of medieval feudalism left little public space and eliminated any semblance of personal security. This context gave rise to armed gangs of ingenue in obsequio free men under the protection and at the service of a military chieftain. The armed retainers of the Frankish king were initially known as comitatus and later as trustus. Ganshof 1964, 3-5. Right arrow curving left. Recent contributions to the financialization literature include Williams et al. 2000, Froud, Yohel and Williams, 2002, Krippner, 2005, and Epstein, 2005. Right arrow curving left. We write subsidizes and cheap with inverted commas since there is no objective benchmark to gauge what is cheap and what is subsidized. Right arrow curving left. The insurmountable difficulties of matching business profits with specific lines of industrial activity are alluded to in various methodology papers which, unfortunately, few students of fractions bother to read. See for example, U.S. Department of Commerce. Bureau of Economic Analysis 1985, 14, 2001, M21, M22. Right arrow curving left. 13. The capitalist mode of power. Every soul and every object have their own purpose, but all ultimately aim at one, the conquest of the world. For Genghis Khan. Chingai's Aitmatov, the day lasts more than 100 years. I don't separate myself from the state. I have no other interests. Oleg Deripaska, owner of Rusal and at one point Russia's richest man. We now broaden the discussion of capital as power. In the previous chapter, we argued that capitalization discounts the power of capitalists to strategically limit social creativity and well-being. Capitalists inflict business dissonance on industrial resonance and leverage the consequence in the form of differential profitability. But power is not merely the means of business. It is also its most fundamental aim. To articulate this argument, we begin the chapter by tracing the origin of mechanization to the ancient power civilizations of the river deltas, where the first giant machine was invented. This early machine, though, was not material, but social. It was made not of physical components, but of human beings. And its ultimate purpose was not production, but the exertion of power for the sake of power. Capital, we argue, is a modern incarnation of this mega-machine, a mechanized social structure driven by power for its own sake. From this viewpoint, the architecture of capitalism is better understood not as a mode of production, but as a mode of power. The mode of power of a society, we argue, constitutes the state of that society. The second part of the chapter explores this proposition. It examines the feudal mode of power, traces the process through which it gave way to a capitalist mode of power, and examines how the logic of capital has gradually penetrated, altered, and eventually become the state of capital. A final note before we begin: as in Chapter 12, here too we translate and negate existing concepts and introduce new ones, here too we develop the argument at length, and here too we suggest that the reader suspend judgment till the end. Material and symbolic drives. One of the most comprehensive attempts to understand the interaction between technology and power was offered by Lewis Mumford, 1934, 1961, and primarily 1967, 1970. Mumford challenged the conventional emphasis on the material nature of technology, focusing instead on its symbolic aspects. Techniques, he argued, were integral to man's higher culture. In his opinion, the final aim of technology was the shaping of society rather than nature. Indeed, the most complex machines were not tangible but social. Thus, whereas Veblen emphasized the progressive separation between the positive aspects of material technology and the negative features of social power, Mumford, who was greatly influenced by Veblen, suggested a different dichotomy between democratic and authoritarian technologies. Democratic technology centered on human progress, authoritarian technology focused on human control. Rather than following Veblen's notion of power as a fetter on technology, Mumford began by viewing power itself as a form of technology. The invisible technology. In contrast to the conventional creed, Mumford emphasized the symbolic aspects of early human development. Limited by the materialist bias of their profession, he argued, archaeologists understandably judge human progress on the basis of physical objects. Man the maker, however, was a fairly late arrival, and the creation of physical artifacts were preceded by other, less visible but equally important mental activities. Moreover, the subsequent growth of material production has done little to diminish the primacy of symbolic drives. According to Mumford, perhaps the most important human technology invisible to archaeology until the invention of writing is language. The material technology of Paleolithic and Neolithic societies, and in some sense even of our own age, remains infinitely inferior to the complexity, flexibility, uniformity, efficiency, and growth of their spoken languages. It is unclear how long language took to develop, but according to Mumford little of what followed could have been achieved without the prior construction of this wholly symbolic technology. Furthermore, it is highly unlikely that the development of language was driven by the everyday imperatives of survival. The hunting pack was dependent on short commands and had little use for the subtlety of language common even among the most archaic tribes still living today. According to Mumford, the principal drive was self-discovery. Mumford argued that the latent function of language, much like the earlier appearance of ritual and taboo and the subsequent evolution of science and material technology, was to control, for better or worse, man's own mental and emotional energies. In many ancient cultures, words were considered the most potent force. God is commonly believed to have created the world with his words, a feat of power that humans have since striven to emulate. Both in goal and structure, language was a precursor for all later technological developments. The two archetypes. From this premise, Mumford differentiated between two qualitatively distinct technologies, one associated with the democratic outlook of Neolithic culture, the other with the power bias of civilized society. In his opinion, their distinct paths stem from a different reaction to death. Neolithic technology takes the biological route, seeking to enhance life while accepting the inevitability of death. Power technology, by contrast, uses mechanical force and violence in the vain hope of achieving immortality. This qualitative distinction, of course, cannot be applied easily to actual societies, certainly not with any precision. Most social formations contain elements of both technologies, and few if any conform closely to either ideal type. But the distinction is nonetheless useful as a general myth, a basic framework for understanding the dual underpinnings of social organizations. Neolithic culture. Neolithic culture does not see work as alienating labor, but rather as a communal process intertwined with the broader ecological system. Work is often backbreaking, but physical toil is compensated for by companionship, cooperation, song, and rhyme, while aesthetic achievements are valued no less than abundance of yield. Indeed, Many early feats of domestication such as fertilization, the sacrifice of food for future growth, the harnessing of cattle and the use of a plow were probably first practiced as religious rituals. Feminine traits abound from the lunar cycle linking cultivation to menstruation and sexuality, through the primary role of containers, pot, jar, house, village, to the careful cultivation of gardens and the patient rearing of children. Festivities, ceremonies, and rituals revolve around the family, neighbors and community. Eating, drinking and sexual activity occupy a central place. There is no lifetime division of labor. Knowledge is rarely monopolized, and most types of work can be performed by all members of the community. Systemic gender inequality is uncommon. There are no social classes, and authority stems from age. Violence is limited and dictatorial power rarely tolerated. 1. Neolithic culture established the merit of morality, self-discipline, cooperation and social order. It had shown the value of public goods and forethought. Most importantly, over time it has proven to be the most resilient form of social organization, always outlasting the far more energetic yet brittle power civilization. These aspects of Neolithic culture, Mumford argued, did not disappear with the archaic village. As a form of social technology, they persist within modern society, sometimes visibly as in villages, communal organizations, and even business companies, and at other times invisibly as resistance to the dictates of mechanical civilization. Mumford also identified some significant shortcomings in Neolithic culture. The exclusive nature of small associations restricts human interaction, the horizons are limited, and pettiness and suspicion prevent broader cooperation. And, indeed, after its initial burst of discoveries and inventions, Neolithic innovation died down and stagnation set in. Conservatism made Neolithic settlements vulnerable to external invasions, and when horse-mounted tribes, equipped with metals and weapons, moved in, many Neolithic communities succumbed and withered. Power civilization. Against this backdrop of a peaceful if limited form of democratic organization rose the specter of power civilization under the authoritarian rule of divine kingship. The first of these social amalgamations evolved in the great river deltas from Egypt and Mesopotamia to the Indus Valley and China. According to Mumford, the unifying hallmark of these amalgamations was absolute power. The need for such power was partly rooted in material circumstances. Physical surplus and the consequent amassment of material wealth for the first time had created the possibility of total loss. The population was large and growing, segmented by an increasing division of labor and ever more interdependent. Under these conditions, flooding, drought and later total war could easily have spelled catastrophe, if not complete annihilation. Whereas Neolithic culture could flexibly respond to the first two and rarely face the third, in the urban amalgamates of the deltas these threats had to be counteracted resolutely and ruthlessly. And given the large scale of activity, such a response could be achieved only through the sanction of absolute authority. But as Mumford argued, material considerations tell only part of the story, the other and perhaps more important part is symbolic. The rise of power civilization was accompanied by the appearance of the sky gods. Neolithic earth gods, attuned to the microbiological cycle of fertility and operating on a human scale, were no longer sufficient for the task at hand. For the kings, risk of disaster made failure increasingly unacceptable, thus amplifying the ever-present fear of death. Neolithic culture, humbled by its limited potential, had to accept mortality, but kings were no longer bound by Neolithic horizons. Control over growing resources and larger populations suggested to them, admittedly with some justification, that the skies were the limit. Expanding insight into writing, mathematics, and astronomy gave their task cosmic proportions. But as Josephus Flavius wisely observed, the union of what is divine and what is mortal is disagreeable, Kessler 1952, 237. So as earthly rationality grew hand in hand with supernatural irrationality, the king, dazzled by both his achievements and fears, was driven toward the ultimate feat of becoming an immortal sun god himself. Power civilization appeared after rising agricultural yield for the first time had enabled a systematic generation of food surpluses. According to Mumford, it was probably at that point that hunting chiefs, who had earlier entertained symbiotic relationships with Neolithic settlements, first discovered the promise of forceful redistribution. Weapons, which had previously been used primarily against animals, were now increasingly applied against people, and total war became a permanent institutional feature. Neolithic excavations offer little or no evidence of fortification or armament. The first fortifications are associated with urban centers, while heaps of cracked skulls, early evidence of organized murder, do not appear until kingship. Neolithic art did not glorify warriors and leaders. It left us no wall paintings of massacres and prisoners. It never built tombs in which lesser mortals were sacrificed for the afterlife of rulers. These aesthetic manifestations emerged only when humanity embarked on its civilized power trip to control nature and, most importantly, people. Point 2. The mega-machine. According to Mumford, the first power machine was social. In attempting to emulate the perfect cosmic order so as to annul their own mortality, kings turned to design, assemble, and operate a human mega-machine. Absolute control of this mega-machine served as evidence of supernatural power, and the machine's most fantastic output, megalomaniacal graves, were supposed to open the gate to immortality. The mega-machine of the early kingships typically comprised three principal components: a labor machine of peasant conscripts to erect public works, a military machine to impose internal discipline and engage in external war, and a bureaucratic machine to keep the accounts. Control was in the hands of a tight caste comprising the royal court and the high priesthood, the former maintaining a monopoly over physical force, the latter over knowledge and ideology. Division of labor and advanced specialization. Egyptian mining expeditions, for instance, had up to 50 different job descriptions. Strict regimentation, uncompromising discipline, and tough punishment turned the workers, soldiers and officials of these organizations into mere mechanical components. Initiative was all but forbidden and flexibility disallowed. Taken as whole, these organizations formed a combination of resistant parts, each specialized in function, operating under human control, to utilize energy and to perform work. In short, they fulfilled all the requirements of Franz Ruliaz's classic definition of a machine, Mumford 1967, 191. The fusion of rational insight and highly irrational aspirations resulted in a massive explosion of what political economists now call productivity. Seen from a material standpoint, the technological achievements of the early mega-machine, particularly the construction of the pyramids, remained unparalleled until our own epoch. But according to Mumford, the more significant contribution was the construction of the human mega-machine itself. It was here that the three basic principles of mechanization, complex coordination, dehumanization, and remote control were first applied. In other words, the original object of mechanization was society itself. And in due course, just as the cosmic worldview was a necessary prerequisite for the adoption of universal weights, coins, the calendar and the clockwork, the human mega-machine became the ultimate model for subsequent non-human mechanization. The mega-machine enabled human beings, for the first time, to transcend some of their own biological limitations. The principles of universality, order, and predictability opened the door to a continuous expansion of knowledge. Urban amalgamations assembled by the first mega-machines opened new horizons for human interaction, triggering occasional flurries of creativity difficult to achieve in small and disjoint Neolithic settlements. But the unleashing of such positive forces was neither the intended purpose nor the most important consequence of the mega-machine. According to Mumford, the ultimate goal of human organization on a large scale was and remains negative, exerting social power for its own sake. The use of brute force is more than a means of exacting obedience, it is the very manifestation of a power civilization. Human sacrifice, although predating kingship, became a central preoccupation of civilized societies, slowly becoming institutionalized, perhaps unconsciously, in the form of war. In its extreme incarnation, argued Mumford, Kingship was a man-eating device, and the cannibalistic lust of earlier kings has repeatedly resurfaced in subsequent appearances of social mega-machines, 1967, 184. Even today, monetized property, capital, and the death penalty, capital punishment, remain linked to the same root, caput. To sum up, Mumford put the power orientation of the mega-machine model in sharp contrast to the democratic features of Neolithic society. With the mega-machine, Neolithic dispersion was replaced by power concentration, ecological production by mechanization, lack of specialization by a lifelong division of labor, limited local violence by the institutionalization of total war, cooperation by exploitation, forced labor and slavery, and egalitarianism by a class structure. The mega-machine resurrected capital. Eventually, the early mega-machines of the Great Deltas crumbled under their own weight. For all their external might, they were internally vulnerable. Dehumanization and obedience stifled initiative, while preoccupation with power and death were bound to undermine legitimacy. And when the myth of the machine died, that is, when the power structure no longer fulfilled the pharaoh's promise of life, prosperity, and wealth, the social pyramid was liable to falter. But according to Mumford, the myth of the machine, much like Neolithic culture before it, has outlived its first historical incarnation, and in the 16th century centralized power once more emerged to control human consciousness. Nothing seemed to escape this renewed preoccupation with organized power. The most significant sign was the resurrection of the sky gods and the growing assimilation of Galileo's mechanical world picture. Every social innovation from Venetian music and French diplomacy to Newtonian physics and Hobbesian politics was marked by mechanical rationalism. And indeed, within only a few centuries, mechanization had once again taken command, so much so that in 1933 the entrance to the World's Fair at Chicago could proudly boast, "Science explores, technology executes, man conforms." This announcement, together with the title of the fair, "The Century of Progress," attests to the extent to which the myth of the machine has been restored. Mumford, 1970, 213. Extending Mumford, we argue that the new mega-machine has become much more powerful than the old, though for reasons that Mumford himself did not explore. In his analysis, Mumford focused mainly on the newly resurrected institution of kingship and its successor, the sovereign state. But lurking within the cocoon of the state and soon emerging to define the very meaning of the state was a new and very specific logic that Mumford largely ignored, the nomos of capital. In our view, capital fulfills all the characteristics of a mega-machine. Based on the universal ritual of capitalization and a fundamental belief in the normal rate of return, capital is a symbolic crystallization of power exercised over large-scale human organizations, typically by a small group of large absentee owners intertwined with key government officials. The underlying driving force of large-scale capitalist organizations is not fundamentally different from that which propelled the rulers of earlier power regimes. They all seek to control nature and, ultimately, human beings. But the structures of these power regimes, their architectures, institutions, and processes are fundamentally different. These differences, we argue, make the capitalist megamachine more potent than any of its real or imagined predecessors, more than Genghis Khan's rolling war machine, more than Orwell's party state, perhaps even more than Huxley's human reproduction line. There are several key reasons for this greatly enhanced power. Universality. Although capital appears fractured by complex production chains and fragmented ownership stakes, in fact it is highly universal. The power symbols of earlier megamachines were largely culture-specific, relying on the physical display of public works, armies, sacrifice, flags and emblems. Capital, by contrast, is reduced to one symbol, capitalization. By the early 21st century, this symbol has been effectively abstracted down to electronic flickers, computer bits and bytes that make people the world over march to the invisible command of capital. Cohesion. The unifying belief in the normal rate of return as the ultimate yardstick for social action is all-embracing. It penetrates government, business, mass communication, and culture, gradually taking over their very articulation and development. By providing a common language, this belief helps unite the various elites into a cohesive, if not seamless, ruling class of absentee owners, making opposition all the more difficult. Expandability. Unlike the power of kings and sovereign governments, capital power is vendible. And the fact that capital can be bought and sold means that the power it represents can be expanded on an ever-increasing scale. For the first time in history, it seems that the sky is the limit. As Mr. Collins, the oil magnate in Travan's The White Rose, puts it, "There isn't any land anywhere in the world that I can't get if I want it, even if it's on Jupiter I get it as sure as death." Travan 1929, 34. Intensity. The focus on profit enables capitalists to deepen as well as broaden their power. The ancient megamachine was a relatively well-defined organization. Power was exercised mostly over the organization itself, and in that sense was organization augmenting. To have more of it required a bigger organization. The capitalist megamachine is a much broader construct. It consists not of the corporation per se, but of the entire scope of capitalistic reproduction. As we elaborate in the final part of the book, control over this totality is proportionate to the various capitalized profit shares. A capitalist group can increase this share directly by expanding its own corporate organization, but it can also do so indirectly, by raising its profit per unit of organization so as to become leaner and meaner. Absorptiveness. Any process of power that systematically affects the expected level and pattern of profit is quickly capitalized. Non-systematic effects usually get classified as better to ignore extraordinary items. The discounters are constantly on the lookout, scanning the power landscape. They look to see whether education increases the relative wages of women, whether environmental policies raise the effective penalty for polluters, whether the use of military force alters the price of raw materials, whether television makes workers easier to predict, whether religious missions pacify indigenous populations, whether economic policy redistributes income, whether elections alter taxation, and so on, all with the aim of assessing the impact of these processes on profitability. Any regular effect on profit is instantly discounted into present value, and the power process this effect emanates from henceforth becomes part of capital. Flexibility. By virtue of its universality, cohesion, expandability, intensity, and absorptiveness, capital has become the most flexible power structure in history. Contrary to earlier megamachines that depended mainly on punishment, oppression, violence, and terror, capital relies also, and often far more so, on reward. This ability to use both carrot and stick makes capital suppler and therefore more resilient than either kingship or sovereign government. And even when this richer menu of power occasionally fails, giving rise to losses and bankruptcy, large-scale capitalist organizations are usually able to resurrect themselves through merger, restructuring, and the securitization of debt. Indeed, this flexibility is what makes capital accumulation possible in the first place. This last point can hardly be overstated. If orthodox economics were right and capital was indeed a physical amalgamation of machines or production lines, its immobility and rigidity would have made accumulation impossible. By contrast, if we treat capital as a human megamachine, a structure of social control, capitalization and recapitalization become possible as business organizations adapt to and change reality. Literally, capital can be accumulated only because it is not a physical entity. To sum up, the myth of the megamachine enables us to think of capital not as a material, productive apparatus, but as a symbolic architecture of social power. Operating through the price system, this architecture quantifies and reduces qualitatively diverse power processes into the universal language of capitalization, and by so doing absorbs them into the process of accumulation. Very little remains out of reach. Power that can be priced is power that can be capitalized. Yet it is precisely this encompassing feature that makes the capitalist megamachine difficult to reconcile with existing theories of society. For if capital tends to absorb and internalize other forms of organized power, how can we differentiate it and, indeed, Should we differentiate it from bureaucratic organization in general and the state in particular? Consequent to these ambiguities, the historical ascent of the capitalist megamachine has been grossly misunderstood, often to the point of putting the whole process on its head. The first misunderstanding concerns the separation of accumulation from organization within the corporation. The second, broader misunderstanding involves the relationship between corporations and capital on the one hand and governments and state on the other. We deal briefly with the former and then turn to the latter. Owners and technocrats. Begin with the inner compass of the corporate unit. As we saw in Chapter 4, the Weberians latched onto social mechanization as evidence that capital, an entity that they erroneously equated with machines and productive artifacts, was actually on the decline, and that class analysis therefore had become irrelevant if not totally misleading. For John Kenneth Galbraith, 1967-1983, a famous voice of this school, mechanization spelled the ascent of a new social strata, the technostructure. Following the conventional creed, his starting assumption was that property applies only to capital goods as distinct from organizations. The capitalist proprietors still own the physical productive apparatus, but not the organization and management of knowledge. And since in his view production has grown more dependent on the latter relative to the former, it follows that property owners must have lost their primacy to corporate technocrats and government regulators. Galbraith himself provided no evidence that this transformation had indeed occurred, although, following the modern corporation and private property by Burley and Means, 1932, and the managerial revolution by Burnham, 1941, he was not alone in inferring that ownership was becoming increasingly separate from control. Despite their popularity, though, the separation thesis and the consequent belief that capital was on the decline were founded on pretty shaky grounds. As Maurice Zeitlin, 1974, convincingly showed, the direct evidence, including in Burley and Means's own study, was dubious from the very start. The separation of ownership from control was never much more than a pseudo-fact. Neither the earlier data nor those furnished by subsequent attempts, he argued, showed that such separation had actually taken place, a claim that has since been corroborated by numerous writers. 3 Other, less hostile critiques, like those of Barron and Sweezy, 1966, and more recently Screpanti, 1999, accepted that ownership was increasingly separate from day-to-day control. But in their view, this separation only subjugated executives to the rigid dictates of accumulation, turning the corporation into an even more effective profit machine. 4. This last point is certainly confirmed by the evidence. As we shall see later in the chapter, when the European bourgeoisie took the lead from the declining feudal nobility, its ascent was manifested through a marked redistribution from landed income to pecuniary return on investment. If capitalists were indeed losing ground to the technostructure as Galbraith and others have argued, we would expect to see a similar redistribution, this time from profit and interest to the salaries of technocrats and professionals. And yet this redistribution never happened. Indeed, judging by the facts, capital seems to have grown stronger, not weaker. Figure 13.1 pertains to the United States, for which there are systematic historical data going back to the late 1920s. The series in the chart shows the income share of capitalists, measured by the proportion of pre-tax profit and interest in national income. The historical picture painted here is unambiguous. First, we can see that the income share of capitalists has trended upward, from an average of 12% in the 1930s to 16% recently. 5. The chart shows that the volatility of the income share, indicated by the narrowing distance between the upper and lower dotted lines, has declined. Given that capitalization is boosted by higher earnings and lower risk, the combination of these two processes attests to the extent to which the mega-machine of capital has strengthened its grip over society. 6. Figure 13.1, Capital's share of income in the United States. Source, U.S. Department of Commerce through Global Insight, Series Codes, ZBCON for pre-tax corporate profit, INTNATAMISC for interest, YN for national income. Evidently, then, knowledge of production techniques is not a prerequisite for exacting obedience. In the final analysis, it is not the engineers and bureaucrats, but the capitalists who are in the driver's seat. The ultimate drive of their corporate organizations is not continuity, security, or sales growth as the managerialists would have us believe, but accumulation. And whether the capitalists are absent or present, the logic of their mega-machine seems to enforce this accumulation on society with increasing mechanical exactitude. State and capital. Still, even with this evidence, students of capital have remained uncertain about how to link it to power. The main reason is simple enough. As Marx pointed out, historically, the regime of capital emerged together with the nation-state. Yet, as we have seen earlier in the book, theoretically, this joint emergence was fractured from the very start. The conventional bifurcation of politics and economics associated capital with production, leaving the state, and power more broadly, at the mercy of political scientists. Therefore, it seems that in order to understand capital as power we need not only to debunk the economists, but also to question what the pundits tell us about the state. Now, state theory is wide-ranging and complex, but then it is worth noting that its intricacies are a fairly new phenomenon, and that the excessively complex and indecipherable texts probably owe more to the post-war explosion of research budgets and the mass media than to the inherent difficulty of the subject matter itself. Our purpose here, therefore, is to simplify. Rather than provide yet another scholastic account, we offer an alternative outline of how one may think about the issue. The need for such alternative thinking is evident, if only indirectly, from the growing unease of state theorists themselves. Over the past couple of decades, the very association of states with command and power on the one hand, and markets with production and well-being on the other, has become increasingly difficult to defend. 7 There have been several attempts to fix the problem, including revising the meaning of the two concepts, altering their relative importance and historicizing their co-development. But as the following illustrations suggest, none of these solutions touches the real problem. Metamorphosis. The revisionist method is typified by the writings of leading U.S. realist Robert Gilpin. During the 1970s, when statism was riding high in the halls of academia, Gilpin distinguished state and markets based on their goals. The former, he said, is seeking power, the latter wealth. Gilpin 1975. By the late 1980s, however, when governments no longer seemed omnipotent, he changed his mind. His new position was that state and markets share the dual goal of power and wealth, and that the difference between them is mainly the means they use to achieve this goal. Gilpin 1987. This is a major shift for a leading state theorist to make, so one may wonder what prompted it. One possible answer is that, between the first and second edition of his book, states and markets had gone through a metamorphosis and that Gilpin was only reporting this change. Another plausible explanation is that Gilpin made a mistake in the first edition and corrected it in the second. And then there is the third possibility that Gilpin has changed his mind simply because he doesn't know how to differentiate the two institutions. Reordering. An easier and much more popular solution, particularly among liberals, is to rearrange the order of significance. According to this creed, globalization has reshuffled the power cards, putting markets on top of states. This perspective is forcefully advanced by Susan Strange in her aptly titled book, The Retreat of the State. The argument put forward is that the impersonal forces of world markets, integrated over the post-war period more by private enterprise in finance, industry, and trade than by the cooperative decisions of governments, are now more powerful than the states to whom ultimate political authority over society and economy is supposed to belong. Where states were once the masters of markets, now it is the markets which, on many crucial issues, are the masters over the governments of states. Strange 1996, 4. Of course, reordering cuts both ways, and, indeed, not everyone thinks that the state is in retreat. Weiss, 1998, and Hurst and Thompson, 1999, for example, argue that the belief that states are capitulating in the face of capital mobility and transnational corporations is factually unfounded, if only because, in their opinion, capital mobility is lower now than a century ago and the large corporations are not nearly as transnational as the globalizationists would have us believe. Others, like Helleiner, 1994, claim that globalization and deregulation, insofar as they exist, do not attest to the victory of the market, primarily because, in his view, these processes result from the deliberate, and reversible, decisions of state officials. Contradictory interdependency. Perhaps the most interesting analyses of these questions are offered by Marxists. As we have seen in Chapter 4, Marxists see the state not as separate from, but as embedded in society. Furthermore, given the capitalist nature of this society, the state, almost by necessity, has a pro-capitalist bias. Beyond this point, however, there is significant disagreement. There is dispute over the extent to which state officials are autonomous from the overall logic of accumulation and the pressures exerted by particular interest groups, over whether the state is predatory or developmental, over whether the capital that the state regulates is productive and useful or speculative and wasteful, and, finally, over the degree to which these characteristics are inherent or change over time. Underlying these numerous interpretations, though, the basic bifurcation remains. No matter how much the two entities change and regardless of their many interactions, capital stays anchored in production and the state in power. The former generates surplus through economic exploitation, the latter regulates accumulation through political oppression. One of the more sophisticated attempts to transcend this static duality is offered by the work of Giovanni Arrighi and his co-writers on the joint evolution of state and business from the Venetian city-states till the present. For example, Arrighi 1993, 1994, Arrighi and Silver 1999. Combining the neo-Leninist tradition of Magdoff, 1969, and others with the world system's perspective, Arrighi et al. Suggest that, over the past half-millennium, the emphasis if not locus of power has gradually shifted from organizations bounded by territory, primarily states, to ones defined by virtual command over scarce resources, mainly business entities. The shift itself has been highly dialectical. According to Arrighi, Barr, and Hsieh, there is a basic contradictory interdependency, our term, between the two entities, with business agencies, because of their non-territorial nature, growing ever more dependent on, but also ever more subversive of, the power of the hegemonic state, 1999-98. During the 17th and 18th centuries, the joint stock companies, chartered first by Holland and later by England, were still half governmental, half business organizations, acting simultaneously both as state and as capital. By the 19th century, however, the substitution of British for Dutch hegemony, together with the emerging domination of British manufacturers, established a more efficient division of labor between territorial and resource-based power. The new firms, relieved from the burden of formal government, were now free to exploit their economic prowess. But that relief only made them dependent on state power for protection and expansion. Furthermore, their competitive organization did little to enhance the state power on which they relied, and when larger business amalgamates began to emerge in Germany and the United States, the British-based system was superseded. By the early 20th century, a new, American-based formation of state and business gained dominance, although, according to Arrighi, the contradictory interdependency of this new formation is even more pronounced than that of its predecessors. US-based multinational companies, while relying on American state power to keep the world open for their business, are actively subverting that very power. The global accumulation of these corporations, particularly in the area of financial intermediation and capital flows, have worked to destabilize the post-war economic order created by U.S. hegemony, and by so doing have undermined the very basis of their prosperity. The long history of this contradictory interdependency, Arrighi argues, could be useful in understanding epochal leaps in the underlying nature of both state and business. Initially, a new hegemonic state typically supports and promotes its own business institutions. Eventually, however, the hegemon's power and the monopolistic profit of its companies attract outside contenders and generate internal inequities and strife. In parallel, business concerns seeking to break their spatial barriers increasingly subvert the territorial power on which they rely. Historically, the consequence of these mounting contradictions has been global instability and, eventually, systemic chaos. The resolution of this systemic chaos, at least so far, has always involved the emergence of a new hegemon, although, according to Arrighi, that latter aspect was less important. The more crucial feature of the transition was the emergence of a qualitatively new state, business formation, one that helped resolve the earlier contradictions and that over the past few hundred years worked to shift the focus of power from territoriality to accumulation. The argument is intriguing, and it certainly takes us further than most accounts in trying to understand the historical interaction of state and business. And yet, even here, the duality persists. State and business, although constantly changing through mutual interaction, are still seen as fundamentally distinct, and it is this basic distinction that we need to rethink. In what follows, we argue that capital and state do not stand against or function together with each other. They do not complement or undermine one another. They neither interact nor interplay. And the reason is simple: they are no longer separate. Capital itself has become an emergent form of state, the state of capital. Notions of space. Cosmic space. The troubled relationship between state and capital could be conceived, metaphorically, by thinking about the notion of space. In his foreword to Max Jammer's Concepts of Space, 1954, 11, 15, Albert Einstein contrasts two interpretations of the concept: 1. Space as the container of all material objects, and 2. Space as the positional quality of the world of material objects. The two views are radically different in origin and implications. Point 8. The container concept, associated with Democritus, Plato, Descartes and, eventually, Galileo and Newton, assumes that space exists independently of what it contains, and that space is absolute rather than relative. In other words, that space acts on its contents, as an inertial system, for instance, but the contents do not react back on space. By contrast, the positional concept, traceable to Aristotle and Spinoza and developed by Leibniz and Huygens, interprets space not as independent of the things, but rather as the order of the things. This type of space is defined by the very relations of the entities that make it. The first interpretation sees space itself as inherently empty. In the second interpretation, empty space is an oxymoron. According to Einstein, Newton won the day largely because of the mathematics. His container concept could be described with available Euclidean geometry, while Leibniz's relational concept could not. In due course, though, Newton's perspective has proven inferior, or at least insufficient. The development of electromagnetism and field theory on the one hand, and of non-Euclidean geometry on the other, paved the way for Einstein's notion of a four-dimension space-time, a Leibniz-like framework in which gravity and curvature are two sides of the same thing. In this ontology, to know the relational properties of bodies is to know the shape of their space and vice versa. Social space. The space of mainstream political economy is much like a Newtonian container. Point 9. But unlike in physics, this container is forever partial. In the liberal version, the container is market space. Its particles, the utility maximizing investors, consumers, act and react on one another according to the rules of the market, but they have no bearing on the rules as such. These rules are eternally fixed, making market space independent and absolute. Unfortunately, liberal society also has non-economic entities, organizations, and institutions, the most important of which is the state, or the government. Unlike the individual investor, consumer, these latter entities often are very large, sometimes irrational, and often disobedient of market rules. And since market space is by definition independent and absolute, there is no way to incorporate these non-economic entities into its logic. They remain exogenous. This fact makes market space inherently partial. And since the external units cannot be wished away, even by liberals, the only solution is for market space itself to inflate and deflate in response to their varying pressures. This is why liberals tell us that when politicians intervene the market has to contract, and when the market expands the state must retreat. The realist container is more or less a mirror image of the liberal. Instead of a market space populated by calculating utility seekers, we have state space swarming with equally rational powermongers. 10 Realist actors struggle over power resources and capabilities, and the state is the arena in which they carry out their Hobbesian all-out wars. In some editions the state itself becomes an actor fighting against other states on the global stage or against other social actors in the national arena. But in all versions the space rules are eternally fixed. To be included in this space you have to seek and use power. If you are after something else, say wealth for its own sake, you have to remain in outer space. As we have seen, some writers, such as Gilpin, try to bend the rules by describing states and markets as seekers of power as well as augmenters of wealth. But this solution breaks down on its own implicit assumption, namely, that wealth and power are distinct to begin with. Since the production of utility presupposes the harmonious equilibration of perfectly competitive production and consumption, it follows that wealth can never be created in the Mad Max violence of state space. In the end, the market must remain outside of state space. If the former inflates, the latter must deflate, and vice versa. The Marxist framework is very different from both the liberal and realist. Instead of market space or state space, it articulates production space. And this space, at least in its abstract articulation, is Leibnizian rather than Newtonian. When Marx speaks about a mode of production, he has in mind a totalizing system that determines individual action while simultaneously being shaped and reshaped by that action. This production space is not eternal, but rather historical and dialectical. In the capitalist epoch, the main logic of this space is surplus value and the drive for accumulation. This logic incorporates both the economic processes of production and the political institutions of power and state, and it constantly changes. Energized by its internal relations, the capitalist production space is ever evolving until it eventually crumbles under the weight of its inner contradictions. And yet, when we get to the details, the devil appears and the Leibnizian metaphor breaks down. As we have seen earlier in the book, although Marx was striving for an encompassing explanation, his theory of value and accumulation remained locked in the Newtonian mechanics of productive labor. This narrow emphasis may have seemed sufficient in the mid-19th century. But as the world changed, the concept of productive labor proved too narrow and, ultimately, impossible to accept. Inevitably, Marxists found themselves having to separate production from power, economics from politics and capital from state. The unit and logic of their economic accumulation could no longer be reconciled with the broader power aspects of capitalism. And as the schism widened, the totalizing Leibnizian-like space was fractured. State as a mode of power. In our view, hierarchical social orders are better understood not as modes of production, but as modes of power. Every mode of power, whether based on slavery, feudalism, or capitalization, has its own particular configuration. Each of these configurations obviously depends on production, narrowly understood. But production as such is merely part of the story of power. Beyond providing the material preconditions for social life, its significance for understanding the hierarchical structure of society lies not in its efficiency or inefficiency per se, but in the way that efficiency or inefficiency bears on power. We propose to think of the mode of power of a society as the state of that society. Obviously, this conception of state is very different from conventional definitions. In common parlance, a state is a political entity that exercises sovereignty, backed by force, over a definite territory. 11 This political entity is both, 1. An organization, typically consisting of government organs, the administration, bureaucracy, legal apparatus, and the military/police, and, 2. A set of institutions, legal and habitual, that enable the political entity to exercise its rule. This definition may seem relatively unambiguous when applied to pre-capitalist centralized regimes, where the organizations and institutions of power were usually associated with and commonly fused in a single entity: estate, palace, king, emperor. But with capitalism, this application is no longer straightforward. Capitalism alters the very nature and meaning of power, as a result of which the organs and institutions of power no longer reside in a single entity, let alone a political one. The scholars no longer agree on what these organs and institutions are, and the capitalist state no longer fits into the conventional box. With this glaring exception, the definition ceases to be universal. Our own notion of state as a mode of power is broader and more flexible. First, it transcends the analytical distinction between economics and politics. As noted, this distinction may be valid when viewed from below and at lower levels of abstraction, and in that sense it remains enfolded in our explanation. But it could be very misleading when considered from above and in relation to the overall architecture of power. The latter perspective no longer differentiates between economic power and political power, between exploitation and oppression, or between the power of the market versus the power of the state. Organized power can take different forms, centralized or decentralized. But insofar as the overall structure is hierarchical, it constitutes a single nomos of power. Second, the nomos of power is not fixed. It changes as the social order evolves, and it is occasionally replaced when a new mode of power emerges. In this sense, one cannot speak of the state as an abstract form with an unchanging definition. The state is never an empty Newtonian container. Instead, it is a Leibnizian-like space, an ever-changing, historically specific relational entity that both comprises and is shaped by the bodies that constitute it. In contemporary capitalism, the key organizational bodies of the state are corporations and government organs. These are the concrete incarnations of the capitalist mode of power, and although separate, they are deeply interrelated. First, both bodies are conditioned by the same nomos of capitalized earnings and its associated rituals. Regardless of whether their departments overlap or exist at arm's length, regardless of whether their personnel are separate or share a revolving door, and regardless of whether they cooperate or bicker, they are both part and parcel of the same architecture of mechanized social power. Second, they presuppose each other. There are no capitalist corporations without a capitalist government, and there is no capitalist government without corporate or proto-corporate organizations. And, third, by incessantly seeking to redistribute capitalized earnings, whether at cross purposes or in unison, corporations and governments end up shaping and reshaping the very patterns of power that define capitalism. In the final analysis, there are no profit expectations without state prisons. At the zenith of its capitalist power, 19th century Britain had more political prisoners than Tsarist Russia, just as the United States today boasts the world's largest inmate population. We call this Leibnizian-like space the state of capital. Mumford insightfully saw the modern state as a resurrected megamachine. But this megamachine is historically unique. It is not a state in the abstract, but one that both consists of and is defined by capital as power. The feudal mode of power. The above account, of course, is a stylized abstraction. To understand where the state of capital comes from historically and how it developed its unique features as a modern megamachine, it is useful to take a step back and examine, if only briefly, some of its feudal roots. This type of inquiry, to be certain, is hardly novel. The feudal origins of capitalism have received more than ample theoretical scrutiny, particularly from Marxists. There are even two famous controversies about the issue. The first, the transition debate, launched by Maurice Dobb, 1946, and Paul Sweezy, 1950, concerned the significance of production versus circulation. The second, the so-called Brenner debate, beginning with the work of Robert Brenner, 1977, 1978, and still going, focuses on the relative importance of forces of production as opposed to relations of production. 12. However, the question these debates seek to answer is fundamentally different from our own. Whereas they are concerned with the transition between modes of production, our own interest is the transition between modes of power. Point 13. The feudal state. Understood as a mode of power, the feudal state consisted of a hierarchical network of voluntary military dependencies among free men. Point 14. This decentralized state was born out of the ruins of the Roman Empire. Lack of central authority and fracturing inheritances fostered something akin to a war of all against all and a heightened sense of insecurity. The initial response was the formation of armed gangs based on personal loyalty and mutual protection. This arrangement later bloomed into a full-fledged system of intricate lord-vassal obligations. The key hallmark of the feudal regime was violence. The lords despised work and creativity, which they viewed as infinitely inferior to their life of honor and exploit. The person and possessions of others were a means to an end. They were seen partly as a source of loot, but mostly as the target of differential sabotage. The Bayeux tapestry of the Queen Matilda, that remarkable story in pictures from the end of the 11th century, narrating the 1066 Norman conquest of England, shows us how, after the landing, a big feast was held and blessed by the hegemon, and how the war expedition was launched with the burning of a house. And, indeed, war in the Middle Ages was marked by systemic devastation. Its purpose was not so much to defeat the enemy militarily, as to undermine its economic and social power, by burning and destroying crops, houses, and villages. Le Goff 1965, 29, emphasis added. This inherent violence determined both the form and content of the feudal contract. Ceremonially, the legal bond, nexus iuris, between the lord and the vassal consisted of two acts, a fusion of their persons symbolized by the mixing of hands, immixtio manuis, and an oath of fealty, sacramentum, which indicated that the vassal was giving himself voluntarily, as a free man. Point 15. Substantively, the bond was mostly negative, a sort of mutual insurance policy designed to reduce uncertainty. Each side promised not only to protect the other but more importantly not to harm the other. Point 16. In addition to not attacking his lord, the vassal was obliged to provide a certain quota of military services so that the lord could protect himself as well as attack others. These services took various forms, but gradually they converged on the basic particle of feudal power, the fully equipped knight. In order for vassals to produce, train and supply knights on a permanent basis, they needed access to agricultural land and tillers, organized through the autarchic monoreal system. And so, gradually, the homage between the lord and the vassal came together with the granting of a benefice, usually in the form of a landed fief, or fiefdom, hence the term feudalism. The cost of reproducing a single knight and his accessories was pretty hefty, requiring roughly 150 hectares of land according to some estimates. Based on this ratio, a fair-size fief of account, made up of 200 to 250 agricultural communities, could supply no more than 150 to 200 mounted warriors. These modest numbers had an important implication. They meant that a larger army could be assembled only by networking the separate commitments of many different vassals. Le Goff 1965, 54-55. This networking formed the basis of the feudal state. The arrangement first emerged in the 8th century, when the Carolingian rulers, seeking to consolidate their power and increase obedience, sowed confiscated church lands as well as their allodial territories with royal vassals. The vassals, who in turn wished to reduce their own uncertainty and if possible leverage their power, further parceled their fiefs to subordinate vassals, and so on. The end result was a dense network of mutual military obligations tied to agricultural monoreal production, a standardized pattern of power that later spread throughout much of Europe. It is not difficult to see here the principle that later informed both Hobbes's Leviathan and Locke's social contract, the individual being, vassal or bourgeois, torn between his desire for freedom, independence, and quest for security, to annul his fear of death, finds the compromise in merging himself with a larger mode of power, the feudal network or the sovereign state. During the Middle Ages, Royal power, although often existing de jure, usually was conditional on and subsidiary to feudal obligations. In some places, such as France of the 12th century, power was so diffused that the king, although claiming sovereignty, was no more than a glorified lord whose authority hardly extended beyond his own feudal domain. In other places, such as England after the Norman conquest of the 11th century, power was highly centralized in the hands of the king. But that centralization was still feudal insofar as the entire country was the property of the king and every feudal agreement was supplemented by allegiance to the monarch, a duality that perhaps hastened the development of British capitalism. There was an important novelty in this arrangement. In imperial structures, power could expand in two ways, conquest and marriage. The feudal state introduced a third alternative, voluntary military contract. Of course, because of their larger number, individual feudal lords could not match the power of emperors. But their added ability to cut and paste slices of power in a quasi-amicable way, a precursor for the capitalist buying and selling of vendible corporate shares, made the structure of power more flexible, easier to realign, and perhaps less vulnerable to external blows. 17. The limits of feudal power. Feudal flexibility, though, had three hard limits. First, the feudal bond was personal and deeply religious. Its material aspects were merely instrumental. The primary purpose was the establishment of direct loyalty and mutual obligation between two people. Second, the bond was total. The lord exercised something akin to sovereignty over the very person of the vassal. And third, the contract was permanent. Save for instances in which the no-harm clauses were violated, the feudal link could not be unilaterally terminated. It ended only with the death of one of the sides. Over time, these features started to strain the structure of feudal power. One problem was that the chain of personal commitments was highly unreliable. As a contract between two people, the feudal bond gave the lord direct power over his own vassals, but not over his vassals' vassals. Unlike a capitalist owner who has legal right and effective power over the corporation's entire chain of subsidiaries, the leverage of a feudal lord depended on the goodwill of his vassals, who, when called on for a military operation, might or might not bring along their own subcontractors. In places where the feudal links were complicated, the task of quickly assembling a large army became a real headache. In some cases, the large lords and kings found themselves at a significant disadvantage, for instance, against the easy-to-organize popular militias of the bargs, or relative to the centralized and partly Monetized armies of the English king. Another difficulty was how to prioritize different commitments. The vassals, seeking to leverage their power and security, often allied themselves with more than one lord. These multiple commitments, though, were inherently contradictory. Unlike the capitalist limited liability contract, which has a definite magnitude denominated in dollars and cents, and hence a prorated structure depending on the relative magnitude of the priced pledges, the feudal contract was total. The vassal was obliged to serve his lord completely and without reservation. Those with overlapping obligations could therefore face multiple claims from different lords, each demanding the very same services. As a result, there emerged various systems of rating, some based on the size of the fief, others on the time it was granted, and still others on the relative position of the lord, all designed to somehow reconcile the overlapping obligations. The most serious limit, though, was the non-alienated nature of the fief. The fief was the property of the lord. It was a unit of power granted to the vassal so that he could serve his master personally. But given the personal nature of the service, the transfer was always temporary and was annulled by death. In this sense, any attempt to parcel, transfer, or sell the fief was a direct challenge to the very purpose of the feudal contract. Over time, though, the pressure to alienate the fief mounted, coming initially from vassals who sought to pass it on to their heirs, and subsequently from lords who were both lured by and forced into the new pecuniary logic of the barg. The solution was found in the form of relief, a sort of ransom paid by the heir to the lord for giving up the property. In the beginning the relief was arbitrary. but around the 12th century in France there emerged something like a normal rate, whereby the lord would alienate the fief in return for a sum equal to the property's annual revenue, Ganshof 1964, 136-39. The capitalization of feudal power. The weakening of the feudal mode of power was marked by the colors of capitalism. One important change was the inversion of the feudal contract. Originally, the fief was a means to an end. The vassal made an oath of fealty to the person of the lord, who in return gave him the fief so that he could fulfill that oath. But toward the second part of the Middle Ages, the order had changed, with the fealty and service becoming preconditioned on the granting of the fief. The fief was now increasingly a matter of real estate, and feudal relations gradually shifted from a personal to proprietary footing. A parallel change was the increasing monetization of both sides of the feudal contract. In many cases, the fief itself took the form of a stipend, or fiatum de bursa, whereby the vassal received a payment for his keep rather than a direct allocation of land. The same happened to the services. Although these assumed a variety of forms from the very start, initially the key service was military. However, from the 11th century onward in England and somewhat later on the continent, the significance of military services declined, giving way to pecuniary payments. In England, many of the lower vassals paid their services in scutage, or monetary substitute, while in 14th century Flanders less than 20% of the vassals of the count in the Châtellenie of Bruges were required to perform military services, Ganshof 1964, 90-92. Faubourg, Bourg, bourgeoisie. The power architecture of capitalism was gradually penetrating and transforming the feudal mode of power. The beginning was rather humble. The process started during the 11th and 12th centuries with the twin expansion of the bourgs and the periodic fairs. The original bourg was a feudal fortification, built by serfs for military purposes. By contrast, the fair was an extraterritorial free trade zone. Granted by the prince as a source of royalties, it was exempt from feudal law and was endowed with franchises and liberties available nowhere else. In due course, the periodic fair gave way to the faubourg, a permanent settlement of merchants that was physically attached but socially alien to the bourg. Gradually, the merchants began to fortify their own suburb and in many cases ended up absorbing the old feudal fortification. The logic of the new bourg, commercial, industrial, and above all monetized and capitalized, was every bit different from the one it had swallowed. The dual economy. The capitalist bourg introduced a totally novel mode of power. Its manufacturing sector, having developed as early as the 11th and 12th centuries, had many structural features we now take for granted. One of these was a prototype of the dual economy, a term coined centuries later by Averett 1968 to describe the bifurcated structure of the modern U.S. business sector. On the one hand, there was the small economy, comprising associations of masters, apprentices and hired workers that supplied mainly the local market. On the other hand, there was the big economy of large merchants and producers who controlled the long-term trade. The latter constituted a closely knit oligarchy, and it colluded heavily both inside the bourg and with the oligarchies of other bourgs, with the most conspicuous example of the latter collusion being the Hanseatic League of London. In parallel, there developed in the bourgs a proto-proletariat of unskilled workers, made mostly of propertyless incomers from the countryside, often known as the Blue Nails. The oligarchy treated the workers and artisans with indifference, that is, as long as they remained docile. When they revolted, the first known strikes took place in Flanders during the 13th century. The retaliation, often coordinated within and between the bourgs, was usually swift and violent. In England of the 14th century, more than 400 years before the Speen-Hamland Act, the King and Parliament were already passing decrees and legislation that made labour mandatory and idleness illegal. Piron 1937, 178-91, Lopez 1967, 278-80, Tuckman 1978, 120. In this sense, the capitalist class struggle, from its very inception, was never merely an industrial dispute. It was a broad power conflict embedded in a newly emergent form of state. Private and public. Another important innovation was the bourgeois link between the public and the private. This institutional structure, like many others, developed almost unintentionally. The new dwellers of the Bourg needed to defend and fortify their private warehouses and workshops against the external hazard of the feudal space. The protection itself, though, was inherently public. By fusing the two, the bourgeoisie invented public finance, a concerted effort to advance their coinciding private interests through proportional taxation. The resulting fiscal system was completely antithetical to the feudal logic. First, contrary to feudal taxes that were inherently penal and served the individual lord only, bourgeois taxes were directly linked to the public interest, that is, to the collective interest of capitalists. Second, since the public consisted of the private taxpayers, it made sense to make payment proportionate to the individual's interest, i.e. to his income. Finally, taxation presumed and implied representation, and indeed, in the bourgs of the 11th century there emerged, along with public works, bodies of elected or representative councils, Piron 1937, 178-91. In other words, from the very beginning, private capitalist bodies and capitalist government assumed one another and were symbiotically intertwined. Liberty as differential power. Beyond these innovations, though, the bourgeoisie, at least initially, tended to view its project not as a comprehensive alternative to the feudal state, but rather as an exception to that state. Inside the Bourg there was democracy of the privileged, a close correspondence, if not an identity, between political administration and economic management, both controlled by the moneyed aristocracy. The space outside the Bourg, though, was accepted as a different mode of power. Although this space was generally hostile to the Bourg, the bourgeoisie neither denied nor challenged it. Matters of jurisprudence and religion, as well as the acts of peace and war, were fully accepted as the prerogatives of church, king, and lord. Indeed, the bourgeoisie was usually more than keen on emulating the authority and privilege of the territorial princes by seeking noble status, by giving gifts to the clergy, and by lending money to the duke in need. All in all, the state was viewed as an external moral, legal entity, distinct from and superior to the city, which was merely an economic body. Lopez 1967, 267-68. This was the basic duality that Hegel identified in his Philosophy of Right, 1821, a duality that Marx rightly criticized but could solve only by turning it into an inherent contradiction between political universality and economic alienation. At the beginning of its journey, then, the bourgeoisie merely tried to fit into and advance within the structure of feudal power. Its tactics were simple. The nobility benefited from forceful confiscation through territorial sabotage hazards that the bourgeoisie sought to bypass through exemptions and immunities. 18 These exceptions and immunities, though, were always in the plural. They represented particular liberties and franchises, and therefore advantages held relative to and against others. There was nothing exceptional about this differential quest. The notion of universal liberty was totally foreign to the feudal world. In the Middle Ages, liberty meant sovereignty, and therefore force and authority over others. Only God was totally free. Everyone else, including the king, was a vassal, and therefore partly dominated. Even the term knight, a symbol of power, comes from the German Knecht, meaning subjugated, a connotation that can also be found in the word samurai, servant, and mamluk, slave soldier. All were merely extensions, or arms, of a ruler, hence the term army. For this reason, liberty at that period, whether bourgeois or feudal, could only be understood as a status of power. 1. It denoted negation, it was the right not to pay, not to work, not to obey. 2. It was dynamic and relative, it changed over time in relation to other people. And, 3. It was anchored in sabotage, it marked one's place in the hierarchy of damage, with the right to inflict it on some and the obligation to accept it from others. In this sense, the expansion of bourgeois liberties was synonymous, both conceptually and historically, with the growth of the bourgeoisie's differential power. War and inflation. As the leverage of the bourgeoisie increased, its own mode of power started to penetrate and gradually replace the feudal state. The bourgs were able to wrestle increasing territorial and legal independence from feudal institutions, forcing the church and lords to sign peace accords for prolonged periods. In France during the 11th century, many of the new bourgs were labeled Communia pro pace, or communes for peace, Le Goff 1965-66. Yet much of the headway of the bourgeoisie was achieved directly and indirectly through war. The indirect impact of war was to devastate the nobility, with more than a little help from the bourgeoisie. Changes in the nature of warfare, particularly since the 13th century, undermined the advantages of feudal military subcontracting. Improved fortifications, new and highly lethal arching technologies and the growing efficiency of infantry relative to mounted knights presented feudal armies with serious challenges. Moreover, lacking the accounting and logistical skills of the bourgs, the lords found it difficult to organize, feed and discipline large forces of heterogeneous knights. But the most serious challenge was soaring cost. In the 5 years between the English invasions of 1346 and 1351, the French king witnessed the price of hiring knights and their accessories practically double. Tuckman 1978, compare pages 84 and 128. War had become so expensive that even the richest of kings found it difficult to finance it. Consequently, observed Robert Lopez, fortunate indeed were those kings who succeeded in maintaining the peace. 1967, 333. Underlying the mounting cost of war was a new weapon of mass destruction, inflation. The expansion of the bourgs and their growing consumption of agricultural produce were accompanied by the spread of the monetary standard and the penetration of prices into the feudal heartland. This process marked the beginning of an invisible revolution, a transformation that shifted the emphasis from the bartered knight of the manor to the cash-paid soldier of the bourg, bankrupted the lords and altered the very nature and form of social power. The nobility and clergy, locked into an antiquated system of barter and fixed income, found themselves at the greatest disadvantage. Most did not grasp the pricing mechanism and were utterly clueless about inflation. Abbot Gil Lemusus of Tournai summed the bewilderment in a famous 14th century verse. Money and currency are very strange things. They keep on going up and down and no one knows why. If you want to win, you lose. However hard you try. Quoted in Tuckman 1978, 130. Feudal rents were fixed by custom and habit, but the prices the nobility had to pay particularly for luxuries and weaponry soared. The consequences were devastating. From the 13th century onward, lords were forced into borrowing, then into mortgaging their property, and eventually into releasing their serfs and selling their lands altogether. Pyron 1937, ch. 3, section 2, Le Goff 1965, 167. The monarchs were generally more astute. Some of them understood, instinctively if not theoretically, that money represented a new order of power and that any shock to that order could be leveraged for differential ends. And the brightest of the lot went on to invent various techniques of sabotage to serve their own ends. One of the more sophisticated methods was to threaten debasement and then blackmail those who stood to lose the most from such an act in return for putting it on hold. Lopez 1967, 333. Centuries later, the financiers of the Weimar Republic would use a variant of this technique with their foreign creditors threatening to inflate the currency in order to avoid having to pay war reparations. But the biggest winner was the bourgeoisie. Situated at the epicentre of the price mechanism, it not only set most of the prices but also understood the inflationary mechanism better than everyone else. This strategic position enabled the early bourgeoisie to profit from the process relative to others and to amass huge fortunes. 19 And that was merely the beginning. As we shall see in Part V, the techniques that were developed during that period, perfected and extended by subsequent generations of capitalists, turned inflation into one of the principal axes of the capitalist mode of power. War and credit. By the 14th century, the European social landscape was in the midst of a massive transformation from a feudal to a capitalist mode of power. This transformation entailed many different developments and innovations, but there was one invention that literally encompassed them all: credit. From its very beginning, credit was a matter of organized power. Its inception was intimately connected to war, it emerged as a negation of feudal sabotage, and it eventually developed to engulf and internalize that sabotage and more. Bypassing power, private instruments. As noted, the bourgeoisie sought to negate the territorial barriers of feudal sabotage by seeking direct territorial exemptions, immunities, and liberties. But the most effective means of bypassing feudal power was trans-territorial, the virtual financial instrument. In its attempt to evade feudal violence, the bourgeoisie went on to develop the letter of credit, bill of exchange and maritime insurance, along with the proto-corporate commenda and compania that were already mentioned in Chapter 12. These developments came hand in hand with the growth of urban education, an alternative to the feudal monastery and a precursor of public schooling. By the 13th century, most Italian merchants were literate, knew some mathematics, used bookkeeping, and often spoke foreign languages. Byron 1937, 122-25. This education enabled the bourgeoisie to further improve its credit institutions and organizations, putting the illiterate nobility at an ever-growing disadvantage. Gradually, as the financial instruments diversified and the transactions multiplied, each type became associated with its own benchmark and normal rate of return. Ironically, the most vibrant private market was real estate, the original source of feudal power. The rising merchants were busy buying the dwindling territorial properties of their increasingly indebted enemies, and by so doing further hastened their demise. The institution of the mortgage, originally a bypass of the church opposition to interest, gave rise to an urban market that traded in rents and sold asset-backed securities. The bourgs started raising money by selling perpetuities backed by the real estate collaterals. In the 13th century, Genoa recognized the vendability of such contracts, leading to the creation of the Bank of St. George, a precursor of the modern mortgage bank. Byron 1937, 137-39. Absorbing power, state finance. But the magnitude of private credit paled in comparison to the size of state finance. Wars, whose costs soared in tandem with their material scope and unit price, were the most financially demanding expenses. Changing military technologies, beginning with the Crusades and continuing with the 100 Years' War, made it increasingly necessary to rely on hired armies that needed to be paid in cash. There were two ways to raise the money: taxes and borrowing, but it was their combination that proved the most effective. The first to brave this new form of war finance were the Lombardian city-states. They issued tax-backed bonds, using the proceeds to pay for soldiers and weapons that waged increasingly successful campaigns against barter-backed knights. The territorial princes and kings were initially hostile to this new arrangement. But having witnessed the lethal force of the new pecuniary militias unleashed on their increasingly expensive knights, they found the temptation of fight now pay later difficult to resist. Gradually, they began to borrow the methods and money of the bourgeoisie, with the result being a growing interdependency and eventually a bondage between the territorial sovereign and the exterritorial capitalists. In due course, this alliance would develop into a new mode of power, a social space we now call the capitalist nation-state. Let's examine this process a bit more closely, beginning with taxation. The collection of ad hoc levies and duties was not only unpopular, but also grossly inefficient and extremely time-consuming. Therefore, in the interest of expediency, the kings often took a shortcut, announcing a convenient state of emergency. The monarchy, when it took over the reins of national life, ought to have resurrected a regular income tax system, the fundamental basis of both Roman and modern finance. But the 13th century was not ripe for such radical reform. The king would merely ask his subjects for help in times of crisis. Philip the Fair acted in such a way as to keep a crisis going, almost without interruption, and his successors improved even more on these methods. Lopez 1967, 334. The bourgeoisie was forced to foot a growing part of the bill, but by now it was already too powerful to give something for nothing. In return for taxation it demanded representation, this time on a national scale. Government taxes, though, constituted only one aspect of the New Deal. The other aspect was private credit, and the two got inextricably bound up. Facing the prospect of war, the king, even if fiscally solvent, was often financially illiquid. Taxes could be collected in the future, but the need for cash was immediate. His solution was to turn to haute finance with its easily accessible stash of money. For the financier, the request offered a huge investment opportunity, a royal promise to augment his capital with future taxes. Initially, the arrangement was fraught with peril, and although both sides resorted to it with much enthusiasm and growing frequency, often they got burned. During the 100 Years' War, for example, kind Edward of England financed his invasion of France with an estimated 1 to 1.5 million gold florins borrowed from the Florentine banks of Bardi and Peruzzi and backed by an expected wool tax. The tax revenues, though, proved disappointing, and the two banks, unable to collect their loans, crashed, creating a chain reaction of bankruptcies throughout northern Italy. Tuckman 1978, 81. But time heals, and by the early 19th century war finance had already been perfected into business as usual. A typical illustration follows. During the Napoleonic Wars, an English expeditionary force, headed by the Duke of Wellington, got stuck in Portugal, besieged by a terrible need of funds. Wellington borrowed money from shabby continental banks against massively discounted British government bonds, but the money was like a drop in the bucket. Unpaid soldiers resorted to looting, wounded officers had to sell their clothes to secure medical attention, and with its wallet empty, the army's attempt to have the local population turn against French rule was going nowhere. Wellington was ready to give up the fight, but then, just as all seemed lost, the Rothschilds came to the rescue. Earlier on they had collected many of Wellington's discounted British government bills at a fraction of their book value, and they now cashed them at an enormous profit in London. In addition, they also bought some £800,000 worth of gold at bargain prices from the East India Company bullion that they were more than willing to sell back at fair value to the needy British government. The Rothschilds also took it upon themselves, again for a proper fee, to transfer this money from England to the continent, and they continued to do so for a number of years, funneling as much as £20 million to the British troops. The transfers were even encouraged by the French authorities, who were misled to believe that the money represented private capital flight in expectation of British devaluation. Elon 1996, 166-71. And so, almost seamlessly, war and organized violence, nominally the archenemies of the free market, had been absorbed into capital. On the one hand, the capitalists used inflation to destroy the military power of the nobility, while on the other hand they financed national wars to multiply their capitalization many times over. And war was merely the beginning of this public-private bondage. In due course, capital has been able to internalize not only organized violence, but every systematic aspect of government power. The genesis of capital as power. Let's take stock of some of our claims so far. In chapters 9 to 11, we have seen that, by discounting risk-adjusted expected earnings, capitalization has gradually come to encompass and commodify our social world, creating a unified quantitative architecture of historically unprecedented complexity. Then in chapter 12, we have demonstrated that both the level and pattern of capitalist earnings are a matter of strategic sabotage, and therefore that the capitalization of earnings represents the commodification of power. Finally, in this chapter we argue that the commodified power of capital has increasingly taken over and absorbed other forms of organized power, that over time this takeover and absorption have come to define the mode of power of society, gradually turning capital itself into a state, and that this Leibnizian transformation is not a recent phenomenon, but one that started with the very inception of bourgeois discounting in Italy of the 14th century. The government bond. Symbolically, the earliest manifestation of the state of capital is the government bond. This financial instrument marks the first systematic capitalization of power, namely, the power of government to tax. And since this power is backed by institutionalized force, the government bond represents a share in the organized violence of society. In and of themselves, taxation and the organized violence behind it are of course ancient, dating back to the early use of armies to collect agricultural tribute. 20 Subsequently, taxation was legitimized in custom and law, so that the use of naked force became less necessary. But it was only with the emergence of capitalism that this power was routinely packaged as a financial asset, discounted as vendible bonds on the open market. This capitalization of power marked the beginning of the end of the feudal mode of power. Instead of a rigid structure of multiple personal protections and endless exceptions, there emerged the anonymous and highly flexible capitalist bond of private owners and public governments. For the first time in history, organized power, although still qualitatively multifaceted, assumed a universal quantity. Primitive accumulation? Interestingly, the first to suggest that the state was integral to capital was no other than Karl Marx. Recall that, analytically, Marx emphasized the primacy of production and surplus in the emergence and development of capitalism. However, toward the end of the first volume of Capital, in a section titled Genesis of the Industrial Capitalist, we find a strikingly different interpretation. In contrast to his otherwise bottom-up view, whereby the bourgeois state emerges to give an already developed capitalism its universal form, here he offers a top-down structural explanation, with accumulation seen as emerging from within the state. The genesis of capitalism, Marx writes in this section, is primitive accumulation, and primitive accumulation is largely the working of the state. The different momenta of primitive accumulation distribute themselves now, more or less in chronological order, particularly over Spain, Portugal, Holland, France, and England. In England at end of the 17th century, they arrive at a systematic combination, embracing the colonies, the national debt, the modern mode of taxation, and the protectionist system. These methods depend in part on brute force, e.g. the colonial system. But they all employ the power of the state, the concentrated and organized force of society, to hasten, hothouse fashion, the process of transformation of the feudal mode of production into the capitalist mode, and to shorten the transition. Force is the midwife of every old society pregnant with a new one. It is itself economic power. Marx 1909, Volume 1, 823-24, emphases added. Within this constellation, Marx further identifies the formative role of credit, particularly public debt. National debts, i.e. the alienation of the state whether despotic, constitutional, or republican marked with its stamp the capitalist era. Public credit becomes the credo of capital. Ibid. 827. In fact, according to Marx, the public debt is not only one of the most powerful levers of primitive accumulation, but also the basis of modern finance more broadly, having given rise to joint stock companies, to dealings in negotiable effects of all kinds, and to agiotage, in a word to stock exchange gambling and the modern bankocracy, Ibid. Leaving aside differences in the meaning of state, this view seems similar to our own. The capitalist state, Marx argues, is neither a historical latecomer nor an added complication to an otherwise economic notion of capital. Instead, it is an integral aspect of accumulation, and it was so from the very start. But the similarity is only superficial. Note that Marx's view here relies crucially on the concept of primitive accumulation. This is the mechanism through which state violence and power penetrate the inner workings of accumulation. Primitive accumulation, though, is an exception to the rule. During the normal course of expanded reproduction, whereby real capital expands through the legitimate production and appropriation of surplus value, the state acts on capital only from the outside, as an external regulator. The problem with this distinction is that the two types of accumulation, normal and abnormal, negate and therefore presuppose each other. In order to know what constitutes primitive accumulation, the forceful exception, we first have to know what expanded reproduction is, the sans force rule. Yet, as we have seen, that cannot be done. Since productive labor, abstract labor, and surplus value cannot be identified theoretically or empirically, there is no way to delineate expanded reproduction, and since the boundaries of expanded reproduction are forever unknown, there is no way to know what constitutes primitive accumulation. The two concepts rise and fall together. For this reason, the endless debates from Luxembourg, 1913, to Harvey, 2004, controversies over what constitutes real accumulation, on how to differentiate it from rent-seeking and accumulation by dispossession, and on whether primitive accumulation is necessary merely to kickstart capitalism or in order to sustain it throughout, are much ado about nothing. These questions cannot be settled for the simple reason that accumulation does not have two faces. It has only one, and it is called capitalization. This process, although deeply intertwined with production, is a manifestation of power and only of power. And since we are dealing with power, the capitalist government, Marx's state, is embedded not only in the so-called primitive forms of accumulation, but potentially in every single bit of it. Government capitalized. And so, what began as a tentative and limited penetration of bourgeois principles into the feudal state ended up destroying that state to emerge, several centuries and numerous struggles later, as a full-fledged state of capital. And as capital grew into a state, the interaction between its organizational bodies of corporations and governments multiplied and intensified. Over the past century, the government bond market has become the heart of modern finance. It provides the biggest and most liquid security market, it offers a vehicle for both fiscal and monetary policy, and it reflects, through its benchmark yield, the universal normal rate of return. And that is just the start. Governments are engaged in numerous activities other than taxation, including military spending, subsidies, education, industrial policies, war-making, tariffs, protection of private property, patents and copyrights, propaganda, labor laws, macroeconomic policies and policing, to name a few, and these activities all bear on the differential level and temporal pattern of capitalist income. In fact, it is hard to think of a single aspect of modern government that does not bear on the distribution of income in general and of capitalist income in particular, just as it is difficult to find a single corporation whose differential earnings are not affected by government power. Given that these power features of government all influence differential capitalist earnings and risk, they are discounted, if only implicitly, into corporate stock and bond prices. In other words, a significant proportion of all private property is, in fact, capitalized government power. Of course, the precise magnitude of this impact isn't written in the company books or declared in stock market filings. But it can be illustrated easily with simple thought experiments. Consider Microsoft once more. As we have seen, it doesn't matter whether Microsoft engineers produce its software from scratch or borrow it entirely from others, gratis. The owners of Microsoft can profit differentially from this software only insofar as they can prevent others from using it without pay. And this prevention depends crucially on the existence and enforcement of intellectual property rights, that is, on the extent to which Microsoft can harness the government apparatus to its own end. Now negate this ability and assume that the government no longer protects Microsoft's software. The most likely result is that Microsoft's earnings and capitalization will drop sharply, if not collapse altogether. The magnitude of the drop represents the extent to which Microsoft capitalizes the government. 21. Similarly with so-called financial intermediaries such as Deutsche Bank. The differential earnings of this group depend, among other things, on interest rate differentials and credit volumes, both of which emerge from a complex power interplay of government policy, cooperation, and conflict among the leading financial intermediaries, the relative power of borrowers and the ebb and flow of risk perceptions. The government is deeply discounted at every step of the way, and the extent of its capitalization can be readily if hypothetically assessed by contemplating what would happen if we were to obey the market fundamentalists and eliminate its involvement from any of those steps. Or consider Daimler-Chrysler. The level and pattern of its differential earnings depend on its tacit and open collusion with the other 7 auto titans. They also depend on the highway system provided by governments and the availability of alternative public transportation. They depend on environmental regulation or lack thereof. They depend on the ups and downs in the price of oil and hence on the global political economy of the Middle East. They depend on tax arrangements with various governments and on the use of transfer pricing. They depend on a sophisticated propaganda war that creates wants and shapes desires. They depend on the relative strength of Daimler-Chrysler's labor unions, and so on. Daimler-Chrysler's profits also hinge on its huge credit operations, and therefore on monetary policy, and they depend on the company's military business, and therefore on the global politics of armament budgets and the threat of inter- and intrastate conflict. Where exactly the government role begins and ends in this complex process of capitalization is difficult to tell, but the magnitude of this role would become immediately apparent if we removed or curtailed it. A final example: the oil companies. Over the past 4 decades, the relative profits of these companies have had little to do with variations in the production of oil and almost everything to do with oil's relative price. Point 22. And the relative price of oil in turn has had little to do with supply and demand or abstract labor and everything to do with the global political economy in general and the political economy of the Middle East in particular. So here, too, profit and capitalization are matters of politics at large, which means that oil assets partly capitalize government power. The conclusion then is pretty clear. If capital is a material, economic substance, then the most we can say is that the government does or does not affect its accumulation. But if assets represent capitalized power, then capital must be seen as incorporating government power. In that sense, the government has become part of capital. The state of capital. Now, so far we have dealt with the degree to which the government has been capitalized by corporations. But that is only part of the process through which capital becomes a state. The other part concerns the extent to which the various organs of government have been conditioned, habituated, and shaped by the logic of capital. We flesh out this question with a series of illustrations. Who are the regulators? By the late 2000s, the changing ecology finally made the headline news and environmental friendliness became a prerequisite for making money, so Walmart decided to go green. Given the company's reputation as an indifferent if not predatory giant, this publicized shift towards social responsibility has taken many leftists and environmentalists by surprise. But the move also revealed another aspect that few paid attention to: it illustrated how Walmart has become a de facto regulator. Because of Walmart's sheer size and market share, most of its rivals have no choice but to follow its lead, and the company has found itself setting standards beyond those that regulators require. They have so much market power that they could drive environmental change through 50,000 companies, something that Congress and the Bush administration has refused to do, says Michael Marks of Corporate Ethics International. Bichler 2007. And since Walmart now acts as a government, so to speak, it seems only appropriate that it should also be lobbied. Walmart says it consults with suppliers on standards. But its efforts to set higher environmental goals than those legally required mean that the retailer is attracting the kind of lobbying that would have previously been directed at central government, from both environmentalists and from industry. IBID. This example of private regulation is by no means exceptional. It keeps popping up in many different areas, from the setting of accounting standards and the determination of monetary policy, to military spending and the waging of war, to the commercialization of legal arbitration and the choice of pharmaceutical practices, all instances in which corporations act as regulators of the capitalist environment in which they operate. Sovereign owners. The second example concerns the modus operandi of government finance. Traditionally, capitalist governments treated their foreign reserves as a buffer for securing imports and protecting the currency. Consequently, the extra money was usually parked in liquid foreign government bonds. This situation started to change in the 1980s. Massive shifts in the global distribution of income gave rise to a significant concentration of foreign currency assets, first in the hands of oil-producing countries, and more recently also in the coffers of Asian governments. These piles of cash made the lure of capital too difficult to resist, as a result of which many governments started to invest their holdings through a new institution, the Sovereign Wealth Fund. By 2006, sovereign wealth funds had amassed assets estimated at $2.5 trillion, representing 10% of all institutionally held investments in the world and nearly 1.5% of all global financial assets. The size of these funds has been growing in leaps and bounds, and at current growth rates it is expected to reach $12 trillion in 2015, exceeding the sum total of global reserves by as much as 50%. Farrell et al. 2007, 11, Gen 2007, Farrell et al. 2008, 10. So far, much of the discourse surrounding this growth has focused on its threat to free markets and the national interest, particularly that of the United States, the world's largest importer of capital. The sovereign owners of these funds, the pundits explain, are inherently anti-market, the liberal fear, and potentially hostile, the realist unease, so thwarting this new form of government intervention must be good for both freedom and country. But this logic can easily be turned on its head. By setting up and managing sovereign wealth funds, governments are further integrating, if not locking themselves, into the larger architecture of capitalist power. This submission is succinctly summarized, however unintentionally, by Youssef Al-Otaiba, Director of International Affairs for the Government of Abu Dhabi. The success in generating and wisely applying financial returns for the public good is directly linked to a clear set of principles that has guided Abu Dhabi's investment organizations. Most basic are the focus on maximizing risk-adjusted returns, relative to well-established market indices, taking a long-term view, avoiding leverage, and investing in a well-diversified portfolio across asset classes, geographies, and sectors. Furthermore, the leading investment organization, the Abu Dhabi Investment Authority, ADIA, has operated predominantly as a passive investor, with the overwhelming share of its portfolio consisting of minority stakes in companies that have included no control rights, no board seats, and no involvement in the management or direction of the receiving companies. It is important to be absolutely clear that the Abu Dhabi government has never and will never use its investment organizations or individual investments as a foreign policy tool. Al-Otaiba 2008, emphases added. The last promise in this quote should be taken with a grain of salt. As things stand, there is, still, no means of preventing governments from using their assets in line with their policy goals. But given the increasingly capitalist bent of these new sovereign owners of wealth, it is not clear how their investment and divestment decisions would differ from the business-as-usual policies of ExxonMobil, Bechtel, or Samsung. Whose policy? And since we talk about foreign policy, what should we make of the recent U.S. invasion of Iraq? Was this policy move taken in the national interest, in the name of business, or perhaps both? Conventional opinions on this question vary widely, so perhaps we should briefly reiterate the underlying assumptions. At one extreme we have the realist position, according to which the state, understood as an independent entity represented by its officials, i.e. the government apparatus, seeks to defend the national interest against the interest of other nations. At the other extreme, we have the structural Marxist position that sees the state, in the last instance, as subservient to the logic of accumulation. And on the face of it both views ring true. There is little doubt that George Bush Jr. and his administration believed that they represented the national interest of the United States. But it is also fairly obvious that this same administration, whatever its formal leeway, could not have deviated too much from the underlying dictates of profit and accumulation. And that is precisely the problem. As stated above, the realist and structural Marxist views are mutually consistent. And if they can coexist, how can we tell whether the US government launched the attack on Iraq in order to serve its vital national interests or to protect the capitalist order? Is it possible that the attack was meant to serve both goals, or is one cause more important than the other? Can we even tell them apart? Moreover, is the relative significance of these goals fixed, or does it change over time? Considering the past 50 years, could we say, for example, that the national interest has grown less imposing relative to the logic of accumulation, or has it been the other way around? Perhaps the underlying logics of the national interest and accumulation have both changed. Whose interests? These, undoubtedly, are big questions. To answer them, we have to take the following steps. First, we need to specify clearly the logic of state power and the logic of accumulation, including the categories and units in which they are articulated and observed. Second, we need to identify conflicts between these logics. And third, we need to examine how these conflicts pan out comparatively and historically. Based on such an investigation, we can then choose the logic that gives the most consistent, robust, and predictive picture. Clearly, so far the debate hasn't taken this route. Worse still, it seems that both sides, the realists and the structural Marxists, have preferred to frame their positions in irrefutable terms. Stephen Krasner, an advocate of the realist view, interprets the national interest not as the sum of individual interests, but rather as the overall interest of the nation. In his words, it is not the utility of the community that matters, but the utility for the community as determined by its central decision makers. Krasner 1978, 12, original emphases. In practice, though, the decision makers, read government officials, themselves rarely agree on the matter, so it is up to the researcher Krasner in this case to make the decision for them. And the way this interest is phrased is often so loose that it can be made consistent with virtually any line of action. According to this template, the 2003 US invasion of Iraq was motivated, depending on the theorist, by the quest for raw materials, by the need to spread capitalist ideology, by the desire to tame the barbarians, by the aspiration to thwart Europe and Asia, by the desire to have Bush Jr. re-elected, or simply by a miscalculation, all in the name of the national interest. Go prove otherwise. Unfortunately, structural Marxists do not always fare much better in specifying the logic of accumulation and the interest of capitalists, let alone in assessing the degree to which this logic and interest dominate the state. In the 1960s, the welfare state served the long-term interest of capitalism. In the 1980s, the welfare state's demise better served that same interest. In the 1980s and 1990s, capitalists wanted a new world order of peace. Now they suddenly want empire. In the 1970s and 1980s, the US government tried to serve its own capitalists by conspiring with OPEC to raise oil prices. In the early 2000s, it tried to cater to their global interests by invading the Middle East in order to lower oil prices, and when, in the late 2000s, the price of oil reached the stratosphere, it was obviously in the interest of the oil companies and the speculators. These claims may or may not be true. But their validity can be judged only if we first specify exactly what we mean by the interest of capitalists and the logic of accumulation. Only then can we begin to judge whether government organizations and institutions are autonomous from or subservient to these interests and logic, or perhaps somewhere in between. What is to be done? The final part of the book outlines the power logic of capitalism and the interest of the dominant owners as we see them. In doing so, this part also illustrates some key features of the historical development of capital accumulation. The quantitative patterns it outlines delineate the boundaries of capitalist politics. These boundaries point to the central political processes, broadly defined, that determine the course of accumulation. They also provide a basis for assessing the extent to which government policies have been discounted into capital on the one hand and the degree to which the capitalist megamachine may have become a form of state on the other. Another set of instructions from AD 1020 articulates this negativity in 6 different ways. He who swears fealty to his Lord should always have these 6 words present to his memory: safe and sound, sure, honest, useful, easy, possible. Safe and sound, because he must cause no injury to the body of his Lord. Sure, because he must not injure his Lord by giving up his secrets or his castle, which are the guarantees of his security. Honest, because he must do nothing to injure the rights of justice of his Lord or such other prerogatives as belong to his well-being. Useful, because he must do no wrong to the possessions of his Lord. Easy and possible, because he must not make difficult for his Lord anything which the latter may wish to do, and because he must not make impossible to his Lord that which the Lord might otherwise accomplish. It is only right that the vassal should abstain from injuring his Lord in any of these ways. Quoted in Ganshof 1964, 83, emphases added. Even the positive vow of protection was inherently negative, in that it was directed against everyone else. A French document from the 13th century recommends the following declaration by the vassal. I promise this because you have granted to me and to my heirs such and such a property, as long as we shall remain your vassals, and also because you have promised to defend me and mine against every man. Quoted in Ganshof 1964, 154, emphases added. Part V. Accumulation of power. 14. Differential accumulation and dominant capital. Ad omnia et contra universos hominis, in all matters and against all men. An 11th century count pledging to serve his Lord. Quoted in François-Louis Ganshof's Feudalism. Creorider. Creating order. Historical society is a creorider. At every passing moment, it is both Parmenidean and Heraclitean, a state in process, a construct reconstructed, a form transformed. To have a history is to create order, a verb and a noun whose fusion yields the verb-noun creorider. A creorider can be hierarchical as in dictatorship or tight bureaucracy, horizontal as in direct democracy, or something in between. Its pace of change can be imperceptibly slow as it was in many ancient tyrannies, yielding the impression of complete stability, or it can be so fast as to undermine any semblance of structure, as it often is in capitalism. Its transformative pattern can be continuous or discrete, uniform or erratic, singular or multifaceted. But whatever its particular properties, it is always a paradoxical duality, a dynamic creation of a static order. Democratic creoriders, of which the most notable example is the demos kratia of ancient Athens, are relatively few and far between, so it is difficult to generalize about them. But given that such societies are to some extent free to create their own fate, they can choose to do so rapidly or slowly. A power creorider doesn't have that choice. Power means the ability to impose order, and imposition presupposes resistance from those on whom order is imposed and from others who wish to impose their own. This ever-present tension between force and counter-force makes a power creorider inherently unstable. Slack on one side unleashes pressure from another, a greater force in one direction trumps over a weaker force in the other. And since to overcome resistance is to create a new order, the very presence of power spells a built-in pressure for change. Historically, however, this pressure tended to remain latent. Judged by contemporary standards, most hierarchical regimes seem highly stable, if not entirely static. Although dynamic in potential, the pace of their creorider was usually restricted. It was capped by material limitations and symbolic inhibitions, and it often slowed to a halt by the very success of rulers in eliminating opposition. Regimes with surplus energy usually spent it on conquering and subjugating other societies. In capitalism, these internal limitations are greatly loosened by two unprecedented developments: 1. A permanent revolution of the scientific ideological mindset that enables rapid material and societal transformations, and 2. A relentless process of pecuniary capitalization that translates and reduces these heterogeneous transformations of quality into universal changes in quantity. Mediated through the market, the convergence of these processes enables capitalists to create in ways that no other ruling class has ever been able to. At the most basic level, it allows owners to lever technical change rather than techniques per se as a tool of power. At a higher level, it lets them use the monetary symbols of prices and inflation to restructure power. And at a still higher level, and perhaps most importantly, it permits them to reorganize power directly, by buying and selling vendible ownership claims. In this sense, the capitalist market, with its universalizing price architecture and encompassing discounting, is not a diffusion of power but the very precondition of power. The power role of the market. The power role of the market cannot be overemphasized, particularly since, as we have seen throughout the book, most observers deny it and many invert it altogether. Analytically, the inversion proceeds in three simple steps. It begins by defining the market as a voluntary, self-regulating mechanism. It continues by observing that such a mechanism leaves no room for the imposition of power. And it ends by concluding that power and market must be antithetical, and that they can coexist only insofar as the former manipulates and distorts the latter. An example of this inversion is Fernand Braudel's historical work Civilization and Capitalism, 1985. According to Braudel, capitalism negates the market. In his words, there is a conflict between a self-regulating market economy on the one hand, and an anti-market capitalist zone where social hierarchies manipulate exchange to their advantage on the other. Braudel 1977, 1985, Volume 1, 23-24 and Volume 2, 229-30. A similar sentiment is expressed by Cornelius Castoriadis, when he proclaims that where there is capitalism, there is no market, and where there is a market, there cannot be capitalism. 1990, 227. The root of the error here lies right at the assumptions. Capitalism cannot negate the market because it requires the market. Without a market, there can be no commodification, and without commodification there can be no capitalization, no accumulation, and no capitalism. And the market can fulfill this role precisely because it is never self-regulating, and since it is never self-regulating, there is nothing to manipulate or distort in the first place. Price is not a utilitarian, productive quantity, but a power magnitude, and the market is the very institution through which this power is quantified. Without this market mediation of power, there can be no profit and, again, no capitalization, no accumulation and no capitalism. And there's more. The market doesn't merely enable capitalist power, it totally transforms it. And it achieves this transformation by making the capitalist megamachine modular. The blueprint of this new machine, unlike those of earlier models, is very short. Its essential component is the capitalization/accumulation formula. The formula is special in that it doesn't specify what the megamachine should look like. Instead, it stipulates a generative order, a fractal-like algorithm that allows capitalists to reconstruct and reshape their megamachine in innumerable ways. The algorithm itself changes so slowly that it seems practically fixed. The basic principle of capitalization hasn't changed much over the past half-millennium. But the historical paths and outcomes generated by this algorithm are very much open-ended, and it is this latter flexibility that makes the capitalist creator so dynamic. Point 1. How to measure accumulation. So let's start with capitalization, the raw material of accumulation. In its immediate appearance, capitalization is just a number, a quantity of dollars and cents. On its own, it can tell us nothing about power, or about anything else for that matter. To gain a meaning, it has to be benchmarked. Real benchmarking? Begin with the yardsticks that don't stick. For most economists, the proper benchmark is a price index. Capitalization, like any other economic entity, acquires its meaning when expressed in real terms, and the way to determine this real quantity is to divide the dollar value of capitalization by its unit price. Accumulation is the rate of growth of this real ratio. Unfortunately, this procedure won't do. As we have seen, the category of real capital is logically impossible and empirically embarrassing. Capitalization has no material units to measure its quantity, and without a quantity there is no definite unit to price. The replacement cost of material artifacts owned by capitalists usually is a small fraction of their overall capitalization, and, as a coup de grace, over time this replacement cost tends to oscillate inversely with capitalization. A popular escape route is to express real capital in terms of purchasing power. According to this logic, capitalists, like all economic agents, are in hot pursuit of hedonic pleasure. All they seek is consumption, immediate or postponed, and the more the better. In this context, the thing to do is benchmark capitalization not against its own elusive price, but relative to the price of consumer goods and services. Simply divide the dollar value of capitalization by the CPI and you are done. But this procedure isn't simple either. Capitalists, of course, are concerned with consumption. Yet, beyond a certain level of riches, their consumption is only marginally affected by their accumulation. And if only a fraction of their fortune is earmarked for consumption, what should the remainder be benchmarked against? Moreover, it turns out that even the proportion that does get consumed is rather tricky to deflate. In liberal tracts, consumption is a hedonic affair between a person and the things he or she consumes. Not so for accumulation-induced consumption. Here, the relationship is interpersonal. The goal is not to achieve hedonic pleasure but to establish differential status, to demonstrate that the consumer can afford something that others cannot. Veblen, 1899b, labeled this demonstration conspicuous consumption. This new emphasis puts the standard deflating method on its head. From a naive utilitarian perspective, higher prices for consumer goods and services imply lower purchasing power and therefore a smaller real capital. For the conspicuous consumer, though, the exact opposite is true. Since higher prices bestow a higher differential status, they generate greater utility and therefore imply a larger real capital. Point 2. It's all relative. The most important critique against real measures of accumulation, however, is that they are irrelevant. Accumulation is not about physical objects or the hedonic pleasure of capitalists. It is about power. And power is not absolute, it is relative. It acquires its meaning only when gauged against other powers. Of course, the differential nature of power isn't unique to capitalism. Chieftains gauged their power against other chieftains, lords against other lords, kings against other kings, nation-states against other nation-states. But in these regimes, the comparisons were largely subjective and their social significance more limited. It is only in capitalism, where power is translated into the universal units of capitalization, that the differential nature of power really takes center stage. Neoclassicists never tire of preaching the imperative of maximizing profit and wealth, although they rarely if ever explain what maximization means in practice or how it can be achieved in reality. Point 3. And not that they should bother, for in the real world of capital, the reference points are all relative. A capitalist investing in Canadian 10-year bonds typically tries to beat the Scotia-McLeod 10-year benchmark. An owner of emerging market equities tries to beat the IFC benchmark. Investors in global commodities try to beat the Reuters/Jefferies CRB Commodity Index. Owners of large U.S. corporations try to beat the S&P 500, and so on. Every investment is stacked against its own group benchmark and, in the abstract, against the global benchmark. Modern-day capitalists have long abandoned the vain search for Archimedean absolutes for readily observable Newtonian differentials. And it is not as if they had a choice. The shifting sands of the capitalist Creo rider leave no absolute yardstick standing. All that is solid melts into air, all that is holy is profaned, observed Marx and Engels, 1848, 63. The only thing capitalists can relate to are the broad processes themselves. They assess their own performance by comparing it to the performance of others. In this quest, the goal is not to maximize but to exceed, not to meet but to beat. To achieve a 5% profit growth during recession is success, to gain 15% or when others make 30% is failure. Even declining profit can be a triumph, provided it outperforms the average. In normal circumstances, the results issued by Mr. Dimon's firm J.P. Morgan Chase on Thursday having in second quarter profits, and a bleak outlook for the rest of the year would have sent investors rushing for the exit. But, with fund managers' nerves jangled by almost a year of credit-related bad news, J.P. Morgan's ability to outperform most of its rivals and beat analysts' predictions was enough to send its shares 11% or higher at midday in New York. Guerrero 2008. Maximizing profit for absolute accumulation is bordering on the occult. The only real thing is differential accumulation. Point 4. Unlike the impossible absolute and elusive maximum, the normal and average are everywhere. Numerous organs of the state of capital, from the news media listings of Fortune, Business Week, Far Eastern Economic Review, Euromoney, Financial Times, and Forbes, to the private databases of Bloomberg, Compustat, DataStream and Global Insight, to national and international organizations, keep churning new benchmarks at a neck-breaking pace. Soon enough, they'll have us swamped with more benchmarks than assets. Every business and economic category is averaged across the world and over time. Indeed, so real is the zeal that even future projections of these magnitudes are now benchmarked against their own so-called consensus forecast. The benchmarks are classified by every imaginable criterion, separately and in combination, including size, nationality, sector, duration, risk, liquidity, and investability, among others. Indeed, the notion of normality as a benchmark for action and achievement has been so thoroughly accepted that it now dominates numerous non-business spheres, from education and the arts to sports and foreign relations. To be real is to be relative. Differential capitalization and differential accumulation. The capitalist Creo writer. The logic of this relative architecture was spelled out by the 18th century invention of the metric system. The system was purposefully linked to the magnitude of the planet, setting the meter equal to 1/40,000,000 th of the Earth's circumference. This anchor, hoped its inventors, would be the benchmark for the measure of all things. A meter based on the size of the Earth, marveled Pierre-Simon Laplace, would entitle even the most humble landowner to say, "The field that nourishes my children is a known portion of the globe, and so, in proportion, am I a co-owner of the world," quoted in Alder 2002, 90. Capitalization enables a similar partition of ownership, only in ways that are infinitely more complex and fluid than anything Laplace could have imagined, and not nearly as congenial or assuring. This latter partition is counted not in meters but in money prices, and it parcels the control not only of land but potentially of every aspect of human society. It is the mapping of capitalist power at large. Of course, not all power gets capitalized, but then all capitalization is power. And as more and more forms of power get capitalized, capitalization becomes the overarching architecture of power. This view helps us transcend the conventional separation between power and capital. From the hierarchical perspective of Marx, the engine is productive capital. This is the basis on which the entire social structure of power gets built. The Weberians flatten the picture, arguing that control over the means of production is merely one of many different types of authority. Point 5. Our own framework fuses the two logics. Capital is still the starting point, as Marx correctly insisted. And ownership of the means of production indeed is merely one form of power, as the Weberians argue. But capital is not means of production, it is a mode of power. And although there are many different forms of authority and power, in principle they can all be subsumed by capital. In this way, the structure of ownership encompasses and reflects the entire gamut of capitalized power. In Chapter 13 we described this mode of power as the state of capital, a mega-machine that comprises both corporations and government organs. The cogs of this mega-machine consist of factory workers, corporate accountants, and chief executives, along with government employees, bureaucrats, and top officials. All are part of the same process of capitalization and accumulation, and in that sense all are integrated into the same map of ownership. In this framework, the total dollar value of capitalization maps the power that capitalists exert over society. Any given fraction of this totality denotes a corresponding, undifferentiated share of that power. Individual or groups of capitalists secure their claims through particular organizations, institutions, and processes, so the content of their power is always qualitatively unique. But because this power is exercised over society as a whole, its form can be quantified in universal monetary units, that is, as claims on the entire process of social restructuring. This universality enables capitalists to gauge their power based on their relative stakes. An owner with 1% of the total has twice the power of one with only 0.5% and half that of another with 2%. But capitalism isn't simply an order, it is a creorider. It involves the ongoing imposition of power and therefore the dynamic transformation of society. In this process the key is differential accumulation. The goal is not merely to retain one's relative capitalization but to increase it. And since relative capitalization represents power, increases in relative capitalization represent the augmentation of power. The accumulation of capital and the changing power of capitalists to transform society become two sides of the same creorider. This notion of capital as power and accumulation as changes in power stands in sharp contrast to received convention. Political economy keeps the two sets of concepts strictly distinct, and even the most astute observers can do no more than link them. When Bowles, Gordon, and Weisskopf, 1986, 1990, offer to weigh capitalist power relative to that of workers, foreign suppliers, and the country's citizenry, they take capital as a given and then treat it as a source of power. A similar distinction underlies Doug Henwood's assessment of the growing concentration of wealth. This concentration, he writes, yields extraordinary social power, the power to buy politicians, pundits, and professors, and to dictate both public and corporate policy, 1997, 4. In this sequence, capitalists first accumulate wealth and then use this wealth to acquire power. The two categories, although intimately linked, are nonetheless separate. The figurative identity. In our framework, capital accumulation and the changing power of capitalists are one and the same. But this identity is only figurative. It consists of converting quality into quantity, of translating and reducing the heterogeneous processes of capitalist power into the universal units of differential capitalization. And this conversion obviously is not an objective process. First, the relative magnitude of capitalization, although readily observable, is based on the intersubjective conventions of the capitalist nomos. Second, this relative magnitude cannot be inferred simply by observing the power aspects of the capitalist scene. The fact that a certain corporation was granted a patent, that it had the government move to its side, that it introduced a new technique, or that it acquired a competitor, cannot, in and of itself, tell us much about that company's rate of differential accumulation. The way to understand this figurative identity is speculatively. Force is nothing apart from its effect, tell us Hegel and Marcuse, it is always a correspondence between form and content, quantity and quality. Therefore, the way to give capital meaning is by contrasting these two aspects, by juxtaposing the quantitative patterns of differential accumulation, on the one hand, with the qualitative power institutions, organizations, and processes that underlie this accumulation, on the other. 6. Clearly, any such attempt to jump from qualities to quantities cannot claim the rigor of natural science. But, then, we have seen what happened to liberal and Marxist analyses when they tried to imitate this rigor. They pretended that there is a strict quantitative correspondence between prices, production, and accumulation on the one hand and utility and labor values on the other, and then fell flat on their faces when they tried to demonstrate this correspondence. Capitalists constantly try to force life into a box, to harness creativity, to convert quality into quantity. This is the nature of their power. But they can achieve this conversion only speculatively and intersubjectively, and there is no point in pretending otherwise. The task is to try to understand this speculative translation. And, in our opinion, The only way to do so is by telling a scientific story, a systematic historical analysis that convincingly ties the quantities and qualities of capitalist power. With these considerations in mind, we propose the following working definition of accumulation. From a static perspective, the differential power possessed by a particular group of owners is measured by its differential capitalization, DK, that is, by comparing the group's combined capitalization to that of the average capital unit. If this average is $5 million, a capital worth $5 billion represents a DK of 1,000. This magnitude means that, as a group, the owners of that capital are 1,000 times more powerful than the owners of an average capital. From a dynamic viewpoint, the change in differential power is measured by the rate of differential accumulation, DA, defined as the rate of change of DK. To achieve differential accumulation, owners need to have their own capitalization grow faster than the average capitalization. Positive, zero or negative rates of DA imply rising, unchanging or falling differential power, respectively. From a power stance, only capitalists with a positive DA are said to accumulate. These differential accumulators should be the center of analysis. The universe of owners. Who are the differential accumulators? To contextualize the answer, let's backtrack and first consider the universe of owners. In principle, anyone who owns a capitalized asset can be thought of as a capitalist to that extent. And since capitalization has penetrated nearly every corner of society, there are plenty of such capitalists around. For our purpose, though, this formal generalization is overstretched and misleading. We can think of two types of assets, those that are held for use and those that are held for accumulation. The vast majority of owners hold the first type. They own articles that they use, such as their family home, vehicle, and other big-ticket items, and they own assets that they intend to use, primarily savings and pensions. The aggregate magnitude of these assets could be substantial, but their individual size tends to be small. Most importantly, these assets give their owners little or no control over other people. A small minority of owners holds the second type of assets. These assets are financial instruments, consisting mostly of equity and debt claims on corporations and governments. They are held not for use, but for accumulation. Their overall magnitude is large and so is their individual size. And, most importantly, they give their owners direct and indirect control over other people. 7. This classification narrows our search. It is obvious that the first group of people, namely, most of humanity, is pretty much out of the accumulation race. The vast majority of the population is simply trying to make ends meet and, if they are lucky, also to save a bit for emergency and old age. Since they do not pursue power, they offer no reference point to accumulators and hence do not figure in the benchmark. The relevant universe for differential accumulation comprises the second group, the owners of financial instruments. They are the capitalists. In our discussion, though, we focus not on individual owners, but on groups of owners. The reason is that the vendibility of capital creates centrifugal as well as centripetal forces, and the centrifugal forces limit the power of any single capitalist. In counteracting this effect, the elementary solution is the corporation, and, eventually, the corporate, government coalition, overt or covert. For this reason we concur with Veblen that the corporation itself, regardless of who runs it, was historically necessary for the survival of capitalism. Without this institution, which for Marx signaled the imminent abolition of capital as private property within the framework of capitalist production itself, 1909, Volume 3, 516, the centrifugal forces of competition and excess capacity would probably have killed the bourgeois order long ago. Hence, any analysis of contemporary capitalism must have the corporation as a central building block. As we have seen in Part 4, the underlying purpose of coalescing individual capitalists into a corporation, and corporations into corporate, government alliances, is exclusion. In non-capitalist systems, exclusion is usually embedded in relatively rigid customs, such as those preventing serfs from growing into kings, slaves from turning into masters and untouchables from becoming Brahmins. Capitalism does not have similar customs. Commodification makes upward mobility possible, and in principle there is nothing to prevent the son of a wandering vendor of quack medicine from assembling the Standard Oil of New Jersey, or a university dropout from incorporating Microsoft. However, the possibility of upward mobility doesn't mean that capitalism has done away with exclusion. Far from it. Indeed, for John D. Rockefeller and William Gates to have acquired their power, others had to give it up. Because of the constant threat of equal opportunity, such exclusion requires relentless formation and reformation of distributional coalitions, to use the language of Mancur Olson, 1965, 1982. The difference therefore is largely one of form, whereas in other modes of power exclusion is mostly static, built into the social code and yielding relatively stable groupings. In the capitalist Creo rider it has to be dynamically recreated through ever-shifting alliances. Dominant capital. The upshot of these considerations is that the accumulation of capital in general depends on the accumulation of capital at the center. The crucial group is dominant capital, a cluster that we equate with the leading corporate, government coalitions at the core of the process. The periphery of capital, comprising the many firms outside the core, in fact constitutes a permanent threat to accumulation. Subject to the strong centrifugal forces of competition, these firms cannot help but undermine the collusive underpinnings of business sabotage and therefore the very possibility of accumulation. It is only to the extent that dominant capital can retain and augment its exclusive power against these lesser capitals, keeping them out of the loop, that the capitalization process can be sustained and extended. This intra-capitalist conflict accentuates the differential underpinnings of accumulation. Whereas profit maximizers concentrate only on their own gains, differential accumulators are also driven to undermine their rivals' gains. Their successful sabotage gives their relative performance a double boost. It raises their own earnings while cutting those that make up the benchmark they try to beat. The identity of dominant capital is bound up with the process of differential accumulation. By definition, those who beat the average rise in the ranking, whereas those who trail it fall in the ranking. Given enough time, the fastest differential accumulators, regardless of their initial positions, will end up occupying the top ranks. So, as a first approximation, we can say that, at any point in time, dominant capital consists of the largest corporations in the relevant universe of companies. Note that this loose definition says nothing about the individual firms that comprise dominant capital. Differential accumulation does not have to be dominated by the same corporate entities throughout, and given the highly transformative nature of the process, neither should we expect it to be. However, at the most general level, what matters is the differential growth of dominant capital as a whole, regardless of its inner composition. As George Orwell aptly put it, a ruling group is a ruling group so long as it can nominate its successors. Who wields power is not important, provided that the hierarchical structure remains always the same. Orwell 1948, 211, original emphasis, point 8. How should we delineate dominant capital from the rest of the corporate universe? The most elegant solution is to not delineate it all, and instead use an integral index such as Gini or Herfindahl-Hirschman, HH. The advantage of these indices is that they take into account the entire distributional pattern of companies, so there is no need to set an arbitrary cut-off point. But integral indices also have two important deficiencies: they require detailed data that often do not exist, and they are difficult to reconcile intuitively with the binary notion of differential accumulation. Therefore, in our presentation here we opt for the less elegant yet simpler cut-off method. There are two basic options. One is to choose a fixed proportion, for instance, the top 5 or 10% of the firms in the corporate universe. The other is to select a fixed number of firms, for example, the top 50 or 100. The latter method is simpler and we use it here. Aggregate concentration. So let's look at the numbers. We begin our exploration with standard measures of aggregate concentration, which we find useful but only up to a point. The next section sharpens the analysis by looking at our own differential measures. Our focus continues to be the United States first, because of its central capitalist position over the past century, and, second, because it has the best long-term statistics. Table 14.1 lists some indicative magnitudes of the categories we measure, contrasting the early 1950s with the early 2000s. The data pertain to three categories: 1. The top 100 corporations in the CompuStat Industrial Database, a cluster that we use as a proxy for dominant capital; 2. The universe of listed corporations, and 3. The universe of all corporations. The table provides information on the number of firms in each group, the average capitalization per firm and the average profit per firm. We refer to these numbers in our description below. Table 14.1, U.S. Corporate Statistics, average number of firms, average capitalization per firm and average net profit per firm. Source: see figures 14.1 and 14.2. Figure 14.1 shows two indices of aggregate concentration, one based on market capitalization, the other on net profit. Each index measures the percent share of the top 100 firms ranked by market capitalization in the relevant corporate universe. Point 10. Figure 14.1, aggregate concentration in the United States. Asterisk ratio between the market capitalization of the top 100 CompuStat corporations, ranked annually by market capitalization, and the overall market capitalization of all U.S. listed corporations. Ratio between the net profit of the top 100 CompuStat corporations, ranked annually by market capitalization, and the overall net profit of all U.S. corporations, listed and unlisted. Source: CompuStat Compan file through WRDS, series codes, data 25 for common shares outstanding, data 199 for share price, data 172 for net income, U.S. Federal Reserve Board's flow of funds through Global Insight, FL 8930641005 for market value of corporate equities, U.S. Bureau of Economic Analysis through Global Insight, ZA for profit after taxes. The concentration index for market capitalization is computed from two sources. The numerator is the market capitalization of the top 100 firms from the CompuStat database, ranked annually by market capitalization. The denominator is the combined market capitalization of all listed corporations on the NYSE, NASDAQ, and Amex. The number of listed corporations quadrupled from roughly 1,500 in the early 1950s to over 6,000 presently. The second measure of concentration, based on net profit, is computed a bit differently. The numerator is the total net profit of the top 100 CompuStat firms by capitalization. The denominator is the aggregate net profit of all U.S. corporations, listed and unlisted. The total number of corporations increased nearly tenfold from around 600,000 in the early 1950s to over 5.5 million presently. Both data series show high and rising levels of aggregate concentration. In the early 1950s, the top 100 firms accounted for 40% of all market capitalization. By the early 2000s their share was 60%. The uptrend in the aggregate concentration of net profit, based on the entire corporate universe, is even more pronounced, particularly given the much faster growth in the total number of firms. During the early 1950s, the top 100 dominant capital firms accounted for 23% of all corporate profits. By the early 2000s, their share more than doubled to 53%. Measures of aggregate concentration are often used to approximate the overall power of big business. And the levels and trends in figure 14.1 indeed portray an ominous picture. But the situation in fact is far more alarming than this picture suggests. The difficulty lies in the definition of aggregate concentration and is fairly simple to explain. Let S denote the average size of a dominant capital firm, in terms of capitalization, profit, etc., N, the fixed number of dominant capital firms, S, the average size of a firm in the corporate universe, and n, the number of firms in the corporate universe. The aggregate concentration ratio is then given by. As the equation makes clear, the rate of aggregate concentration depends not only on the differential size of dominant capital, S/S, but also on the ratio between the number of dominant capital firms and the total number of firms, N/N. The problem is that over time these two ratios tend to trend in opposite directions. Whereas, S/S tends to increase as large firms grow bigger while small firms do not, N/N tends to fall since the number of dominant capital firms remains fixed while the overall number of firms keeps rising. In many instances, the rise in N is so fast that the aggregate concentration ratio ends up moving sideways or even down. Now, this counter movement would have been inconsequential had the numerator and denominator of the concentration ratio represented comparable entities. But the entities they represent are very different. The numerator measures the overall size of dominant capital, a cluster that gets as close as one can to the ruling capitalist class. This group is subject to intradistributional struggles, but on the whole it is probably the most cohesive and often the only class in society. Its members, owners and controllers are connected and fused through numerous ownership, business, cultural and sometimes family ties. They are tightly linked to key government organs through a complex web of regulations, contracts, revolving doors, and a shared worldview, and their accumulation trajectories often show close similarities. The denominator, representing the corporate sector as a whole, is a very different creature. Excluding dominant capital, the vast majority of its firms are small. Unlike dominant capital, whose worldview was shaped by the 20th century, the owners of smaller firms tend to entertain 19th century ideals. They continue to swear by the free market and the autonomous consumer, they love to bedevil government intervention and the higher-up lobbies, and they long for the good old days of equal opportunity and a level playing field. Their own corporate units are only loosely related through professional associations, if at all. They are removed from the high politics of organized sabotage. They have very little say in matters of formal politics, and, most importantly, they tend to act at cross purposes. In no way can they be considered a power block. Point 11. The fractured nature of the sector makes aggregate concentration ratios difficult to interpret. An increase in the number of small firms causes aggregate concentration to decline, yet that very increase fractures the sector even further, causing the relative power of dominant capital to rise. Differential measures. The relevant measure of power, therefore, is not aggregate but disaggregate. What we need to compare are not the totals, but the typical units that make up those totals, i.e. the relevant, S/S, in equation 1. This is what we do in figure 14.2, which displays two differential measures, one for capitalization, the other for net profit. Point 12. Figure 14.2. Differential capitalization and differential net profit in the United States. Asterisk ratio between the average market capitalization of the top 100 CompuStat corporations, ranked annually by market capitalization, and the average market capitalization of all U.S. listed corporations. Ratio between the average net profit of the top 100 CompuStat corporations, ranked annually by market capitalization, and the average net profit of all U.S. corporations, listed and unlisted. The number of U.S. corporations for 2004 to 2006 is extrapolated based on recent growth rates. Source: CompuStat Compan file through WRDS, series codes, data 25 for common shares outstanding, data 199 for share price, data 172 for net income, global financial data, number of listed corporations on the NYSE, Amex, and Nasdaq till 1989, World Federation of Exchanges, number of listed corporations on the NYSE, Amex, and Nasdaq from 1990, U.S. Internal Revenue Service, number of corporate tax returns for active corporations, U.S. Federal Reserve Board's flow of funds through Global Insight. FL 8930641105 for market value of corporate equities, U.S. Bureau of Economic Analysis through Global Insight, ZA for profit after taxes. Begin with differential capitalization. This ratio is computed in 3 steps. First, by calculating the average capitalization of a dominant capital firm, total capitalization of the top 100 CompuStat firms divided by 100, then by calculating the average capitalization of a listed company, total market capitalization divided by the number of listed companies, and finally by dividing the first result by the second. The ensuing ratio denotes the differential power of capital. It shows that in the early 1950s, a typical dominant capital corporation had nearly 7 times the capitalization, red power, of the average listed company, $694 million compared to $107 million, as calculated in Table 14.1. By the early 2000s, this ratio had risen to around $96 billion versus $2.7 billion, a 5-fold increase. 13. Unfortunately, this measure significantly underestimates the increase in the power of dominant capital. Note that the vast majority of firms are not listed. Since the shares of unlisted firms are not publicly traded, they have no market value. The fact that they have no market value keeps them out of the statistical picture, and since the excluded firms are relatively small, differential measures based only on large listed firms end up understating the relative size of dominant capital. In order to get around this limitation, we plot another differential measure, one that is based not on capitalization but on net profit, and that includes all corporations, listed and unlisted. The computational steps are similar. We calculate the average net profit of a dominant capital corporation, the total net profit of the top 100 CompuStat companies by capitalization divided by 100, we then compute the average net profit of a U.S. corporation, total corporate profit after taxes divided by the number of corporate tax returns. Finally, we divide the first result by the second. As expected, the two series have very different orders of magnitude. Notice the 2 log scales. But they are also highly correlated, which isn't surprising given that profit is the key driver of capitalization. This correlation means that we can use the broadly based differential profit indicator as a proxy for the power of dominant capital relative to all corporations. With this interpretation in mind, the pattern emerging from the chart is remarkable indeed. The data show that, in the early 1950s, a typical dominant capital corporation was roughly 1,667 times larger / more powerful than the average U.S. firm, average profit of $60 million compared with $36,000. By the early 2000s, this ratio had risen to 31,325, $5.2 billion versus $166,000, a 19-fold increase. 14. Accumulation crisis or differential accumulation boom. What does figure 14.2 tell us? Most generally, it suggests that U.S. differential accumulation has proceeded more or less uninterruptedly for the past half-century and possibly longer. Relative to all listed companies, the rate of differential accumulation by the top 100 dominant capital firms averaged nearly 4% annually, measured by the slope of the exponential growth trend of the capitalization series. The differential profit measure, benchmarked relative to the corporate sector as a whole, expanded even faster, growing at annual trend rate of 5%. Seen as a power process, U.S. accumulation appears to have been sailing on an even keel throughout much of the post-war era. For many readers, this conclusion may sound counterintuitive, if not heretical. According to analyses of the social structures of accumulation, SSA, and regulation schools, for instance, the United States has experienced an accumulation crisis during much of this period, particularly in the decades between the late 1960s and early 1990s. 15. This sharp difference in interpretation is rooted in the troubled definition of capital. The conventional creed, focused on a material understanding of profitability and accumulation, indeed suggests a crisis. Figure 14.3 shows 2 standard accumulation indices, smoothed as 5-year moving averages. The first is the plowback ratio, which measures the proportion of capitalist income invested in net productive capacity, net investment as a percent of net profit and net interest. The second is the rate of growth of the net capital stock measured in real terms. The long-term trend of both series is clearly negative. And, from a conventional viewpoint, this convergence makes sense. The plowback ratio is the major source of capital formation, so when the former stagnates and declines, so should the latter. Figure 14.3, Accumulation Crisis. Asterisk accumulation denotes the percent growth rate of private fixed assets net of depreciation, expressed in constant prices. Private fixed assets comprise non-residential equipment, software, and structures. The plowback ratio is net investment expressed as a percent of capitalist income. Net investment is the first difference between successive annual values of the net capital stock in current prices. Capitalist income is the dollar sum of after-tax corporate profit and net interest. Note, series are smoothed as 5-year moving averages. Source, U.S. Bureau of Economic Analysis through Global Insight, series codes, FAPNRA for private fixed assets in current prices, JAKE FAPNRA for private fixed assets in constant prices, ZCON for after-tax corporate profit with IVA and CCA, INTNATAMISC for net interest and miscellaneous payments on assets. This notion of accumulation crisis stands in sharp contrast to the evidence based on differential accumulation. As illustrated in Figure 14.4, unlike the plowback ratio and the rate of material accumulation, the share of capital in national income trended upward. It rose in the 1980s to twice its level in the 1950s, and fell only slightly since then, with data smoothed as 5-year moving averages. This distributional measure shows no sign of a protracted crisis. If anything, it indicates that capital income has grown increasingly abundant. Figure 14.4. Or a differential accumulation boom. Asterisk ratio between the average net profit of the top 100 CompuStat corporations, ranked annually by market capitalization, and the average net profit of all U.S. corporations. Note, series are smoothed as 5-year moving averages. Source, CompuStat Compan file through WRDS, series codes, data 25 for common shares outstanding, data 199 for share price, U.S. Bureau of Economic Analysis through Global Insight, ZA for corporate profit after tax, ZCON for after-tax corporate profit with IVA and CCA, INTNATAMISC for net interest and miscellaneous payments on assets, YN for national income, U.S. Internal Revenue Service, number of corporate tax returns for active corporations. The number of U.S. corporations for 2005 to 2006 is extrapolated based on recent growth rates. From a conventional viewpoint, these opposite developments are certainly puzzling. Capitalists have been investing a smaller proportion of their income and have seen their real accumulation rate decline, yet despite the accumulation crisis their share of national income kept growing. From a power viewpoint, though, the divergence is perfectly consistent. Capital income depends not on the growth of industry, but on the strategic control of industry. Had industry been given a free rein to raise its productive capacity, the likely result would have been excess capacity and a fall in capital's share. Revisit figures 12.1 and 12.2. Based on this latter logic, it seems entirely possible that the income share of capitalists increased because their real investment declined. To close the circle, note that the uptrend in the income share of capital plotted in Figure 14.4 coincided with a consistently positive differential accumulation by dominant capital, indicated here by the rising trend of differential net profit, smoothed as a 5-year moving average. This correlation is hardly trivial, at least from the viewpoint of economic orthodoxy. Liberal analysis suggests that because of diminishing returns, accumulation, defined as rising capital goods per head, should be associated with lower rates of returns and hence a downward pressure on the income share of capital. Marxist analysis is more ambivalent. It accepts that distribution could depend on power, yet, hostage to the labor theory of value, it sees investment as contributing to a rising organic composition of capital and therefore to lower surplus and declining returns. From our own perspective, however, the positive association between differential accumulation and capital's income share is hardly surprising. Accumulation is a power process, not a material one. Defined in differential terms, it involves the growing relative power of society's leading capital groups, which in turn helps sustain or expand the overall income share of capital. This double-sided process is consistent with our analysis in Chapter 12, where we suggested that the distribution of capital income among absentee owners, and hence the differential rate of accumulation, is roughly related to the balance of business damage they inflict on each other, and that the income share of all absentee owners depends, although non-linearly, on the overall industrial damage arising from the business warfare raging among them. Therefore, we tentatively argue that, over the longer term, capital accumulation depends on two key conditions, and that the absence of one or both of these conditions brings a threat of capitalist crisis. A non-negative rate of differential accumulation by dominant capital. This condition implies that the relative power of the largest absentee owners is either stable or growing. It reflects both the power drive of accumulation and the actual ability to keep industry subjugated to business. A steady or rising capital share of income. Although this requirement is partly an indirect result of the first condition, it also reflects the overall balance of power between capitalists and other societal groups. Unless this condition is fulfilled, the very capitalist nature of the system could be put into question. Historical paths. The boundaries of novelty. Differential accumulation is a power creator, an ongoing struggle to restructure society against opposition. The form of the process is the quantitative redistribution of ownership, its content the qualitative transformation of power relations. The transformative feature is crucial because it means novelty, and novelty, by definition, is never in the cards. It cannot be predicted. In this sense, differential accumulation, despite its objective quantitative appearance, is inherently open-ended. It does not move toward any equilibrium. It has no laws of motion. It may not even happen at all. In short, like much else in society, it is an indeterminate journey, an adventure continuously rewritten by its own characters. Point 16. This is the dynamic prefix of the capitalist CRE order. But there is also the static suffix of CRE order, namely, the structures that capitalists try to impose and to which they themselves often become subservient. The imposition of order concretizes differential accumulation. It turns it from an abstract principle into a particular story, subject to specific, albeit broad, limitations. As noted earlier, these limitations, including the basic algorithm of accumulation, are themselves created by humans, so they too can be altered. But such changes, being more fundamental in nature, always come with difficulty and never too quickly. To paraphrase Marx, human beings make their own history, as well as the circumstances in which this history unfolds, but the latter are much more difficult to change than the former. And as long as these circumstances, or algorithms, persist in their general form, their impact is to restrict action and limit the possible, as Fernand Braudel, 1985, put it. It is in this latter sense that commodification and capitalization gradually make the quest for differential accumulation a primary compass of social action, a constraint that shapes both ideology and behavior. And insofar as this differential quest materializes, that is, insofar as dominant capital does grow faster than the average, its expansion tends to occur within certain boundaries and follow particular paths. Spread, integration, oscillation. What are these paths? Broadly speaking, the historical evolution of differential accumulation during the past century seems to have followed three related patterns. The first, secular feature is the gradual spread of differential accumulation as the principal driving force of capitalist development within a given society, as well as into virgin territory previously untouched by vendible capital. The second feature, also secular, is the increasing integration of separate differential accumulation processes. As capital becomes more and more vendible, its buying and selling transcends its original industry, sector and, finally, home country, resulting in a progressive convergence of accumulation benchmarks across these different universes. The capitalists find it feasible to invest farther afield, and the more they venture out, the more universal their yardsticks become. The social process underlying this convergence is the growing unification and standardization of business principles, so that any given society or group finds itself responding to the roller coaster of differential accumulation elsewhere and to an increasingly similar normal rate of return everywhere. The final feature of this history is cyclical. Differential accumulation tends to move in long swings, alternating between two distinct regimes which we term breadth and depth. A breadth regime is characterized by proletarianization, growth, and corporate amalgamation. It tends to be structurally dynamic, and commonly it is less conflictual. A depth regime, by contrast, is marked by stagflation. It tends to consolidate rather than change institutions and structures, and it is usually more conflictual and often violent. These three features of differential accumulation, its spread, integration, and alternating regimes, are closely related. The first two processes work to reinforce one another, and their unfolding makes the breadth-depth cycles ever more interdependent and synchronized across sectors and societies. The other side of this triple process relates to class. Ongoing differential accumulation means the centralization of commodified power in the hands of an ever more cohesive group of dominant capital, whereas the spatial integration of the process makes this group increasingly transnational. The study of differential accumulation regimes, therefore, is a study of capitalist class formation. It helps us understand how this class comes into being, the methods it uses to build and consolidate its power, and the conflict and contradictions it faces in rewriting its own history. The remainder of the chapter outlines the general boundaries and paths of these processes, characterizes their features, and briefly examines their interactions. The subsequent chapters look at these issues more closely, flesh out their history, and assess their broader significance for the global political economy. Regimes of differential accumulation. How can dominant capital achieve differential accumulation? To set the context, consider again the capitalization equation from Chapter 11. The formula consists of four elementary particles: future earnings, E, hype, H, a risk coefficient, delta, and the confident normal rate of return, RC. For dominant capital, differential capitalization, DK, is the ratio between its own capitalization and the average capitalization. Equation 3 expresses this ratio by using the D subscript to denote dominant capital and no subscript to denote the average capital. The normal rate of return is common to dominant capital and the average, and therefore drops from the ratio. Equation 3 presents the overall picture. On the quantitative side, it tells us that dominant capital can achieve differential accumulation by some combination of the following: 1. Raising its differential earnings, ED/E, 2. Raising its differential hype, HD/H, and 3. Lowering its differential risk, delta D/delta. Point 17. On the qualitative side, it means that in order to understand the concrete history of dominant capital, we need to examine the intertwined power processes that drive its differential earnings, hype, and risk, as well as the processes that underlie the normal rate of return, which, although not in the equation, remains of crucial importance in setting the boundaries of the process. But of these components, one clearly stands out: differential earnings, ED/E. As we have seen, this is the main long-term driver of the process. And since our aim here is to provide only a broad brush description, the empirical analysis that follows focuses mostly on earnings and refers to hype and risk only in passing. For a corporation, the level of earnings is the product of the number of employees multiplied by the average earnings per employee. The number of employees denotes the formal size of the organization, while earnings per employee measure the elemental power per unit of organization. According to this equation, the firm can raise its earnings in two ways. The first path, which we call breadth, is to augment the size of its organization by having more employees. The second path, which we label depth, is to increase the elemental power of its organization by raising its earnings per employee. 18. This decomposition merits clarification. Despite the apparent connotations, the categories of employment and earnings per employee have little to do with narrowly defined production and everything to do with broadly conceived power. Our choice of employment as a measure of organizational size is not accidental. Ever since they first emerged in the power civilizations of the ancient river deltas, hierarchical organizations have been measured by head, or capita. They have been counted in slaves, soldiers, serfs, religious followers, factory workers, and now, more generically, in employees. The number of heads under one's immediate command relative to the number of heads commanded by others is indicative of one's immediate power. But formal organizational size is merely the first, immediate dimension of power. In the past, rulers were able to use their slaves, soldiers, serfs, religious laity, and factory workers to control others, often beyond the formal confines of their own organization. And the same is true, only many times over, with the broader category of employment. Operating through their corporate organization, capitalists are able to project their indirect power over society as a whole. This indirect power takes numerous forms, from the creation of loyal and predictable consumers, through the taming of voters, to the control of subcontractors, the subjugation of governments, the shaping of public policies, the molding of culture, the crafting of ideology, the harnessing of religion, the use of armies and police forces, and the crafting of international relations. The relative effectiveness of these multiple forms of indirect power gets crystallized in the magnitude of differential profit per employee. This latter measure represents the elemental power of the capitalist organization, its ability to extend its power beyond its immediate size. Equation 5 formalizes this logic at the differential level, using the subscript D to denote dominant capital and no subscript to signify the average. Differential earnings, ED/E, are given by the ratio of differential employment and differential earnings per employee. A dominant capital firm can accumulate differentially, 1. by expanding its employment faster than the average, 2. by raising its earnings per employee faster than the average, or by some combination of the two. Each avenue breadth or depth can be further subdivided into internal and external subroutes, leading to a four-way taxonomy. Table 14.2, Regimes of Differential Accumulation. Some implications. In addressing the implications of this taxonomy, it is important to distinguish the case of an individual large corporation from the broader analysis of dominant capital as a group. A single firm may successfully combine different facets of breadth and depth. However, the same does not hold true for dominant capital as a whole. If we look at breadth and depth not as firm strategies, but as overall regimes of differential accumulation, it quickly becomes apparent that the broader conditions that are conducive to one regime often undermine the other. For the sake of brevity, we group our tentative arguments here into 8 related propositions. Proposition 1. Understood as broad regimes, breadth and depth tend to move counter-cyclically to one another. Breadth presupposes some measure of employment growth as well as relative political, economic stability. Depth, on the other hand, commonly implies restrictions, conflict, and stagflation. Although strictly speaking the two regimes are not mutually exclusive, they tend to negate one another, with more breadth being associated with less depth, and vice versa. Proposition 2. Of the two regimes, breadth is the path of least resistance. There are 2 reasons for this pattern. First, usually it is more straightforward and less conflictual to expand one's organization than it is to engage in collusive increases in prices or in struggles over input prices. Although both methods are political in the wide sense of the term, depth commonly depends on complex corporate, state realignments that are not necessary for breadth. Second, breadth is relatively more stable and hence easier to extend and sustain, whereas depth, with its heightened social antagonism, is more vulnerable to backlash and quicker to spin out of control. Proposition 3. Over the longer haul, mergers and acquisitions tend to rise relative to greenfield investment. While both routes can contribute to differential accumulation, as capitalism spreads geographically and dominant capital grows in importance, so does the threat of excess capacity. Mergers and acquisitions alleviate the problem, whereas greenfield aggravates it. Point 20. The broader consequence of this shift is for chronic stagnation to gradually substitute for cyclical instability. Proposition 4. The relative growth of mergers and acquisitions is likely to oscillate around its uptrend. Corporate amalgamation involves major social restructuring and hence is bound to run into roadblocks. The result is a wave-like pattern, with long periods of acceleration followed by shorter downturns. Proposition 5. The underlying logic of mergers and acquisitions implies progressive spatial unification and, eventually, globalization. For amalgamation to run ahead of overall growth, dominant capital must successively break its envelopes, spreading from the industry, to the sector, to the national economy, and ultimately to the world as a whole. In this sense, differential accumulation is a prime mover of spatial integration and globalization. Proposition 6. Cost cutting is not a real alternative to an amalgamation lull. The pressure to reduce cost is ever present, but its effect is more to meet than to beat the average. The principal reason is that productivity improvements are neither inherently related to corporate size nor easy to protect. Similarly, reductions in input prices seldom are proprietary and often spill over to other firms. Proposition 7. A much more potent response to declining mergers and acquisitions is inflationary increases in earning margins. This method is often facilitated by previous corporate centralization, and although the process is inherently unstable and short-lived, it can generate very large differential gains. By its nature, though, such inflation is possible only through a vigilant limitation of production, as a result of which inflation appears as stagflation. Proposition 8. Over the longer term, differential accumulation depends primarily on mergers and acquisitions. In the shorter term, it can benefit from sharp stagflationary crises. The main engine of differential accumulation is corporate amalgamation, a process that thrives on overall growth and the successive breakup of ownership envelopes. Occasional discontinuities in the process, however, push dominant capital toward an alternative regime of stagflationary redistribution. The result is a pendulum-like oscillation between long periods of relative political economic stability accompanied by greenfield growth and low inflation, and shorter periods of heightened conflict, stagnation, and inflation. The remaining chapters of the book highlight the significance of these propositions with an examination of the U.S. experience over the past century. Brevity and the exclusive focus on the United States make this analysis suggestive rather than exhaustive. Nonetheless, the United States and US-based firms have had a leading role in shaping modern capitalism, so their experience may offer insight into other cases as well as into the nature of capitalist development more broadly. Finally, a word of caution. Although the United States offers the best historical data, these are not always suited for our disaggregate analysis and occasionally force us into rough approximations, roundabout estimates, and bare speculations. Our conclusions therefore are tentative and open to challenges, and they invite further research and discussion. According to David Bohm, Bohm 1980, Bohm and Pete 1987, there is no ultimate generative order. Instead, there is an infinite unfoldment, a never-ending order of orders that slowly unfolds with greater hindsight and insight. From this viewpoint, Marx's capitalism is enfolded, along with several other modes of production, within the higher generative order of dialectical materialism. Perhaps with enough hindsight it will be possible at some point to nest capitalization within a higher generative order of power right arrow curving left. One of the most conspicuous acts of consumption is the acquisition of an entire territory. Capitalists cannot yet apply this act to sovereign countries, but they have been practicing on islands. According to the subtly titled Financial Times supplement How to Spend It, the demand for islands has never been higher, and although the chief driver of this rarefied market remains prestige, other factors now fuel the passion for a personal domain surrounded by sea. Friedman 2007. One popular consideration, says Farhan Vilati, owner of the world's leading island estate agency, is the direction of the wind, in case a nuclear attack annihilates the nearby mainland. Another is elevation so that the consumer can safely escape the imminent rising of the seas as the poles melt. But even these considerations are part of the show-off. It's not the price because those who can afford it tend not to worry about money, it's the fact there's such a limited supply. And sure enough, private islands tended to outperform the mainstream property market. So, in the end, conspicuous consumption is nothing more than glorified investment, but, then, since investment cannot have a real quantity, our measurement odyssey ends up right where it started. Right arrow curving left. We have already seen in Chapter 12 that actual pricing methods have little to do with maximization. Neoclassicists love to ignore these inconvenient facts, only that the situation is hardly any better in their pure theory. As it turns out, neoclassical profits can be maximized only in the hypothetical cases of perfect competition and monopoly, but not anywhere in between. The problem, first identified by Cournot, 1838, is one of oligopolistic interdependence, which, in its unrestricted form, that is, without the game theorists, makes maximum profit indeterminate even in the mind of the economist. See footnote 4 in Chapter 5. Right arrow curving left. Peter Martin, a Financial Times columnist, is clearly sailing against the wind when he calls on fund managers to abandon their fetish for relative performance in favor of absolute returns. Martin 1999. Some hedge funds have tried to do just that, i.e. achieve a predetermined rate of return, but as another Financial Times commentator explains, their strategy is tantamount to having their cake and eating it too. In the end, absolute return strategies are attractive only insofar as they manage to beat the average. Anonymous 2002. Right arrow curving left. Control over the means of production is but a special case of authority, and the connection of control with legal property an incidental phenomenon of the industrializing societies of Europe and the United States. Classes are tied neither to private property nor to industry or economic structures in general, but as an element of social structure and a factor affecting change they are as universal as their determinant, namely, authority and its distribution itself. Dahrendorf 1959, 136-37. Right arrow curving left. In this sense, our logic here is similar to Kalecki's degree of monopoly, 1943a, an already mentioned proxy that measures the consequence for relative profit margins of monopolistic institutions and forces. Our own notion here differs from Kalecki's, first, in that it focuses on capitalization rather than merely on profit margins, and second, in that it relates not to the narrow economic question of monopoly vs competition, but to the entire dynamics of capitalist power. Right arrow curving left. The two ownership groups overlap. The first may own some financial assets, while the second owns assets for use. But the overlaps are sufficiently small to be safely ignored. Even in the so-called people's capitalism of the United States, most family holdings of stocks and bonds do not exceed a few $1,000s. And although many of the big holders of financial instruments have a lavish lifestyle, the assets they own for use tend to be small relative to those they hold for accumulation. Right arrow curving left. Theory aside, the actual turnover among the leading corporations is slower than it looks, although it is sometimes necessary to read the fine print to see why. A 1989 Fortune comparison shows that, of the top 50 firms in 1954, only 28 were still in the top 50 in 1988. The rest disappeared, though none because it became too small. Of the 22 firms that were no longer on the 1988 list, all remained very much at the top, 7 were still ranked in the top 300, 11 were acquired by other large firms, 2 went private, 1 was reclassified as a service firm, and 1 was still on the list but under a new name. Anonymous 1989. Right arrow curving left. 15. Breadth. It is difficult to describe the rapacity with which the American rushes forward to secure the immense booty which fortune proffers to him. For he is goaded onwards by a passion more intense than the love of life. Before him lies a boundless continent, and he urges onwards as if time pressed and he was afraid of finding no room for his exertions. Alexis de Tocqueville, Democracy in America. It is hard to think of a capitalist growth episode more exhilarating and promising than the 19th century advancement of the American frontier. The promise of abundance, riches, and endless opportunities, minus the Indians, excited tellers of stories and theories alike and lured millions to try their luck in the land of unlimited possibilities, Zinn 1999. Yet, as the opening quote from de Tocqueville points out, even in this historically unique period, with a wilderness large and fertile enough to accommodate everyone, the pursuit of growth was decidedly differential. Growth itself may seem unbounded, but the control of growth is always bounded. No capitalist can ever control more than the entire social process. This is the whole. The only way for some owners to gain more power over this totality is for others to give up some of theirs. In the rush for power, there is never enough room for everyone. The present chapter examines how dominant capital increases its power by augmenting the relative size of its corporate organs. To reiterate, there are two basic ways of doing so: 1. Greenfield investment that buys newly built facilities and hires new employees, and 2. Mergers and acquisitions that take over the existing facilities and employees of other firms. We spend relatively little time on greenfield growth, which, as we shall see, is the less important avenue. The bulk of the chapter is devoted to corporate amalgamation and its far-reaching implications for the capitalist Creo-rider. Greenfield. Dominant capital can run its greenfield investment at different speeds. It can sprint ahead of the pack, expanding its employment faster than the overall growth of the business sector. It can run with the pack, expanding at the same rate as the business sector, or it can trail the business sector. Of these strategies, the first two are relevant for our inquiry. Both augment the external breadth of dominant capital, differential employment per firm, but as it turns out, both act as a double-edged sword in that they also undermine external depth, differential profit per firm. Running ahead of the pack. The consequences of running ahead of the pack are fairly clear. When larger firms hire new workers faster than the overall expansion of private employment, their corporate size grows relative to that of the average firm, particularly since, as we shall see shortly, the size of the average firm tends to fall even as overall employment rises. But, save for exceptional circumstances, this strategy is suicidal. Recall that the ultimate purpose is to increase not the relative size of the organization, breadth, but of relative profit, the product of breadth and depth. And it turns out that this strategy usually loses in depth more than it gains in breadth, leading to falling differential profit. As the reader now knows, letting industry loose undermines the fundamental tenet of sabotage without which profit and accumulation are impossible. The vulnerability here is so great that even the mere anticipation of excessive growth is often enough to trigger panic, price war, and sharply lower differential profit per firm. Perhaps this is the reason that most dominant capital executives respond to greenfield opportunities with the suspicion of a New York City driver who has just spotted an empty parking space. Their typical knee-jerk reaction is to look for the proverbial road sign warning, "Don't even think of parking, your cash, here." Running with the pack. Fortunately for dominant capital, there is no need to lead. Simply going with the crowd and letting employment expand in tandem with the business sector as a whole is sufficient to generate external breadth. The success of this sound strategy has to do with the different expansion patterns of large and small firms. Large companies react to overall growth mainly by increasing their employment ranks. Smaller companies, by contrast, respond by growing in number, through the birth of new firms, as well as in size, by hiring more workers. This difference is important since newborn firms, by their very nature, tend to be smaller than the average. Recall our discussion of aggregate concentration in Chapter 14. The implication is that, even if greenfield growth is spread proportionately between dominant capital and the rest of the business universe, since both expand at the same clip, as long as some of this growth results in the birth of smaller firms, the net impact is to reduce average employment per firm and, therefore, to augment the differential breadth of dominant capital. The evolution of this process in the United States is illustrated in Figure 15.1, which shows the number of corporations, the overall level of employment and the average number of employees per firm, with series rebused for comparison. Point 2. The overall picture is one of pronounced divergence. From 1926 to 2008, the number of corporations has risen nearly 16-fold, whereas overall employment has grown only 3-fold. As a result of this difference, average employment per firm has dropped by over 75%. Note the logarithmic scale. Point 3. The process wasn't always even. During the 2 decades between the mid-1920s and mid-1940s, the number of firms remained relatively stable, first because of the Great Depression, and subsequently due to the Second World War. Consequently, changes in overall employment during that period were reflected more or less fully in the average size of firms, which fell throughout the Depression only to rise rapidly thereafter. In the longer run, however, this early pattern proved an aberration. As noted, capitalism is subject to strong centrifugal forces, one of which is the inability of business enterprise to control the overall number of independent capitalists on the scene. And indeed, after the war, the number of firms started multiplying again, while their average size trended down more or less continuously. Since large firm employment has increased over the same period, we can safely conclude that overall employment growth served to boost the differential breadth of dominant capital. The indirect impact of employment growth, operating through depth, is more complex and harder to assess. On the one hand, the multiplicity of small firms keeps their profit per employee low, partly by precluding cooperation and pricing discretion and partly by undermining formal political action. This fact bears positively on the differential depth of dominant capital. At the same time, unruly growth in the number of small firms can quickly degenerate into excess capacity, threatening to unravel cooperation within dominant capital itself. The balance between these conflicting forces is difficult if not impossible to determine. All in all, then, greenfield growth is no panacea for dominant capital. Although the process boosts its differential breadth, it has an indeterminate and possibly negative effect on differential depth. One way to counteract this latter threat is to scare the underlying population with overheating and educate policy makers about the benefits of balanced growth, a stagnationary recipe that has been applied with considerable success over the past half-century. Point 4. But the more fundamental solution to the problem is corporate amalgamation. Mergers and acquisitions. A mystery of finance. Our discussion of amalgamation begins with Figure 15.2. The chart plots a buy-to-build indicator, expressing the dollar value of mergers and acquisitions as a percent of the dollar value of gross fixed investment. In terms of our own categories, this index corresponds roughly to the ratio between internal and external breadth. The data sources and method of computing this index are described in the data appendix to the chapter. The chart illustrates two important processes, one secular, the other cyclical. Secularly, it shows that, over the longer haul, mergers and acquisitions indeed have become more important relative to greenfield investment, Proposition 3 in Chapter 14. At the end of the 19th century, money put into amalgamation was equivalent to less than 1% of greenfield investment. A century later, the ratio surpassed 200%. The trend growth rate indicated in the chart suggests that, year in, year out, mergers and acquisitions grew 3.4 percentage points faster than new capacity. Now, whereas employment associated with new capacity is added by small and large firms alike, amalgamation increases mostly the employment ranks of dominant capital. The net effect of this trend, therefore, is a massive contribution to the differential accumulation of large firms. Point 5. The reasons for this tendency are not at all obvious. Why do firms decide to merge with, or take over other firms? Why has their urge to merge grown stronger over time? And what does this process mean for the broader political economy? These are not straw man questions. Mergers baffle the experts. Most mergers disappoint, writes The Economist, so why do firms keep merging? Anonymous 1998. And the textbooks offer no clear answer. According to one influential manual, mergers remain one of the 10 mysteries of finance, a riddle for which there are many partial explanations but no overall theory. Brealey et al. 1992, ch. 36. The efficiency spin. Needless to say, amalgamation is a real headache for mainstream economics, whose models commonly rely on the assumption of atomistic competition. Alfred Marshall, 1920, tried to solve the problem by arguing that firms, however large, are like trees in the forest. Eventually they lose their vitality and die out in competition with younger, more vigorous successors. On its own, though, the forest analogy was not entirely persuasive, if only because incorporation made firms potentially perpetual. So, for the skeptics, Marshall had to offer an add-on. Even if large firms failed to die, he said, and instead grew into a corporate caste, the attendant social inconvenience was still tolerable because, first, such a caste tended to be benevolent and, second, the political costs were outweighed by the greater economic efficiency of large-scale business enterprise. The rigorous spin on this justification was provided by Ronald Coase, 1937, who stated that the size of firms is largely a matter of transaction costs. Inter-firm transactions, he asserted, are the most efficient since they are subject to market discipline. Unfortunately, such transactions are not free, and therefore they make sense only if their efficiency gains exceed the extra cost of carrying them through, otherwise, they should be internalized as intra-firm activity. Using such a calculus, one can then determine the proper boundary of the firm, which, according to Coase, is set at the precise point where the costs of organizing an extra transaction within the firm become equal to the costs of carrying out the same transaction by means of an exchange on the open market or the costs of organizing in another firm. p. 96. The ideological leverage of this theory proved immense. It implied that if companies such as General Electric, Cisco, or Exxon decided to internalize their dealings with other firms by swallowing them up, then that must be socially efficient, and it meant that their resulting size, no matter how big, was necessarily optimal. For instance, Williamson 1985, 1986. In this way, the non-existence of perfect competition was no longer an embarrassment for neoclassical theory. To the contrary, it was the market itself that determined the right balance between the benefits of competition and corporate size, and what is more, the whole thing was achieved automatically, according to the eternal principles of marginalism. But then, there is a little glitch in this Nobel-winning spin. It is irrefutable. The problem is, first, that the cost of transactions, relative to not transacting, and the efficiency gains of transactions, relative to internalization, cannot be measured objectively, and, second, that it isn't even clear how to identify the relevant transactions in the first place. This measurement limbo makes marginal transaction costs much like marginal productivity and marginal utility unobservable, and with unobservable magnitudes, reality can never be at odds with the theory. Point 6. For instance, one can use transaction costs to claim that the historical emergence of internalized command economies such as Nazi Germany or the Soviet Union proves that they were more efficient than their market predecessors. The obvious counterargument, which may well be true, is that these systems were imposed from above, driven by a quest for power rather than efficiency. But then, can we not say the exact same thing about the development of oligopolistic capitalism? 7. In fact, if it were only for efficiency, corporations should have become smaller, not larger. According to Coase's theory, technical progress, particularly in information and communication, reduces transaction costs, making the market look increasingly appealing and large corporations ever more cumbersome. And, indeed, using this very logic, Francis Fukuyama, 1999, has announced the death of the hierarchy, while advocates of the freelance economy, as in freelance, have argued that today's corporate behemoths are anomalous and will soon be replaced by small, virtual firms, Malone and Laubacher 1998. So far, though, these predictions seem hopelessly wrong. Amalgamation has not only continued, but accelerated, including in the so-called high-technology sector, where transaction costs have supposedly fallen the most. From efficiency to power. From an efficiency perspective, the relentless growth of large firms is indeed puzzling. Why do firms give up the benefit of market transactions in pursuit of further, presumably more expensive internalization? Are they not interested in lower costs? From a power viewpoint, though, the riddle is more apparent than real. Improved technology certainly can reduce the minimum efficient scale of production, MES, and, indeed, today's largest establishments, plants, head offices, etc., often are smaller than they were 100 years ago. However, firms are not production entities but business units, and given that they can own many establishments, their boundary need not depend on production as such. The real issue with corporate size is not efficiency but differential profit, and the key question therefore is whether amalgamation helps firms beat the average, and if so, how? The conventional wisdom here is that mergers and acquisitions are a disciplinary form of corporate control. According to writers such as Mann, 1965, Jensen and Rabach, 1983, and Jensen, 1987, managers are often subject to conflicting loyalties, and this conflict may compromise their commitment to profit maximization, the so-called principal-agent problem. The threat of takeover puts these managers back in line, forcing them not only to improve efficiency, but also to translate such efficiency into higher profit and rising shareholders' value. This argument became popular during the 1980s. The earning yield on U.S. equities fell below the yield on long-term bonds for the first time since the 1940s, and that drop gave corporate raiders the academic justification, if they needed one, for launching the latest and longest merger wave. The logic of the argument, however, was and remains problematic. Mergers may indeed be driven by profit, but that in itself has little to do with productivity gains. Neither is there much evidence that mergers are prompted by inefficiency, or that they make the combined firms more efficient. 8 Indeed, as we suggested in Chapter 12 and argue further below, the latent function of mergers in this regard is not to boost efficiency but to tame it, a task that they achieve by keeping a lid on overall capacity growth. Moreover, there is no clear indication that mergers make the amalgamated firms more profitable than they were separately, although here the issue is somewhat more complicated and requires some explication. 2 points are worth noting. First, there is a serious methodological difficulty. Most attempts to test the effects of mergers on profitability are based on comparing the performance of merged and non-merged companies. 9 While this method may offer some insight in the case of individual firms, it is misleading when applied to dominant capital as a whole. Looking at the amalgamation process in its entirety, the issue is not how it compares with doing nothing, that is, with not amalgamating, but rather how it contrasts with the alternative strategy of greenfield investment. Unfortunately, such a comparison is impossible since the very purpose of mergers and acquisitions is to avoid creating new capacity. In other words, amalgamation removes the main evidence against which one can assess its business success. Perhaps a better, albeit unscientific, way to tackle the issue is to answer the following hypothetical question: what would have happened to the profitability of dominant capital in the United States if, instead of splitting its investment 1/3 for greenfield and 2/3 for mergers and acquisitions, it were to plow it all back into new capacity? As Veblen, 1923, correctly predicted, such a free run of production is not going to happen, so we cannot know for sure. But then the very fact it hasn't happened, together with the century-long tendency to move in the opposite direction, from greenfield to amalgamation, already suggests what the answer may be. 10. The second important point concerns the meaning of profitability in this context. Conventional measures, such as earnings to price ratio, return on equity, or profit margin on sales, relevant as they may be for investors, are too narrow as indicators of capitalist power, particularly when such power is vested in and exercised by corporations rather than individuals. A more appropriate measure for this power is the distribution and differential growth of profit, and of capitalization more broadly, and from this perspective mergers and acquisitions make a very big difference. By fusing previously distinct earning streams, amalgamation contributes to the organized power of dominant capital, regardless of whether or not it augments the more conventional rates of return. In our view, this earning fusion, common to all mergers, is also their ultimate reason. And indeed, by gradually shifting the emphasis from building to buying, from colliding to colluding, and from a certain measure of public oversight to increasingly capitalized government, corporate capitalism in the United States and elsewhere has been able not only to lessen the destabilizing impact of greenfield cycles pointed out by Marx, but also to reproduce and consolidate on an ever-growing scale. Instead of collapsing under its own weight, capitalism seems to have grown stronger. The broader consequence of this shift has been creeping stagnation, Proposition 3 in Chapter 14, and yet, as Veblen already suggested a century ago, the large accumulators have learned to manage the stagnation for their own ends. Patterns of amalgamation. Merger waves. Now, this general rationale for merger does not in itself explain the concrete historical trajectory of corporate amalgamation. Mergers and acquisitions grow, but not smoothly, and indeed the second feature evident in Figure 15.2 is the cyclical pattern of the series, Proposition 4 in Chapter 14. Looking at the past century, we can identify 4 amalgamation waves. The first wave, occurring during the transition from the 19th to the 20th century, is commonly referred to as the monopoly wave. The second, lasting through much of the 1920s, is known as the oligopoly wave. The third, building up during the late 1950s and 1960s, is nicknamed the conglomerate wave. And the fourth wave, beginning in the early 1980s, does not yet have a popular title, but based on its all-encompassing nature we can safely label it the global wave. This wave-like pattern remains something of a mystery. Why do mergers and acquisitions have a pattern at all? Why are they not erratic? Or, alternatively, why do they not grow continuously or in line with greenfield investment? So far, most attempts to answer these questions have approached the issue from the micro perspective of the firm, which is precisely why they run into a dead end. Tobin's Q. One of the more famous explanations is based on the work of Tobin and Brainerd, 1968, 1977, whom we have already met in Chapter 10. The underpinnings of the argument cannot be simpler: capitalists are rational, and rational actors buy what is cheap. Their yardstick is Tobin's Q, the ratio between the capitalized value of an asset on the market and the price of building it from scratch. When Tobin's Q is smaller than 1, existing capacity is cheaper, so the firm will buy it from others. And when Tobin's Q is greater than 1, new capacity is cheaper, so the firm will construct it anew. For the corporate universe as a whole, Tobin's Q is the ratio of overall market capitalization to the replacement cost of all outstanding assets, and if individual rationality extends to aggregate rationality, we should observe the buy-to-build indicator moving inversely with Tobin's Q. The less expensive existing assets are relative to newly produced ones, the greater the proportion of financial to real investment should be, and vice versa. The explanation seems sensible enough, only that reality refuses to abide. Figure 15.3 shows the relationship between the two magnitudes, our own buy-to-build indicator expressing mergers and acquisitions as a percent of gross fixed investment, and Tobin's Q, computed by dividing the overall market value of stocks and bonds by the total current cost of corporate fixed assets. Both series are smoothed for easier comparison. Source: for data sources and computations of the buy-to-build indicator, see data appendix to the chapter. Data for Tobin's Q, U.S. Bureau of Economic Analysis through Global Insight, series codes, FAPNRES for current cost of corporate fixed assets. The market value of stocks and bonds splices data from the following two sources. 1932 to 1951, Global Financial Data, Market Value of Corporate Stocks and Market Value of Bonds on the NYSE. 1952 to 2007, Federal Reserve Board through Global Insight, Series Codes, FL8930641005 for Market Value of Corporate Equities, FL263164003 for Market Value of Foreign Equities held by U.S. residents, FL8931630005 for Market Value of Corporate and Foreign Bonds, FL263163003 for Market Value of Foreign Bonds held by U.S. residents. According to the chart, U.S. capitalists have gone out of their minds. Instead of investing in what is cheap, they have been systematically overspending on the expensive. Note that the two series move not inversely, but together. When Tobin's Q rises, so does the buy-to-build ratio, which means that capitalists prefer costlier mergers and acquisition over cheaper greenfield. And when Tobin's Q falls, so does our buy-to-build indicator, which suggests that they prefer pricier new factories over the inexpensive second-hand assets available on the market. Of course, the problem here is not the capitalists, it's the theory. If the positive correlation of the two series seems anomalous, it is only because we use a neoclassical logic that denies power in order to explain a process that is all about power. The specific blind spot is prices. Locked into the atomistic individualism of the 19th century, liberal analysts tend to assume that prices are given by the market, and that the only thing capitalists need to do is minimize cost. Yet, as we have seen in Chapter 12 and as the large owners know full well, this pricing ethics is a relic of history. In the new state of capital, the power struggle is fought over prices as well as costs. The issue is not only to reduce the latter, but also to actively maintain and increase the former. And this simultaneity changes the whole buy or build calculus. New capacity indeed may be cheap if only a few capitalists add it. But if many capitalists do the same, the calculus becomes very different. The latter circumstances spell glut. Glut means the disintegration of full cost pricing, and if prices end up dropping faster than costs, the consequence is falling profit. In this context, building greenfield factories, although seemingly cheaper than existing assets, is a recipe for business disaster. As we explain below, dominant capital understands this power logic all too well and acts accordingly. And as the emphasis flips from passively accepting prices to actively managing them, Tobin's Q turns from a cause to a consequence. It goes up when investors happen to buy and down when they decide to build. From classical Marxism to monopoly capitalism. In short, mergers and acquisitions, although pursued by individual firms, occur within a broader and ever-changing political, economic context. It is only when we make this restructuring process the center of our analysis that the general pattern of amalgamation begins to make sense. A highly interesting attempt in this direction was offered by Michael Lebowitz, 1985, who tried to derive the tendency toward monopoly capitalism from the very logic of classical Marxism. According to Marx, argues Lebowitz, the essence of accumulation is the expropriation of means of production initially from workers, but ultimately also from most capitalists until capital becomes one, a unitary amalgamate held by a single capitalist or a single corporation. The road towards such amalgamation, Lebowitz continues, proceeds through horizontal, vertical, and conglomerate integration, although not necessarily following the stylized pattern in Figure 15.2, and the key challenge is to show that all three phenomena are inherent in the inner logic of accumulation. To establish this link, Lebowitz begins by assuming, along with Marx, an intrinsic connection leading from productivity growth to accumulation. Next, he suggests that all three forms of integration increase efficiency and hence contribute to accumulation. Horizontal integration creates economies of scale, vertical integration leads to more roundabout, or mechanized production runs, and conglomerate integration improves allocative efficiency through intersectoral capital mobility. To constrain any of these processes therefore is to hinder accumulation, and since according to Marx capital works to dismantle its own barriers, it follows that all three types of integration are inevitable, and that capitalism is destined to become monopolistic. Based on its own premises, this logic is undoubtedly elegant. But the premises are partly incorrect as well as incomplete. The first problem concerns production. As noted earlier, beyond a certain point there is no necessary connection between industrial size and measured efficiency/profitability, so complete business integration cannot be attributed to the productive logic of accumulation. Point 11. The second problem is the absence of power. Even if greater industrial integration were always more efficient and more profitable, that would still leave unexplained a growing proportion of mergers that merely fuse ownership while leaving production lines separate. The difficulty is most clearly illustrated in the case of conglomerate integration. Intersectoral capital movement can improve allocative efficiency only through greenfield investment, but, if so, why does conglomerate consolidation almost invariably take the route of merger? The answer, by now a bit tedious, is that business consolidation is not about efficiency but about the control of efficiency. While capital is forever trying to remove the barriers to its own accumulation, this very accumulation is inherently impossible without imposing barriers on others, including on most other capitalists. The act of merger fulfills both of these requirements, allowing investors to exercise their freedom to hinder. Differential advantage. Seen from a differential accumulation perspective, amalgamation is a power process whose goal is to beat the average and redistribute control. Its main appeal to capitalists is that it contributes directly to differential breadth, yet without undermining and sometimes boosting the potential for differential depth. Point 12. In addition, by making the fused entities ever larger, increasingly intertwined with other larger firms and government bodies, and more involved in setting policies and regulations, mergers stabilize earnings growth and therefore reduce differential risk. Point 13. Finally, mergers often generate differential hype that owners can leverage to their own advantage. Thus, everything else remaining the same, it makes more sense to buy than to build. But then everything else does not and indeed cannot remain the same. The reason is simple: amalgamation creates the very conditions on which it is based. Point 14. 3 transformations. 3 particular transformations need noting here. First, amalgamation is akin to eating the goose that lays the golden eggs. By gobbling up takeover targets within a given corporate universe, acquiring firms are depleting the pool of future targets. Unless this pool is somehow replenished, mergers and acquisitions are bound to create a highly centralized structure in which dominant capital owns everything worth owning. From a certain point onward, therefore, the pace of amalgamation has to decelerate. Although further amalgamation within the circle of dominant capital itself may be possible, large firms buying each other, the impact on the group's differential accumulation relative to the average is negligible. By this stage, dominant capital has grown so big it is the average. Greenfield growth, by adding new employment and firms, works to replenish the takeover pool to some extent. But then, and this is the second point worth noting, since greenfield growth tends to trail the pace of amalgamation in both employment volume and dollar value, its effect is mostly to slow down the depletion process, not to stop it. Indeed, the very process of amalgamation, by directing resources away from greenfield investment, has the countervailing impact of reducing growth, and that reduction hastens the depleting process. Thus, sooner or later, dominant capital is bound to reach its envelope, namely the boundaries of its own corporate universe with few or no takeover targets to speak of. Point 15. Finally, corporate amalgamation is often socially traumatic. It commonly involves massive dislocation as well as significant power realignments. It is restricted by the ability of broader state institutions to quickly accommodate the new corporate formations, and it is capped by the speed at which the underlying corporate bureaucracy can adapt, a point emphasized by Penrose 1959. The consequence is that as amalgamation builds up momentum, it also generates higher and higher roadblocks, contradictions, and counterforces. Point 16. Taken together, the depletion of takeover targets, the negative effect on growth associated with lower levels of greenfield investment and the emergence of counterforces suggest that corporate amalgamation cannot possibly run smoothly and continuously. Proposition 4 in Chapter 14. Breaking the envelope. But then, why should amalgamation move in cycles? In other words, why does the uptrend resume after it stumbles? And what does this resumption mean? From the perspective of dominant capital, amalgamation is simply too important to give up. And while there may not be many candidates worth absorbing in their own corporate universe, outside of this universe targets are still plentiful. Of course, to take advantage of this broader pool, dominant capital has to break through its original envelope, which is precisely what happened as the United States moved from one wave to another. Proposition 5 in Chapter 14. The first, monopoly wave marked the emergence of modern big business, with giant corporations forming within their own original industries. Once this source of amalgamation was more or less exhausted, further expansion meant that firms had to move outside their industry boundaries. And indeed, the next oligopoly wave saw the formation of vertically integrated combines whose control increasingly spanned entire sectors, such as in petroleum, machinery, and food products, among others. The next phase opened up the whole U.S. corporate universe, with firms crossing their original boundaries of specialization to form large conglomerates with multiple business lines ranging from raw materials, through manufacturing, to services and finance. Finally, with the national scene having been more or less integrated, the main avenue for further expansion now is across international borders, hence the latest global merger wave. Point 17. Until recently, the global wave was characterized by considerable deconglomeration, with many firms refocusing on so-called core activities where they enjoyed a leading profit position. The main reason is that globalization enables additional intra-industry expansion across borders while legitimizing further domestic centralization in the name of global competitiveness. Eventually, though, such refocusing is bound to become exhausted, pushing dominant capital back toward conglomeration, and this time on a global scale. In fact, such reconglomeration is already happening in areas such as computing, communication, transportation and entertainment, where technological change is rapidly blurring the lines between standard industrial classifications. Point 18. And, indeed, the pivotal impact of mergers is to create not capitalist production but capitalist power at large. The reason is rooted in the dialectical nature of amalgamation. By constantly pushing toward, and eventually breaking through their successive social envelopes from the industry, to the sector, to the nation-state, to the world as a whole, mergers create a strong drive toward jurisdictional integration, to use Olson's terminology, 1982. Yet this very integration pits dominant capital against new rivals under new circumstances, and so creates the need to constantly create the wider power institutions of society, including the state of capital, international relations, ideology, and violence. Although this merger-driven creating of power is yet to be theorized and empirically investigated, some of its important patterns can be outlined tentatively. In the remainder of the chapter we examine several key developments that unfold as mergers enter their ultimate, global envelope. Globalization. From the viewpoint of capital as power, globalization is the capitalization of power on a global scale, and its key vehicle is the movement of capital. Point 19. The notion of movement here can have different meanings, so some clarification is in order before we begin. In common parlance, reference to international capital mobility connotes a macro-statist frame of reference. Capital is seen as an economic, productive entity that somehow flows from one state to another. But that isn't what happens in practice. By definition, capital mobility is a purely pecuniary process. Usually, the only thing that happens is a reshuffle of ownership claims, in which foreign capitalists acquire an asset from, or sell one to, their domestic counterparts. Occasionally, the acquisition alters the value of the transacted asset, but that change, too, is entirely pecuniary. The accountants simply adjust the value of equity or debt on the right-hand side of the balance sheet and of goodwill on the left-hand side, and that's it. There is no cross-border flow of machines, structures, vehicles, technical know-how, or employees. These items may or may not move later on, but such movements are merely rearrangements of the left-hand side of the balance sheet. They have no bearing on the act of foreign investment per se. The real impact of capital flows is on the underlying nature of power. When ownership crosses a border, it alters the organization and institutions of power on both sides of that border and, eventually, the significance of the border itself. In this sense, capital mobility creates the very state of capital from within and from without, and it is this fundamental transformation that we need to decipher. Capital movements and the unholy trinity. Most analyses of capital movement concentrate on its alleged cyclicality. The common view is that, although capital flow has accelerated since the 1980s, the acceleration is part of a broader recurring pattern, and that the peaks of this process in fact were recorded during the late 19th and early 20th centuries, Taylor 1996. The standard approach to these ups and downs in capital mobility is the so-called unholy trinity of international political economy. According to this framework, there is an inherent trade-off between 1. State sovereignty, 2. Capital mobility and 3. International monetary stability, three conditions of which only two can coexist at any one time, Fleming 1962, Mundell 1963, Cohen 1993, point 20. Thus, during the liberal gold standard that lasted until the First World War, limited state sovereignty allowed for both free capital mobility and international monetary stability. During the subsequent interwar period, the emergence of state autonomy along with unfettered capital flow served to upset this monetary stability. After the Second World War, the quasi-statist system of Bretton Woods put a check on capital mobility so as to allow domestic policy autonomy without compromising monetary stability. Finally, since the 1970s, the rise of neoliberalism has, again, unleashed capital mobility, although it is still unclear which of the other two nodes of the trinity, state sovereignty or monetary stability, will have to give. Why has the world moved from liberalism to instability to statism and back to neo-liberalism? Is this some sort of inevitable cycle, or is there an underlying historical process here that makes each phase fundamentally different? The answers vary widely. Point 21. Liberal interpretations emphasize the secular impact of technology that constantly pushes toward freer trade and greater capital mobility, with unfortunate setbacks created by government intervention and distortions. From this perspective, post-war statism, or embedded liberalism as Ruggie, 1982, later called it, was largely a historical aberration. After the war, governments took advantage of the temporary weakness of capitalism to impose all sorts of restrictions and barriers. Eventually, though, the unstoppable advance of information and communication forced them to succumb, as a result of which the rate of return rather than political whim once again governs the movement of capital. Critics of this natural course of things theory tend to reverse its emphasis. Thus, according to Helleiner, 1994, the key issue is neither the expansionary tendencies of technology and markets, nor their impact on the propensity of capital to move, but rather the willingness of states, i.e. governments, to let such movements occur in the first place. From this viewpoint, state regulation is not an aberration, but rather the determining factor and one that governments remain free to switch on and off. One important reason for such cyclical change of heart, suggests Frieden, 1988, is the shifting political economy of foreign debt. According to this view, during the gold standard, Britain became a mature creditor, and therefore was interested in liberalization so that its debtors could have enough export earnings to service their foreign liabilities. The United States reached a similar position during the 1970s, and since then it has used its hegemonic power to reimpose liberalization for much the same reason. According to Goodman and Pauly, 1995, this second coming of liberalism was further facilitated by the desire of governments to retain the benefits of transnational production. The latter desire required that they also open the door to transnational financial intermediation, hence the dual rise of portfolio and foreign direct investment. Global production or global ownership. Plus CA change, plus say Perel? According to the globalization skeptics, the answer is pretty much yes. Despite the recent increase in capital mobility, they point out, most companies remain far more national than global. See for instance, Doremus et al. 1998, Weiss 1998, Hurst and Thompson 1999. The extent of transnational production is fairly limited. Its share in global GDP rose from 5.6% in 1982, to 6.8% in 1990, to 10.1% in 2006. Even the world's top 100 transnational corporations are not yet fully global. Their 2005 Transnationality Index defined as the average of the ratios of foreign to total assets, foreign to total sales, and foreign to total employment is only 60% compared to 51% in 1990.22. The data themselves are hard to argue with, only that they aren't really the relevant ones to use. As noted in the preamble to this section, capital flow denotes the movement not of machines or production, but of ownership. The key issue, therefore, is not the location of factories and employees, but of the capitalists, and from this latter perspective the picture looks very different. Seen from the assets side of the balance sheet, a company whose factories and offices are all located in the United States is entirely domestic. But this all-American production tells us nothing about the company's liabilities. If its owners float bonds on the European market, borrow money from a Kuwaiti bank, or sell their equity to a Korean capitalist, their company, although still domestically located, suddenly becomes global. How extensive is the globalization of ownership as distinct from the globalization of production? According to recent research by the McKinsey Global Institute, between 1990 and 2006 the global proportion of foreign-owned assets has nearly tripled, from 9% to 26%. The increase was broadly based. Foreign ownership of corporate bonds rose from 7 to 21%, of government bonds from 11 to 31%, and of corporate stocks from 9 to 27%. Farrell et al. 2008, p. 73, Exhibit 3.10. How do these ratios compare to the situation during the late 19th and early 20th centuries, a period when capital mobility was supposedly hitting a record high? Since there are no data on global assets in that earlier period, the question is impossible to answer directly. But we can examine the process indirectly, by measuring the growth of global assets relative to global GDP. This comparison is presented in Figure 15.4. The estimates, taken from the work of Obstfeld and Taylor, 2004, show the ratio of gross foreign assets, comprising cash, loans, bonds, and equities owned by non-residents, to world GDP. Figure 15.4, Ratio of global gross foreign assets to global GDP. Asterisk gross foreign asset stocks consist of cash, loans, bonds, and equities owned by non-residents. Source, Obstfeld and Taylor, 2004, pages 52 to 53, Table 2-1. Based on this approximation, the historical transnationalization of ownership seems far less cyclical than the globalization skeptics would like to believe. The chart confirms the build-up of foreign assets during the latter decades of the 19th century. As British imperialism was approaching its zenith, it shows the relative build-down of these assets during the first half of the 20th century, as instability, depression, wars, and capital controls hampered the movement of capital, and it demonstrates the resurgence of foreign ownership since the early 1970s, as embedded liberalism gave rise to global capitalism. The amplitude of this long-term cycle, though, has increased quite a bit. During the previous phase, foreign assets peaked at less than 20% of world GDP. In the current phase, which so far shows no sign of abating, their ratio to GDP has already surpassed 90%. Net or gross? The question, then, is, How could a supposedly cyclical pattern of foreign capital flows generate what seems like a secular surge in foreign capital stocks? The answer is twofold. First, even if the movement of capital indeed ebbs and flows, over time the impact it has on the level of capital stocks tends to be cumulative, a point emphasized by Magdoff 1969. A second point, less intuitively obvious but equally important, is that the movement of capital may not be as cyclical as it seems. Note that most analyses of capital flow concentrate on net movements, namely, on the difference between inflow and outflow. Point 23. This choice is inadequate and potentially misleading. Capitalist integration and globalization can move both ways, which means that the proper measure to use here is the gross flow, that is, the sum of inflow and outflow. Wallach 1984. The net and gross magnitudes are the same when capital goes only in one direction, either in or out of a country. But when the flow runs in both directions, the numbers could be very different. The divergence of the two measures is clearly illustrated in figure 15.5. The chart contrasts the net and gross capital flows in the G7 countries, with both series expressed as a percent of the G7's gross fixed capital formation. Point 24. It shows that since the 1980s, the relative increase of gross private flows was both powerful and secular, whereas that of net flows was more limited and cyclical. As a result, by 2007 the value of gross flows reached 82% of greenfield investment, compared to only 16% per center for net flows. Point 25. Figure 15.5, G7 cross-border private investment flows as a percent of gross fixed capital formation. Note, series are smoothed as 3-year moving averages. Flows comprise direct and portfolio investment. Gross flows are computed as the sum of inflows and outflows. Net flows are computed separately for each country as the difference between inflows and outflows and are then converted into absolute values and aggregated. Each series denotes the ratio of overall G7 flows to overall G7 gross fixed capital formation, both in $US. Source: IMF's International Financial Statistics through Global Insight, series codes, LAF for the $US exchange rate, L93ENC for gross fixed capital formation, IMF's Balance of Payment Statistics through Global Insight, series codes, B4505 for direct investment abroad, B4555Z for direct investment in the reporting country, B4602 for portfolio investment abroad, B4652Z for portfolio investment in the reporting country. Global Insight International Database, series codes RX at US for Euro/$US. Exchange rate, IFIX at Euro for fixed capital formation from 1998 for EU countries. Unfortunately, lack of historical data on gross movements makes it difficult to compare current developments with conditions prevailing at the turn of the 20th century. Nonetheless, the facts that the share of gross investment in GDP was generally higher then than now and that two-way capital flow is a relatively recent phenomenon, together serve to suggest that the current pace of globalization, let alone its level, may well be at an all-time high. Capital flow and the Creorider of global power. Theoretically, the common thread going through most analyses is the belief that capital flows in response to the primordial forces of production and trade. According to this view, capital flows are directed by profit signals. Profit signals show where capital is most needed, and capital is most needed where it is the most productive, comparatively or otherwise. To us, this view is akin to putting the world on its head. The global movement of capital is a matter not of production and efficiency but of ownership and power. On its own, the act of foreign investment, whether portfolio or direct, consists of nothing more than the creation or alteration of legal entitlements. Point 26. The magnitude of such foreign entitlements, just like the magnitude of domestic entitlements, is equal to the present value of their expected future earnings. And since the level and pattern of these earnings reflect the control of business over industry, it follows that cross-border flow of capital reflects the restructuring not of global production, but of global capitalist power at large. Point 27. One of the first writers to approach international capital mobility as a facet of ownership and power was Stephen Heimer, 1960. In his view, firms would prefer foreign investment over export or licensing when such ownership conferred differential power, or an ownership advantage as it later came to be known. Based on this interpretation, the power of US-based foreign investors seems to have risen exponentially over the past half-century, as illustrated in Figure 15.6. Note, series are smoothed as 5-year moving averages. Source, U.S. Bureau of Economic Analysis through Global Insight, Series Codes, GARP till 1998 and ZBCon from 1999 for after-tax corporate profit receipts from the rest of the world, ZA for after-tax corporate profit, X for export, GDP for GDP. The chart presents two proxies for the globalization of U.S. business. The first proxy, measuring the share of export in GDP, provides a rough indication of the contribution to overall profit of outgoing trade. The second, measuring the share of foreign operations in overall net corporate profit, approximates the significance of foreign as opposed to domestic investment. Up until the 1950s, the relative contribution to profit of foreign assets was similar to that of export, assuming domestic and export sales are equally profitable, so that the ratio of export to GDP corresponds to the ratio of export profit to overall profit. But since then, the importance for profit of foreign investment has grown much faster than that of trade, reaching 1/3 of the total in recent years. This faster growth of foreign profit may seem perplexing since, even with the recent resurgence of capital mobility, U.S. trade flows are still roughly 3 times larger than capital flows. But then, unlike trade, investment tends to accumulate, and that accumulation eventually causes overseas earnings to outpace those generated by export. This divergence serves to heighten the power underpinnings of trade liberalization. Advocates of global integration, following in the footsteps of Adam Smith and David Ricardo, tend to emphasize the central role of free trade. Unhindered exchange, they argue, is the major force underlying greater efficiency and lower prices. And as it stands, their claim may well be true. Indeed, downward price pressures are one reason why dominant capital is often half-hearted about indiscriminate deregulation, particularly when such deregulation allows competitors to undermine its differential margins. Yet despite this threat, large firms continue to support freer trade, and for a very good reason. For them, free trade is a means to something much more important, namely free investment, or more precisely, the freedom to impose and capitalize power. Foreign investment and differential accumulation. Although difficult to ascertain with available data, the cumulative, albeit irregular, build-up of international investment must have contributed greatly to the differential accumulation of U.S. dominant capital. The reason is that whereas exports augment the profits of small as well as large firms, the bulk of foreign earnings go to the largest corporations. Therefore, it is the globalization of ownership, not trade, which is the real prize. While free trade can boost as well as undermine differential accumulation, free investment tends mostly to raise it. But then, since free investment can come only on the heels of liberalized trade, the latter is worth pursuing, even at the cost of import competition and rising trade deficits. Foreign investment, like any other investment, is always a matter of power. The nature of this power, though, has changed significantly over time. Until well into the second half of the 19th century, the combination of rapidly expanding capitalism and high population growth enabled profitability to rise despite the parallel increase in the number of competitors. 28 There was only a limited need for business collusion and the explicit politicization of accumulation, and, as a result, most capital flows were relatively small portfolio investments, associated mainly with greenfield expansion, Folkertslandet, Matheson, and Skynasi. 1997, Annex 6. Eventually, though, excess capacity started to appear, giving rise to the progressive shift from greenfield to amalgamation as described earlier in the chapter. Yet for more than half a century this shift was mostly domestic, with mergers and acquisitions first having to break through their various national envelopes. It was only since the 1970s and 1980s that the process became truly global, and it was only then that the character of capital flow started to change. The need to exert control has moved the emphasis gradually toward larger, direct foreign investment, while the threat of excess capacity has pushed such investment away from greenfield and toward amalgamation. At present, over 75% of all foreign direct investment takes the form of cross-border mergers and acquisitions, United Nations Conference on Trade and Development 2117, figure 4.9. From a power perspective, therefore, one could say that during the late 19th and early 20th centuries capital mobility was still largely a matter of choice. But by the end of the 20th century it became more or less a necessity, mandated by the combination of excess capacity and the cumulative build-up of giant firms, for which profitable expansion increasingly hinges on global amalgamation and creeping stagnation, Proposition 3 in Chapter 14.29. In summary, there is a long but crucial link leading from the broad power imperatives of capitalism, to the logic of differential accumulation, to amalgamation, to capital mobility, Proposition 5 in Chapter 14. From this viewpoint, the purpose of globalization is not aggregate growth but differential gain. It is driven not by the quest for greater global efficiency, but by the need to control efficiency on a global scale, and finally and most importantly, it is inherent in the capitalist credo. Without the globalization of ownership, dominant capital cannot break its national envelope, and if it cannot go global, its differential breadth is bound to collapse. In this sense, globalization is part of the inner logic of accumulation. It can be reversed only by altering that logic, or by moving away from it altogether. Appendix to Chapter 15, Data on Mergers and Acquisitions. There are no systematic historical time series for mergers and acquisitions in the United States. Other countries have even less information. The mergers and acquisitions series constructed in this chapter and plotted in figures 15.2 and 15.3 is computed on the basis of various studies. These studies often use different definitions, covering different universes of companies. The dollar values of mergers and acquisition for the 1895 to 1919 period are taken from Nelson, 1959, Table 14, p. 37, whereas those covering the 1920 to 29 period come from EIS, 1969, as reported in Historical Statistics of the United States, U.S. Department of Commerce. Bureau of the Census 1975, Volume 2, Table V38, 40, p. 914. Both datasets cover manufacturing and mining transactions only and thus fail to reflect the parallel amalgamation drive in other sectors, Markham 1955. Data for the 1930 to 66 period are from the U.S. Federal Trade Commission, reported in Historical Statistics of the United States, 1975, Volume 2, Table V38, 40, p. 914. These data, again covering only manufacturing and mining, pertain to the number of transactions rather than their dollar value. Significantly, though, the number of mergers and acquisitions correlates closely with the value ratio of mergers and acquisitions to greenfield investment during previous and subsequent periods for which both are available, the 1920s and 1960s to 1980s. In our computations, we assume that there is a similar correlation during 1930 to 66 and use the former series, with proper rebasing, as a proxy for the latter ratio. From 1967 onward, we again use value data which now cover all sectors. Figures for 1967 to 79 are from W.T. Grimm, reported in Weston, 1987, Table 3.3, p. 44. For 1980 to 83, data are from Securities Data Corporation, comprising transactions of over $1 million only. The next batch, covering the period from 1984 to the 2003, consists of transactions of $5 million or more and is from Thompson Financial. The data for 2004-7, also from Thomson Financial, cover transactions of $10 million or more. These latter data are spliced with the previous series for consistency. In constructing our indicator for the ratio of mergers and acquisitions to gross fixed investment, we divided, for each year, the dollar value of mergers and acquisitions by the corresponding dollar value of gross fixed private domestic investment. Until 1928, the Greenfield investment data pertain to total fixed investment, private and public, and are taken from the Historical Statistics of the United States, 1975, Volume 1, Series F105, p. 231. From 1929 onward, the data cover gross fixed private investment and are from the U.S. Bureau of Economic Analysis via Global Insight, Series Code, IF. For the 1930-66 period, we spliced in the number of deals, linking it with prior and latter value ratios. 16. Depth. Husbandman, I think it is long of you gentlemen that this dearth is, by reason you enhance your lands to such an height, as men that live thereon must needs sell dear, or else they were not able to make the rent again. Night, and I say it is long of you husbandmen, that we are forced to raise our rents, by reason we must buy all things so dear that we have of you, which now will cost me double the money. From a 16th century text, a discourse of the common will of this realm of England. Quoted in Leo Huberman's Man's Worldly Goods. The farmers and knights of the 16th century could be forgiven for failing to understand the universal laws of inflation. They didn't realize that their own local problems in fact were part of a much bigger global process. They were oblivious to the influx of precious metals and ignorant of the growing importance of credit and capitalization. They had no comparative data to look at and no in-house economists to interpret them. In fact, as far as they were concerned, inflation didn't even exist. There were only increases in prices. The term inflation came into common use only 3 centuries later. Nonetheless, these illiterate 16th century folks were smart enough to see what many present-day economists wish we forgot, namely, that inflation is a conflictual process of redistribution. The prices that the farmers charged were costs for the knights, while those that the knights set were costs for the farmers. Both hiked their prices, but never at the same rate. And this differential meant that those who raised their prices faster redistributed income from those who did so more slowly. But the inflationary struggle isn't simply a tug of war between independent individuals or groups in society. It is an entire regime, an encompassing political process of transforming capitalist power. Note that inflation per se is much older than capitalism. As we have seen, prices already existed in the early civilizations and were leveraged and manipulated well before the arrival of capital. But capitalism is the first mode of power to be overwhelmingly denominated in prices. And hence it was only with the rise of accumulation that inflation could emerge as a key aspect of the social creorider, and it was only in the 20th century, with rise of large organized units, that inflation became a defining feature of the state of capital. The purpose of this chapter is to examine some of the ways in which prices and inflation assume this role through the process of differential accumulation. Point 2. Depth, internal and external. One of the more flexible features of the capitalist megamachine is the ability to increase power indirectly as well as directly. Equation 4, in Chapter 14. Capitalist power, exerted over society as a whole, is coded in the level and pattern of differential earnings. As we have seen, dominant capital can broaden this power directly by making its organization grow faster than the average. But there is also the other, indirect route of deepening the elemental power of its organization. Whereas breadth hinges on the number of employees in the corporate organization, depth depends on earnings per employee, a measure of the corporation's ability to leverage its organizational power over society as a whole. Of these two methods, the former is the more effective. Operating primarily through mergers and acquisitions, it can generate enduring large-scale increases in capitalized power. Yet amalgamation isn't always feasible, and when breadth occasionally recedes, dominant capital has to resort to depth or risk differential decumulation. It is through this latter process that price changes and inflation come into the accumulation picture. Point 3. Let's look at the depth process more closely. Earnings per employee can be decomposed into three elements associated with the number of units produced/sold by the corporation, indicated by the term units. Point 4. These include 1. Unit price, 2. Unit cost, and 3. Units per employee. According to this equation, dominant capital can increase its differential depth by some combination of the following: 1. Raising the number of units sold per employee faster than the average, 2. Lowering unit cost faster than the average, 3. Increasing unit price faster than the average. Most political economists emphasize the first two methods and deem phase if not reject the third. In the race for accumulation, they argue, the ultimate winners are those whose inputs are the most efficient and least expensive. That's the ABC of economic survival. It is of course true, the argument continues, that monopolistic firms sometimes can increase their profits by charging higher prices, but this practice is secondary and ephemeral. According to received convention, excessively high prices send buyers in search of cheaper substitutes, the excess profits generated by high prices attract competitors, and finally, there is always competitors' creative destruction and the onslaught of innovations that even the strongest monopolist cannot withstand. All of this seems common sense, but, then, what looks sensible from the viewpoint of conventional political economy often gets inverted by differential accumulation. In Chapter 15 we saw that, contrary to common belief, dominant capital benefits much more from mergers and acquisitions than from greenfield growth. And in the present chapter we'll see a similar inversion with respect to prices. It turns out that raising prices is far more important for dominant capital than cutting costs. Cost cutting. To clarify, it's not that the economists are wrong about cost cutting. The conflictual dynamics of capitalism, persistent even in the presence of oligopoly and monopoly, imply a constant pressure to raise the productivity of the inputs and lower their prices. Point 5. This dual pressure, identified by the classical economists and reiterated by all subsequent schools, critical as well as conservative, seems beyond dispute. And yet, from the viewpoint of differential accumulation, cutting cost is much like running on empty. It helps dominant capital meet the average, not beat it. Admittedly, this latter claim isn't easy to test. The problem is that conventional data on productivity and input prices are rarely if ever broken down by firm size, so it is impossible to know whether and to what extent larger firms beat the average on either count. But the claim can be assessed indirectly, and the roundabout evidence seems consistent with the running on empty thesis. Productivity gains. Begin with productivity. Analytically, the number of units sold per employee, denoted by units per employee, can be written as the ratio between sales per employee and unit price. Using this equation, we can approximate the performance of dominant capital relative to the corporate sector as a whole. Our proxy for dominant capital here is the Fortune 500 group of companies, an alternative to the CompuStat Top 100 from Chapter 14. Over the past half-century, sales per employee in the Fortune 500 group and in the corporate universe have grown more or less in tandem. The ratio between the Fortune 500 and the corporate universe was 1.4 in 1954, it fell gradually to 1.1 by 1969, and from there it rose steadily, reaching 1.7 by 1993, with the latter increase probably partly reflecting the growing significance of outsourcing by large firms. Point 6. The overall change from 1.4 in 1954 to 1.7 in 1993 represents a 20% increase, minuscule when compared to the 19-fold increase in differential profit per firm recorded over the same period, figure 14.2. It also seems reasonable to assume that the prices charged by larger firms haven't fallen relative to those of smaller ones, and have possibly increased, particularly since, as we show in the next section, inflation has tended to work in their favor. Point 7. Now relate these two long-term developments to equation 2. Since differential sales per employee rose only marginally while differential prices haven't fallen and have probably risen, it follows that productivity gains by dominant capital were more or less the same as the social average. The difficulty of securing differential productivity gains shouldn't surprise us. Even if we ignore the hologramic nature of technology and focus only on the presumable in-house development of production techniques, there is still no reason to expect large firms to be better in such development than small ones. For instance, many of the current advances in biotechnology, information and communication are reported by smaller companies, some with only a handful of employees. Dominant capital is often unable to match this flurry of innovation. In many cases, large firms find it cheaper to let smaller companies incur the R&D cost and then buy the more promising startups, sometimes just to keep their technology from spreading too quickly. Point 8. Moreover, and probably more importantly, production techniques, regardless of who develops them, are notoriously difficult to monopolize. Unlike final commodities that can often be protected through patents, copyrights and other exclusionary threats, improvements in the social organization of production tend to proliferate easily, and this rapid spread quickly dilutes the initial advantage of whoever implemented them first. Input prices. The other route to cutting costs is to lower the prices of the inputs. Yet, here too it is very difficult to translate absolute reductions into differential reductions. For a start, even the largest firms have only limited control over their input prices, particularly with the proliferation of outsourcing and long production chains. The challenge to differential accumulation of universal input prices was summarized neatly by the former chairman of Intel, Andrew Grove. How do you build a company when your buyers are infinitely knowledgeable and where your suppliers maintain a level playing field for your competitors? What remains your competitive differentiator or your source of value, or whatever academic cliché you want to wrap around it? Verne 2000. Furthermore, even when large firms do control input prices, the benefits quickly tend to spill over to other firms. Thus, a wage freeze by dominant capital groups in the United States would empower smaller firms to follow suit. Political pressure by automobile companies on the Indian government to subsidize oil would benefit all energy users. A British importer winning a tariff reduction gives competing importers a free ride, etc. All in all, then, cost-cutting is a poor differential tactic. Dominant capital has to pursue it with much zeal, lest it falls behind, but it can rarely use it to get ahead. Stagflation. The road to differential depth is not to cut cost but to inflate prices. As we shall see, inflation often redistributes income from wages to profits and from small to large firms. It elevates the differential earnings per employee of the leading corporations, and it deepens the elemental power of dominant capital. But the process is full of puzzles. First, there is the general theoretical conundrum. Conventional theory associates inflation with growth, yet reality usually brings inflation together with stagnation. Since this combination is not supposed to happen, economists decided to contain the damage by giving it a special name. They called it stagflation, an anomalous mixture of stagnation and inflation that shouldn't be confused with normal, growth-driven inflation, growthflation. Point 9. And then there is our own bizarre proposition that stagflation, whether normal or anomalous, fuels the differential accumulation of dominant capital. Most readers will probably find this suggestion somewhat difficult to swallow. How could firms gain from a combined crisis of rising prices, stagnating production, and falling employment? Why should this crisis benefit larger firms relative to smaller ones? And if stagflation is so beneficial to the most powerful groups in society, why don't we have it all the time? Clearly, there are many questions to sort out here, so it is worthwhile to backtrack a bit and provide some context. The historical backdrop. To start with, there seems to be a general neglect, including among critical political economists, of the historical significance of inflation for capitalist development. On the face of it, this neglect is rather surprising. Inflation, commonly defined as a general rise in the price of commodities, is hardly new. According to David Hackett Fisher, 1996. Since the 13th century there have been no less than 4 major inflationary waves, or price revolutions as he calls them. Figure 16.1 illustrates the pattern of these waves in the UK, a country whose price indices go back the farthest. Note the log scale, point 10. Figure 16.1, Consumer prices in the UK, 1271 to 2007. Source, till 1948, data are from Global Financial Data, Series Code, CPGBRM, from 1949 onward, data are from International Financial Statistics through Global Insight, Series Code, L64 at C112. The first wave occurred during the 13th century, the second during the 16th century, the third in the latter part of the 18th century, and the most recent began in the early 20th century and is still going. As Fisher argues, each of these price revolutions was accompanied, particularly toward the latter part of the wave, by a deepening socio-economic crisis. In other words, the anomaly of inflation in the midst of stagnation is not a 20th century novelty. It's been with us for half a millennium, if not more. Now, to be fair to the classical political economists, the specific backdrop against which they were writing was largely one of price stability and even deflation, not inflation. As shown in figure 16.1, UK consumer prices had hardly changed between 1600 and 1750. In the second half of the 18th century they rose relatively quickly, but then fell again throughout the 19th century. Between 1800 and 1900, a formative period of political economy, consumer prices in Great Britain and wholesale prices in the United States both dropped by more than 1/3. 11 In this deflationary context, it was only natural to concentrate on production and the coercive discipline of market forces and to ignore inflation. However, the historical backdrop changed dramatically during the 20th century. First, inflation has risen to unprecedented levels. As figure 16.1 shows, UK prices rose by nearly 6,000% between 1900 and 2007, compared with less than 800% in the previous 6 centuries combined. 12. There was a clear change in pattern. Whereas during previous waves prices oscillated around their uptrend, in the 20th century with the notable exception of the 1930s they moved only up. 13. The classical political economists, writing in a different era, perhaps could be excused for not paying too much attention to inflation. But having lived through the experience of the 20th century, contemporary observers cannot ask for similar leniency. Neutrality. Of course, modern political economists don't deny that inflation exists, and some even agree that it may have short-term consequences. But in the opinion of most, all of this is much ado about nothing. In the long run, inflation has little or no effect. It is neutral. And why this insistence on neutrality? The reason goes back to David Hume's classical dichotomy. As we have seen earlier in the book, political economists follow this dichotomy to separate the real and nominal spheres of economic life. Of these two, the real sphere of production, consumption, and distribution is considered primary, the nominal sphere of money and absolute prices is thought of mostly as a lubricant, a mechanism that merely facilitates the movement of the real economy. And since money prices are nominal and therefore do not impinge on the real, their overall inflation, or deflation, must be neutral, by definition. 14. Aggregates. The belief that inflation is neutral is greatly facilitated by the way economists define it. There are two common definitions: 1. Inflation as a continuous increase in the average price level, and 2. Inflation as an ongoing increase in liquidity, that is, an increase in the total amount of money relative to the total volume of commodities. These two definitions are often seen as equivalent. If we derive the average price level P as the ratio between the total amount of money M and the overall quantity of commodities Q, ignoring the velocity of circulation, it is obvious that in order for the average price P to rise, or fall, the liquidity ratio M/Q has to rise, or fall, at the same rate, and vice versa. 15. In this strict sense, Milton Friedman is correct, inflation indeed is always and everywhere a monetary phenomenon, by definition. But inflation is never only a monetary phenomenon. Disaggregates. The important thing to note here is the aggregate perspective. The conventional definition focuses wholly and only on averages and totals. This fact is crucial, since to define inflation in this way is to miss the point altogether. Inflation certainly involves a rise in the average price of commodities, but that is like saying that the average outcome of a game between two basketball teams is always a draw, one team's win is another's loss. Although mathematically correct, the statement is irrelevant to the reality of basketball games. If these games always ended up in a draw, players would soon be looking for another game, one that they could actually win. Similarly with inflation. If all prices rose at the same average rate, inflation definitely would be neutral, as mainstream economists say. But it would also serve no purpose whatsoever and hence cease to exist. The crux of inflation is not that prices rise in general, but that they rise differentially. Inflation is never a uniform process. Although most prices tend to rise during inflation, they never rise at the same rate. There is always a spread, with some prices rising faster and others more slowly. From this viewpoint, the engine of inflation is a redistributional struggle fought through rising prices. The overall level of inflation is merely the surface consequence of that struggle. So in the end, Milton Friedman is right, but only in part. Inflation is always and everywhere a monetary phenomenon, but it is also always and everywhere a redistributional phenomenon. Point 16. Redistribution. The difference between the two views is decisive. For those who see inflation as an aggregate nominal process of too much money chasing too few commodities, indeed there is little reason to look any further into the so-called real world of distribution. The only relevant questions are, first, how much money is created, and, second, how increased liquidity is transmitted to higher prices. But if inflation is merely the aggregate appearance of an underlying redistributional conflict, the way to understand it is to begin from that very struggle. From this perspective, there are two important questions: 1. Who are the winners and losers in the struggle, and 2. What is the broader character of that struggle? We deal with each question in turn. Winners and losers. Inflation redistributes income in many different ways, of which we highlight two: redistribution between workers and capitalists, and redistribution between small and large firms. Point 17. Workers and capitalists. Figure 16.2 contrasts the redistribution between workers and capitalists with the rate of wholesale price inflation in the United States over the past half-century. The insert in the top left corner shows the period since 1985 and will be examined later. The distribution of income denotes the ratio between the earnings per share of the Standard & Poor's 500, S&P 500, and the average hourly wage in the private sector. The specific focus on earnings per share and the wage rate is intended to emphasize the income of individual owners, the owner of capital and the owner of labor power, respectively. Figure 16.2, U.S. inflation and capital, labor redistribution. Asterisk corporate earnings per share are for the S&P 500. The wage rate is the average hourly earnings in the goods-producing private sector till 1963 and in the private sector afterwards. Source: Standard & Poor's through Global Insight, Series Code, Earn 500 NS for S&P 500 earnings per share, U.S. Department of Commerce and U.S. Bureau of Labor Statistics through Global Insight, Series Codes, OPP and OPEP for the wage rate, BPINs for the wholesale price index. Now, if mainstream economics is right and inflation is neutral, its ups and downs shouldn't correlate with the distribution of income between workers and capitalists. The wheel of fortune would oscillate between the two groups as they alter their prices and wages at different rates. But since these are relative price changes, there is no reason for them to be systematically related to the overall nominal rate of inflation. Unfortunately, that is not what we see in the chart. Instead of a random pattern, the data show the two series to be tightly and persistently correlated. When inflation accelerates, income is redistributed in favor of capitalists, and when inflation decelerates, the process inverts to benefit workers at the expense of capitalists. Obviously, this isn't exactly the evidence neutrality buffs would marshal to prove their point. Now, at first sight it seems that the correlation has loosened a bit in recent years. But this is an optical illusion. Notice that the fluctuations in the income ratio have trended upwards, particularly since the late 1980s. The main reason is that, unlike workers, the S&P 500 have gone global, drawing an increasing proportion of their profits from overseas operations, as illustrated in figure 15.6. This global diversification caused the levels of the two series to diverge. 18. Remarkably, though, even in this period of heightened capital flows and soaring foreign earnings, the fluctuations of distribution and inflation continue to move in tandem. The insert in the top left corner of figure 16.2 recalibrates the left-hand axis, showing that the correlation remains as positive and tight as before. 19. Small and large firms. The second redistribution through inflation is between small and large firms. Given our focus on external depth, the interesting question for us concerns the earnings per employee ratio. Can dominant capital leverage inflation in order to increase its own earnings per employee faster than the average? The neutrality theory of inflation would say no. Relative pricing power, assuming such power exists, is a real variable. This relative power may rise or fall, but there is no reason for it to change with nominal inflation, and even less reason for the change to be related to firm size. And yet, here, too, reality disrespects the theory. It turns out that US inflation has systematically and persistently redistributed earnings from small to large firms. In this illustration we use the Fortune 500 group of companies as our proxy for dominant capital and focus specifically on net profit. 20 Differential profit per employee is defined as the ratio between net profit per employee in the Fortune 500 group and in the business sector, respectively. However, as we already mentioned, Fortune stopped publishing the number of employees after 1993, so we end up with only a partial series. Fortunately, there is a close substitute, the differential markup. This indicator measures the ratio between the net profit share of sales in the Fortune 500 group and in the business sector, respectively. Over the period between 1950 and 1993, the annual oscillations of these two differential indicators looked like carbon copies of one another, with a correlation coefficient of 0.86. Assuming that this correlation continued after 1993 makes the differential markup a nearly perfect proxy of differential profit per employee. 21. Figure 16.3 contrasts the differential markup of the Fortune 500 with the annual rate of wholesale price inflation. The figure demonstrates the greater elemental power of dominant capital. Over the past half-century, the differential markup averaged 1.6, while differential profit per employee, which is not shown here, averaged 2. These numbers mean that the largest firms marked up their sales by 60% or more than the business average and that they earned twice as much profit per employee. Figure 16.3, U.S. inflation and differential accumulation. The markup is the percent of net profit in sales. The Fortune 500 markup is the percent of after-tax profit in sales revenues. The business sector markup is computed by dividing total corporate profit after tax with IVA and CCA, from the national income accounts, by total business receipts, from the IRS. The differential markup is given by dividing the Fortune 500 markup by the business sector markup. Note, until 1993, the Fortune 500 list included only industrial corporations, firms deriving at least half their sales revenues from manufacturing or mining. From 1994 onward, the list includes all corporations. For 1992-3, data for Fortune 500 companies are reported without SFAS 106 special charges. Source: U.S. Department of Commerce through Global Insight, Series Codes, ZCON for total corporate profit after tax with IVA and CCA, BPINs for the Wholesale Price Index, U.S. Internal Revenue Service, Fortune. For our purpose, though, the crucial point lies in the dynamics. Over time, the relative profit power of dominant capital tended to fluctuate, and as the data clearly show, these fluctuations have been positively and tightly correlated with the rate of inflation. Dominant capital tended to beat the average when inflation rose and trail it when inflation fell. 22. Further analysis in Nitzan, 1992, pages 418 to 22, figures 9.15a, 9.15h, demonstrates that the link between inflation and differential depth is positively related to firm size. The analysis disaggregates US-based corporations into 8 groups ranked by asset size, showing that the larger the firm, the greater and more systematic its differential gains from inflation. This systematic correlation is all the more remarkable given the prevalent practice of markup pricing discussed in Chapter 12. Much of the literature about this practice is concerned with the way firms respond to and transmit cost signals. 23 Now, if firms merely responded to and passed on cost increases, their differential markup position would have remained the same and there would be no redistribution. Figure 16.3, though, shows that redistribution is incessant, so there must be more to markup pricing than passive reaction. At the very least, some firms, most notably the largest, must be more responsive than others. Their more agile reaction, particularly during inflation, helps them beat the average and redistribute income in their favor. But the more plausible explanation is that these firms do not simply react passively, they take the initiative. They actively raise their prices, markup, and profit per employee faster than the average, and as the ensuing redistributional struggle unfolds, inflation is ratcheted higher. Patterns. All in all, then, it is clear that US inflation hasn't been neutral in the least. On the contrary, it has been associated with a systematic redistribution of income from workers to firms and from small firms to large firms. That in itself is already a good enough reason to doubt conventional inflation theory. But what is really remarkable here is that the direction of these two correlations has remained the same for half a century or more. This point can hardly be overstated. Redistribution is a matter of power, and power can shift over time. So even if we accept that inflation is always and everywhere a redistributional phenomenon, still there is no inherent reason why it should almost always work in favor of capital in general and dominant capital in particular. For instance, in Israel, as in the United States, workers tended to lose from inflation and large firms tended to gain at the expense of smaller ones. Nitzan and Bichler 2002, ch. 4. But in Germany and France, 2 countries where labor is relatively strong, the impact of inflation on labor/capital redistribution has been far less clear. The highly aggregated nature of OECD data makes it difficult to draw conclusions regarding the performance of large versus small firms. In principle, then, the link between inflation and redistribution has no preset pattern. Inflation itself is a tricky process, its consequences depend on the relative power of the leading firms, capital in general and labor groups, among others. This relative power can change over time and so can the distributional outcomes. In this open-ended context, the fact that the US experience has been so systematically one-sided is highly significant. Thus, put together, the evidence presented here means that US inflation has become a very potent and fairly reliable engine of differential accumulation. With a long history to learn from, companies know that inflation helps them raise their profit faster than it helps workers raise their wages. They know that inflation helps them more if they are large than if they are small, and they know that the process has certain regularities on which they can rely. Accumulating through crisis. Business as usual. These considerations serve to suggest why inflation has become a permanent feature of modern-day capitalism. Recall from Figure 16.1 that the turn of the 20th century marked the birth of a new type of inflation, relentless and rapid. And recall further that it was exactly at that point that dominant capital emerged as a key element of the capitalist credo. This dual rise of modern inflation and dominant capital is no coincidence. In Chapter 12 we suggested that accumulation requires sabotage, and that business as usual for large corporations comes with a certain measure of stagnation, figures 12.1 and 12.2. But this turns out to be only half the story. The other half is inflation. As we have seen, dominant capital benefits from inflation relative to workers and relative to smaller firms. And, therefore, it shouldn't surprise us that just as stagnation has become a fixture of the modern capitalist landscape, so has inflation. Putting the two processes together, we can redefine business as usual as a combination of stagnation and inflation, or stagflation. The imperative of crisis. So in the end, inflation in the midst of stagnation is not an anomaly. If anything, it is the general rule. Modern capitalism is built on strategic sabotage and continued dissonance. In order to earn a profit and accumulate capital, business needs to restrict industry and limit its resonating energies. And when profit is to be increased and accumulation hastened, the sabotage often has to intensify and the dissonance deepen. That is how inflation redistributes income, and that is why the process commonly appears as a stagflationary crisis. Naturally, most economists would reject these claims outright. Inflation, they would counter, is a monetary phenomenon and therefore has no lasting impact on the real world. As a concession, they would readily agree that inflation can be triggered by real variables but certainly not by stagnation. Indeed, according to the macroeconomic canons, the most common catalyst for inflation, aside from the proverbial printing press, is excessive economic growth. This conviction, however, is based on a cyclical perception of supply constraints, which, valid or not, is meaningful only in the short term. Over the longer haul, capacity can be increased as needed, so material bottlenecks are largely irrelevant. In fact, the most common curse of rapid growth is the even faster expansion of greenfield investment and the inevitable glut that follows. Point 24. In the long run, the key to inflation is power. Since growth tends to remove its own natural bottlenecks, these have to be actively created and instituted by the key players. Regardless of their particular form, the purpose of all such instituted restrictions is to keep overall capacity from growing too fast. Note the emphasis here on overall capacity. Dominant capital may be able to keep its own production stable or even growing, but unless it manages to cap overall growth, coordination is bound to disintegrate into a price war, leading to disinflation or even outright deflation. The upshot is simple: over the longer haul we should expect conventional measures of inflation and growth to be not positively, but inversely related. Long-term growth, far from stoking the inflation fire, works to cool it off by undermining the ability to coordinate and exercise organized power. Inflation, on the other hand, requires slack and therefore tends to appear as stagflation. Varieties of stagflation. Before testing this proposition, however, a final clarification is necessary. The term stagflation has several interpretations that are not equally useful. The weak version, as per Samuelson, 1974, views stagflation as inflation combined with unemployment and undercapacity utilization. The moderate version, found for instance in Baumol, Blinder and Scarth, 1986, defines it as inflation combined with slow growth or recession. Finally, the strong version, adopted for example by Parkin and Bade, 1986, limits stagflation to instances where inflation coincides with falling output. For our purpose here, the weak version is not sufficiently refined. 20th century capitalism was characterized by some measure of unemployment and unused capacity throughout, so its inflation was always stagflationary according to this definition. This characterization, although technically correct, doesn't allow us to gauge the precise nature and intensity of the process. The strong version is also not very helpful, since falling overall output is relatively rare. The most useful of the three is the moderate version, particularly when understood as a relationship. If growth is positively related to inflation, stagflation is clearly an anomaly. By contrast, If the relationship is negative, stagflation must be seen as the norm. It intensifies as growth declines and inflation rises, and it recedes when growth increases and inflation falls. The stagflation norm. Now to the facts. Figure 16.4 shows the long-term relationship between the conventional measures of inflation and economic growth in the United States, going back to 1809, with both series smoothed as 20-year moving averages. The data show quite clearly that the relationship between the two phenomena is not positive, but negative. Low inflation is associated with high growth, whereas high inflation is commonly accompanied by stagnation, the very opposite of what conventional theory wants us to believe. And this inversion is hardly limited to the United States. In fact, during the post-war period, the negative correlation between growth and inflation has become the rule rather than the exception, reproducing itself in country after country, developed as well as developing. See for example, Nitzan 1995a, Nitzan and Bichler 2002, Figure 2.8, p. 71. Figure 16.4, United States, Inflation and Growth, 1809 to 2007. Note, series are shown as 20-year moving averages. The straight line running through the observations is drawn freehand for illustration purposes. Source: historical data till 1928 are from Global Financial Data. From 1929 onward, data are from the U.S. Department of Commerce through Global Insight, series codes, GDP for GDP, PDG for the implicit GDP deflator. At this point, the reader may wonder, if stagflation is the norm and prices tend to rise in the midst of slack, the implication is that there is no material scarcity. But, then, if there is no real shortage, why are buyers willing to pay higher prices? The short answer is that usually they are not willing, they are forced. And the way to force them is by creating, imposing, and maintaining various forms of social crisis, apparent or real. Military hostilities during the First World War, the reparation crisis of Germany in the 1920s, the global oil crises of the 1970s, rising unemployment in Israel during the 1980s, political instability in Russia in the 1990s, debt default in Argentina in the early 2000s and peak commodities in the late 2000s are all illustrations of such inflation-triggering crises. 25. The effect of these crises on inflation is twofold. On the one hand, they undermine the ability of most people to resist price increases. On the other hand, they enable a consensus to emerge within dominant capital that inflation can be used with relative impunity. In this sense, stagflation is the macroeconomic appearance of accumulation through crisis. Unemployment and stagnating production, along with other forms of instability, conflict, and force, constitute the necessary backdrop for differential accumulation through differential inflation. The hazards of inflation. However, stagflation isn't always a bonanza for dominant capital. We have already seen that although some stagnation is necessary for accumulation, excessive stagnation undermines it. And the same holds true for inflation. In small doses it boosts accumulation, in overdoses it can easily undermine it. Capitalization risk. So far, our discussion has focused on the benefits of inflation for differential earnings, but we shouldn't forget that differential earnings are merely a means to the higher end of differential capitalization. Now, it is true that earnings are the most important elementary particle of capitalization, particularly over the longer run, but they are not the only factor. In addition, there is also hype, risk, and the normal rate of return. These particles are also affected by inflation, though sometimes in ways that dominant capital doesn't find attractive. The most important factor to consider here is risk. Note that although differential earnings rise with inflation, the gains are always short-lived, they last only as long as the underlying bout of inflation continues. Indeed, it seems that the only way to keep such gains coming is to keep inflation going, and if the gains are to be raised, inflation needs to be accelerated. Although such acceleration occasionally happens, and often with the desired differential impact, it cannot last indefinitely. As illustrated repeatedly in history and across the world, inflation is a risky business. It is difficult to manage, it often degenerates into an uncontrollable spiral, and its consequences for dominant capital specifically and for the capitalist order more broadly are hard to predict. This unpredictability can wreak havoc on differential capitalization. If the perceived increase in risk for dominant capital exceeds that of the business sector, the negative effect can outweigh the positive gain in differential earnings, causing differential capitalization to decline. The politics of inflation. And that isn't all. Inflation destabilizes society. The architecture of capitalist power is denominated in prices, and inflation, by changing absolute and relative prices, constantly alters that architecture. This reshuffling makes the political underpinnings of inflation dangerously overt. The situation is very different from that of breadth. As we have seen, mergers and acquisitions have a long-lasting and often dramatic impact on the organization and ideologies of power. From the viewpoint of the proles, though, the process seems confined to the upper echelons of society. The media convince them that amalgamation is necessary for economies of scale and national competitiveness, and that the financial aspects of the process are too difficult for them to comprehend anyway. And since the resulting consolidation seems to have little direct bearing on the day-to-day existence of the underlying population, few find reason to resist it, let alone to do so politically. This sales pitch cannot work with inflation. The mechanisms of inflation, much like those of mergers and acquisitions, are political in the widest sense of the term. They are intimately dependent on the power institutions and policies of the state of capital and on the government organs that facilitate and administer them. But unlike amalgamation that comes covered in a soft glove, inflation delivers a raw punch. And this naked force makes the politics of the process far more obvious. Since redistribution here leverages the entire structure of prices, it has an immediate bearing on everyone. The winners and losers are evident, and their conflict is open for all to see. The underlying population, impartial to breadth, is almost always hostile to depth. It starts to resist and fight back, it calls for political changes, it demands to rein in the leading corporations, and it wants to be compensated by higher wages. And as the struggle intensifies, so does the inflationary spiral, causing the crisis to deepen and instability to heighten. The government, seemingly unable to stop the process, is blamed as a culprit and risks losing its legitimacy as a neutral body. The stability of the currency, measurement habits, the law, morals, and justice are all thrown into question. The ruling class itself starts to bicker over the spoils of the process, over how to manage it and over whether or not to terminate it. And as the process intensifies and its character politicizes, there arises the risk that the very supremacy of capital will be called into question. Point 26. Stopgap. For these reasons, inflation is more of a stopgap option for dominant capital. In contrast to mergers and acquisitions whose differential impact is slower to develop, the gains from inflation have no upper technical bound, as illustrated by episodes of hyperinflation. But these benefits come with mounting risks which the large owners and leading government officials are often hesitant to take. From the viewpoint of dominant capital, therefore, inflation is forever a double-edged sword. Effective but highly dangerous, it is not the weapon of first choice. It is only when the gains from breadth dry up that dominant capital, seeing its differential accumulation undermined, moves reluctantly toward relying on inflationary redistribution. Policy autonomy and the capitalist Creo rider. The negative long-term correlation between growth and inflation helps to contextualize the post-war schizophrenia of policymakers. Their stated purpose, with an emphasis depending on whether they sit in the finance ministry or central bank, is always the same: to promote growth and assure price stability. Their latent commitment, though, is far more flexible and seems to have progressively drifted in favor of differential accumulation. During breadth periods, the stated and latent goals are consistent, with high growth and low inflation allowing policy makers to do little and claim success. The problem arises when differential accumulation moves into depth and the macroeconomic scene turns stagflationary. Then the two commitments clash and the winner is almost always dominant capital. Policy is tightened, presumably in order to rein in inflation, but the consequence tends to be the exact opposite. The pace of growth slows, heightening the crisis that dominant capital needs in order to keep inflation going. Occasionally, policy tightening claims a big victory. For instance, during the early 1980s, when Fed Chairman Paul Volcker was congratulated for bringing inflation down by sharply hiking the rate of interest. But was tighter policy really the cause of lower inflation? As illustrated in Figure 15.2, by the early 1980s, dominant capital was already busy riding a new merger wave, having no appetite for further inflation. If this interpretation is correct, the real cause of disinflation was the resumption of breadth, with Volcker and his restrictive policy merely playing catch-up. These considerations reveal a glimpse of the new state of capital. As Galileo Galilei reputedly observed, "Surely, God could have caused birds to fly with their bones made of solid gold, with their veins full of quicksilver, with their flesh heavier than lead, and with their wings exceedingly small. He did not, and that ought to show something." Quoted in Singh 2004, 73:27. In principle, policymakers don't have to line up for dominant capital. They can loosen policy when the largest firms demand tightening, and vice versa. They can restrict mergers and dismember capitalist giants. They can set prices, provide subsidies, and impose different forms of taxation to undermine the differential accumulation of the leading corporations. They can even move toward a truly democratic society, where the citizens themselves make policy and dominant capital fades into oblivion. These options are all open in principle, that is, assuming today's policy maker can even fathom them, let alone fathom them and retain their status as officials of the capitalist state. But one way or the other, the systemic patterns of U.S. differential accumulation suggest that these options are less and less open in practice. The officials and theorists of the state continue to talk about policy autonomy, but the content and direction of the policies themselves seem increasingly predicated on the capitalist credo of differential accumulation. 17. Differential accumulation. Past and future. He began to decipher the instant that he was living, deciphering it as he lived it, prophesying himself in the act of deciphering the last page of the parchments, as if he were looking into a speaking mirror. Then he skipped again to anticipate the predictions and ascertain the date and circumstances of his death. Before reaching the final line, however, he had already understood that he would never leave that room, for everything written on them was unrepeatable since time immemorial. Gabriel Garcia Marquez, 100 Years of Solitude. Like other aspects of the capitalist nomos, there is nothing natural about differential accumulation. To accumulate differentially is to create organized power, and to do so conflictually against multiple oppositions. Such a process cannot be predetermined. It has neither a preset pattern, nor an inevitable outcome. In fact, it doesn't even have to happen and can just as easily go into reverse. Given this open-endedness, the stylized history of differential accumulation is nothing short of astounding. With only brief interruptions, US-based dominant capital has managed to sustain its differential accumulation through both prosperity and crisis, and to do so in a most counterintuitive fashion. Its differential expansion has tended to rely not on greenfield growth and cost-cutting as the canons would have preferred, but on mergers and acquisitions and stagflation. Moreover, as we shall see in this final chapter, the broad trajectories of amalgamation and stagflation have become so tightly correlated that they look like mirror images of each other. As one process increases, the other tends to decrease, and vice versa. The apparent automaticity of the process may give the impression of natural inevitability, but that would be the wrong conclusion to draw. Perhaps a better metaphor here is the evolution of an organized religion. Much like the Almighty God invented by past rulers, the ideology and practice of differential accumulation were created by capitalists as an open-ended process to increase their power. but success brings consolidation, and as dominant capital triumphed, its differential accumulation petrified into a rigid structure, it ended up conditioning and subjugating not only the underlying population, but also its own creators. In the pages that follow we focus on one key aspect of this structure, the metacorrelation between amalgamation and stagflation. The historical relationship between these two regimes provides a framework for understanding key moments in the 20th century evolution of capitalism, as well as the limits it may face in the future. Amalgamation versus stagflation. Figure 17.1 contrasts the general contours of internal breadth and external depth in the United States. The chart plots our amalgamation index, the buy-to-build indicator, against a composite stagflation proxy, both smoothed for easier comparison. Figure 17.1, Amalgamation and Stagflation in the United States. Asterisk computed as the average of 1. The standardized deviations from the average rate of unemployment, and 2. The standardized deviation from the average rate of inflation of the GDP implicit price deflator. Mergers and acquisitions expressed as a percent of gross fixed private domestic investment. Note, series are shown as 5-year moving averages. The first 4 observations in each series cover data to that point only. Source: the stagflation index is computed based on data from the U.S. Department of Commerce through Global Insight, series codes, RUC for the rate of unemployment since 1929, DIG for the GDP implicit price deflator, Historical Statistics of the United States, series D8, P126 for the rate of unemployment before 1929. For the amalgamation index see appendix to chapter 15. To clarify the meaning of our stagflation proxy, recall from chapter 16 the weak definition of stagflation as inflation together with unemployment and underutilized capacity. Now, as we have seen, the United States experienced some measure of unemployment and undercapacity utilization throughout the past century, so in that sense there was always some degree of stagnation. Also, with the exception of the 1930s, there was uninterrupted inflation. Applying both observations to the weak definition implies that U.S. inflation during the period was always stagflationary. With this understanding in mind, our stagflation proxy combines inflation and stagnation in 3 simple steps. First, we measure the standardized deviations of inflation from its average. Second, we compute the standardized deviations of unemployment from its average, and finally we take the average of the 2 indices. Since the United States experienced continued stagflation, we treat a 0 reading of the combined index as the average rate of stagflation, a positive reading as above average stagflation, and a negative reading as below average stagflation. The chart shows that over the long haul mergers and acquisitions were indeed the path of least resistance, Proposition 2 in Chapter 14. Whereas stagflation moved sideways, oscillating around its own stable mean, mergers and acquisitions rose exponentially relative to greenfield investment. Note the logarithmic left scale. The chart also shows that, following the initial emergence of big business at the turn of the 20th century, internal breadth and external depth tended to move countercyclically. Temporary declines in mergers and acquisitions typically were compensated for by sharp increases in stagflation, and when amalgamation resumed, with dominant capital breaking through its existing envelope and into a broader universe, stagflation promptly abated. Propositions 1 and 8. The very existence of this countercyclical pattern is already remarkable, particularly since, as we have repeatedly emphasized, differential accumulation does not have to happen and can as easily go into reverse. Note also the highly significant fact that the inverse correlation between breadth and depth has grown tighter over time. This tightening is clear from the chart. During the final decade of the 19th century, when big business was only starting to take its modern shape, the 2 series still moved in the same direction. By the first decades of the 20th century, however, with dominant capital already having assumed center stage, the relationship turned clearly negative, although still somewhat loose. And from the 1930s onward, as differential accumulation became increasingly entrenched, the negative fit grew tighter and tighter. Point 1. The progressive move from looser to tighter correlation is consistent with our earlier narrative. Differential accumulation, understood as a broad historical process, is relatively new. It rose to prominence only toward the end of the 19th century, when corporations grew big enough and became sufficiently intertwined with governmental organs to engage in large-scale strategic sabotage. The process first became important in certain sectors in the United States and Europe, from where it subsequently spread domestically and internationally. However, the spread was very uneven, and so, despite high capital mobility, initially the cyclical regimes in different sectors and countries were disjoined and out of step with one another. It was only later, with the gradual proliferation and deepening of business principles and the ideology of discounting, with the progressive breaking of sectoral envelopes, and with the growing globalization of ownership, that differential accumulation became the compass of modern capitalism. And therefore it was only toward the middle of the 20th century, when these processes converged, that breadth and depth grew more stylized and inversely synchronized. The pattern of conflict. Now, since differential accumulation lies at the heart of the capitalist credo, its specific regimes are important for understanding the broader nature of institutional and structural change in capitalist society. Perhaps the most important change concerns the pattern of conflict. Recall that although dominant capital always struggles to increase its power relative to other capitalists, in breadth this struggle is direct, whereas in depth the path is indirect. When expanding through breadth, capitalists fight each other to control existing and new corporate organizations. The intra-capitalist struggle here is commonly associated with overall growth and ongoing institutional change, which in turn partly conceals the conflict between capitalists and society at large. By contrast, in depth the intra-capitalist struggle is mediated through a redistributional conflict between capitalists and the rest of society. Moreover, the redistribution here thrives on stagflation, not growth. Obviously, sustaining such accumulation through crisis requires entrenchment, fortified power arrangements and a greater use of force and violence. The very different social conditions required for each regime explain their incompatibility. Individual firms can engage in both breadth and depth, but for society as a whole, the power processes that support one type of differential accumulation tend to undermine the other. A new type of cycle. Cyclical analyses of capitalism tend to focus on the patterns of real economy. The most famous is the business cycle, a relatively short oscillation that describes the ups and downs of economic activity from output and investment to inventories and employment. Long-wave cycles, often extending over decades, measure looser variables such as innovation, as well as nominal quantities like prices. These analyses are all informed by the traditional bifurcation between economics and politics. Embedded in the material/economic sphere, they emphasize the automatic underpinnings of the cycle and search for their mechanical rationale. After the Great Depression and the rise of government intervention, the business cycle was augmented by political variables. Although economists continued to keep their economy conceptually separate from politics, they recognized that the latter could contaminate the former, leading to a political business cycle. Point 2. Our own breadth and depth cycles present a different story altogether. First, they deal neither with economic activity nor with government intervention that supposedly distorts or supports such activity. Instead, their subject is the broad credo-riding of capitalist power quantified through differential accumulation. Second, although the breadth and depth cycles are historically stylized and seemingly mean-reverting, there is nothing automatic or equilibrating about them. In fact, given that we deal here with open-ended conflict whose outcome is never predetermined, there is no inherent reason why amalgamation and stagflation should be cyclical in the first place, and certainly there is no reason for the two cycles to be related. The fact that they are cyclical and that they are correlated attests to the extent to which differential accumulation has come to define the capitalist nomos. Our own thesis is that for differential accumulation to occur, dominant capital has to expand through either breadth or depth, and that, at the societal level, these two regimes, because of their very different if not opposite character, tend to move counter-cyclically. But the grip of dominant capital can loosen or disappear, and when it does so will differential accumulation and its cycles of breadth and depth. Oscillating regimes, a bird's eye view. With this open-ended conflictual framework in mind, we can tentatively identify several broad phases in the global evolution of differential accumulation, temporal patterns whose initially blurred contours have gradually sharpened into focus. 1. A mixture of breadth and depth during the period between the 1890s and 1910s. 2. A partial breadth regime during the 1920s. 3. A depth regime in the 1930s. 4. A breadth regime between the 1940s and 1960s. 5. A return to depth in the 1970s and early 1980s. 6. The re-emergence of breadth in the late 1980s and 1990s, and 7. Tentative signs of a return to depth in the early years of the 21st century. Let's look at each period a bit more closely. The period from the 1890s until the 1910s was one of rapid and accelerating economic growth, coupled with relatively low inflation and the beginning of corporate transnationalization, particularly by large US-based companies. Internationally, differential accumulation was still cloaked in statist clothes, with American and European companies often seen as imperial agents as well as pursuers of their own interests. The competitive expansion of these companies, however, was largely uncoordinated and soon led to the creation of massive imbalances of excess capacity. Left unattended, such imbalances would have spelled business ruin, so there was growing pressure to resolve the predicament via depth. And indeed, as figure 17.1 shows, since the middle of the first decade of the 20th century US merger activity had collapsed, followed in the 1910s by war in Europe together with plunging production and rising inflation around the world. The 1920s offered a brief break. In the United States, merger activity soared while stagflation subsided sharply. In Europe, however, the reprieve was short and stress signs were soon piling up. Protectionist walls, both between and within countries, emerged everywhere, stagflation spread through a cascade of crises, and before long the world had fallen into the Great Depression of the 1930s. By that time, the counter-cyclical pattern of breadth and depth became more apparent, with declining merger activity accompanied by rising stagflation. 3. The new depth regime was marked by the massive use of military force, in which the global power impasse was resolved through an all-encompassing world war. This use of violence was articulated and justified largely in statist terms. It was a war of sovereigns waged over territory and ideology. But the war also proved highly significant for differential accumulation. Most importantly, it accelerated the relative ascent of US-based corporations, and it helped spread both the normal rate of return and the need to beat it. After the war, the world again shifted to breadth. The counter-cyclical regime pattern was sharpened even further, while the inverse correlation between inflation and growth became increasingly apparent. Now, on the surface, it looked as if developments during that period, which lasted until the end of the 1960s, should have undermined breadth. For one, superpower rivalry, decolonization and the non-alignment movement limited the geographical expansion of Western dominant capital. In addition, many developing countries that were previously open to foreign investment adopted import substitution policies that favored domestic over foreign capitalists. And yet, for much of the 1950s and 1960s, these barriers on breadth were outweighed by two powerful counter-forces. The first of these was the post-war baby boom that boosted population growth. The second was the post-war rebuilding of Europe and Japan that in some sense was equivalent to the reproletarianization of their societies. The result was a powerful breadth engine, particularly for the large US firms that saw their profits soar during that period. The macroeconomic result in the industrialized countries, anomalous from a conventional viewpoint but consistent with differential accumulation, was rapid economic growth averaging 6% during that period, combined with low inflation of less than 3%. 4. This picture was inverted in the 1970s. By then, the German and Japanese miracles had already run out of steam, while Western rates of population growth dropped sharply. Foreign investment could have provided a way out, yet outlets for such investment in developing countries remained hindered by communist or import-substituting regimes. Faced with these obstacles to breadth, dominant capital groups in the industrialized countries were once again driven toward depth, with the average rate of inflation during the 1970s rising to 8% and the average rate of economic growth dropping to 3%. And, as before, the new depth regime was accompanied by heightened conflict and violence. This time, though, the conflict was played out mostly in the outlying areas of the developing world, initially in Southeast Asia and subsequently in the Middle East. The role of the Middle East. The role of the Middle East in global capitalism provides a good illustration of the temporal spread and geographical integration of differential accumulation. 5 Until the late 1940s, the region was out of sync with the global cycle of breadth and depth. Its energy resources had already been parceled out by the international oil companies in the 1920s, but with the world awash with oil, these companies mostly sat on their concessions and produced little. As a result, the Middle East remained relatively insulated from the capitalist core, and when Europe slipped into stagflation and conflict during the 1920s and 1930s, the region prospered. After the war, though, the tables turned. The Middle East, until then a true outlying area, suddenly became center stage for the global drama of differential accumulation. Initially, the link was pretty simple, with oil from the region helping sustain the growth underpinnings of global breadth. During the early 1970s, however, when differential accumulation shifted into depth, the relationship became more complicated. The background for this latter shift is illustrated in Figure 17.2. The chart shows a positive long-term correlation between inflation in the industrialized countries on the one hand and the global arms trade expressed as a share of world GDP on the other. Conventional economics would probably treat this relationship as accidental and largely irrelevant. From the viewpoint of dominant capital, however, the relationship is systematic and meaningful. It points to the conflict-ural underpinnings of its differential accumulation cycles. 6. Figure 17.2, Inflation and Arms Exports. Note, series are shown as 3-year moving averages. Source, International Financial Statistics through Global Insight, series codes L64 at C110 for CPI, U.S. Arms Control and Disarmament Agency, World Military Expenditures and Arms Transfers, various years. As we noted earlier, the inflationary depth regime of the 1970s and 1980s was largely a response to Western dominant capital running out of breadth. This exhaustion in turn was partly the consequence of bipolar geopolitics that prevented capitalist expansion into outlying areas and contested Western control over strategic regions, particularly the Middle East. One key consequence of this antagonism was an intense arms race, and hence it is not surprising that the time pattern of arms exports, a handy proxy for bellicosity, roughly follow the periodicity of Western inflation. The first process was fueled by and nourished the antagonism and violence of depth, the second its redistributional mechanism. Both arms exports and inflation rose until the mid-1980s, peaked as the Cold War began to weaken, and went into a free fall with the disintegration of communism and the onset of global breadth. 7 Moreover, the two processes were causally connected, with military conflict, especially in the Middle East, contributing to rising energy prices, and therefore to higher inflation. The late 1980s seemed to mark the beginning of yet another breadth phase, this time at the global level. On the surface, the new breadth regime was somewhat anomalous according to our criteria. Inflation in the industrial countries dropped sharply, and yet, unlike in previous cycles, growth did not revive. A closer inspection, however, easily shows why. First, with the collapse of the Soviet Union and the wholesale capitulation of statist ideology, the entire world finally opened up for capitalist expansion and differential accumulation. The result was that, although external breadth for dominant capital fizzled in the industrial countries proper, it remained strong outside of these countries, particularly in developing Asia. 8 Moreover, cheap imports from Asia helped keep inflation in the industrial countries low despite the latter's domestic stagnation. Second, the ideological demise of public ownership and the mixed economy opened the door for privatization of state assets and government services, which, from the viewpoint of dominant capital, was tantamount to greenfield investment. 9 And third, the decline of statist ideology weakened the support for national ownership, thus contributing to the spread of cross-border mergers and acquisitions. Together, the combination of expansion into less developed countries, privatization, and corporate amalgamation helped sustain a powerful breadth drive for large Western corporations despite the lackluster growth of their parent countries. Coalitions. So far, we have focused on dominant capital as a whole. The concrete history of differential accumulation, however, including its transition from one regime to the next, depends crucially on what happens within dominant capital. This process includes the inner conflicts between various corporate state coalitions and alliances that comprise the nuclei of dominant capital, as well as the struggles that pit these coalitions and alliances against groups outside of dominant capital. An analysis of these issues is beyond the scope of this volume, but their significance can be illustrated briefly. 10. During the depth phase of the 1970s and 1980s, differential accumulation was led by a weapon dollar, petrodollar coalition made up of large oil companies, armament contractors, and OPEC, and was backed by the United States and several European governments that supplied arms to the Middle East and encouraged high oil prices. 11 The central accumulation mechanism of this coalition was the ongoing cycle of Middle East energy conflicts and oil crises. The basic logic of the process was simple enough. Rising petroleum prices brought massive profits for the oil companies. They also generated huge petrodollar revenues for local OPEC governments, who were only too eager to spend them on expensive weaponry in preparation for the next war. As a result, the Middle East during that period became the world's largest market for imported arms, absorbing over 1/3 of the global trade. The big arms contractors of course loved this arrangement, and various U.S. administrations from Nixon's and Ford's to Bush Sr.'s and Jr.'s supported it with equal zeal. Indeed, what better way to fight communism, divide and rule the Middle East, and enrich your corporate friends all in one stroke and without spending a penny? The consequences of this process were nothing short of dramatic. Rising oil prices threw much of the world into a deep stagflationary crisis, conflict bloomed everywhere, and there was even the occasional flirt with nuclear exchange. The weapon dollar, petrodollar coalition, however, thrived, while the other members of dominant capital, although hit by the stagnation, ended up benefiting greatly from the consequent inflation. Revisit figure 16.3. The distributional consequences for the oil and armament companies are vividly illustrated in figure 17.3, which measures their share of global market capitalization. As the chart shows, during the 1970s and 1980s, this group of firms became one of the world's most valuable. With plenty of wars and soaring oil prices, its fortunes multiplied, and by 1981, after the onset of the Iran-Iraq wars, it accounted for nearly 14% of global market capitalization. War profits were clearly the way to go. Figure 17.3, the two coalitions, share of world market capitalization. Note, series denote monthly data shown as 12-month moving averages. Source, data stream, series codes, TOTNCODE for world total, OILAN for integrated oil, AIRSPUD for defense, TNOUD for technology. But that was the peak. By the mid-1980s the situation started to change on several fronts. First, many developing countries, having shifted from import substitution to export-led growth, were now reclassified as emerging markets open to foreign investors. Second, high technology was firing up both investors' hype and the stock market, giving mergers and acquisition repeated shots of adrenaline. And third, neoliberalism, having undermined the previous statist ideology, now opened the door for massive privatization and capital decontrols. Put together, these developments marked the dawn of a new breadth regime. The weapon dollar, petrodollar coalition started to decline, and by the early 1990s, with the Cold War over and the world having been declared a global village, it disintegrated. Signs of its demise were clear. International hostilities were actively curtailed, with the number of major conflicts falling from 36 in 1989 to 25 in 1997, military budgets the world over came under the axe, dropping by over one-third in real terms from their peak in the late 1980s, the price of oil fell absolutely and relative to other prices, reaching a low of $11 per barrel in 1999, compared with over $30 in the early 1980s, $96 in 2007 prices, and world inflation dropped to less than 5% in 1999, down from over 30% at the beginning of the decade. 12. The main challenge to the weapon dollar, petrodollar coalition came from a new technodollar, merger dollar alliance, a group based on civilian high-tech and corporate takeovers and backed by third-way governments led by the likes of Bill Clinton and Tony Blair. Instead of war profits, nationalism, and conflict, the new alliance marshaled the rhetoric of peace dividends and free investment in an open world. Capital controls gave way to deregulation, protectionism to privatization, and bloody wars to peace deals. And indeed, by end of 2000, the technodollar, merger dollar alliance seemed victorious. As figure 17.3 illustrates, its share of global market capitalization soared to 20%, while that of the oil and armament companies sank to a meager 4%. 13. Unrepeatable since time immemorial? The retreat of breadth. During the 1990s, many experts, impressed by the new breadth euphoria, announced the arrival of a new economy based on high-tech knowledge, information, and communication. This new economy, they promised, would deliver not only uninterrupted growth, but also low inflation, making the anomaly of stagflation a relic of history. Other observers with an eye to culture and politics went even further, arguing that liberal capitalism had won the last battle of ideology and that history was finally coming to an end. But the prognosis proved a bit hasty. These projections hinged crucially on the promise of surging productivity. And yet, productivity growth data from the 1990s, assuming for argument's sake that productivity indeed can be measured, hardly seem exceptional by historical standards. In the United States, the presumed epicenter of the high-tech revolution, these data pale in comparison to the record of the low-tech 1950s and 1960s. Moreover, past productivity gains have often failed to stop inflation, so it isn't entirely clear why the experts expected them to succeed this time around. And, indeed, reports of the death of stagflation proved a bit premature. The rapid breadth expansion, particularly in the emerging markets of Asia, created a massive build-up of excess capacity and loosened the grip of business sabotage. Greenfield investment in the 1990s grew in leaps and bounds, much faster than world consumption and with disastrous consequences for profit margins. The implications for differential accumulation were not lost on absentee investors, who began liquidating their holdings in peripheral regions where earnings growth fell short of the world average. Nitzan 1997, 1998a. The first victim was the Mexican peso circa 1994, followed in 1997 by the Thai baht and the rest of the Asian currencies. From there, the centrifugal forces of excessive external breadth spread devaluation throughout the developing world, striking most countries, from Russia and Brazil to South Africa and Argentina. The emerging markets crisis spelled trouble for the core markets of North America and Europe. During the 1990s, developing countries absorbed some of the elevated hype from the core, and in so doing provided a defense line for blue-chip companies listed in the world money centers. Eventually, though, this defense line collapsed. In 2000, fear struck the core financial markets. Led by the collapsing Nasdaq, they went into a tailspin and in the process pulled the rug from under a two-decade surge in merger activity. Next, the global political economy, perhaps for the first time since the Great Depression, fell into a synchronized recession involving all major countries. And finally, After a decade of peace dividends, attacks on the World Trade Center and the Pentagon, followed by the invasion of Afghanistan and Iraq and the re-intensification of the Israeli-Palestinian conflict, rekindled the ghost of violence and war profits. And so the tables again turned. As illustrated in Figure 17.3, by the early 2000s the weapon dollar, petrodollar coalition once more was on the ascent while the techno-dollar, merger dollar coalition went into a free fall. Was the world running out of breadth? Were these developments the mark of a new depth phase? Or maybe they were soon to be forgotten ripples on the tidal wave of globalization and amalgamation. The boundaries of differential accumulation. In 1999, we presented a paper at the International Studies Association meetings. The key question of the paper was stated in the title: will the global merger boom end in global stagflation? Nitzan 1999. And the answer was positive. Based on our differential accumulation framework, we argued that worldwide mergers and their neoliberal underpinnings were about to peak, and that conflict and stagflation were ready for a comeback. Point 14. A decade later, such projections may seem trivial. The global village is defunct, no logo analysts have retreated, overshadowed by the pundits of terror and war. The headlines that previously announced prosperity and merger suddenly talk of stagnation and inflation, and the experts assure us that they have been predicting all of this all along. But the truth is that, back in 1999, none of this was in the cards. Few in our audience understood the question we asked, and even less so the answer we gave. Caught in the postmodern fashion of deconstruction, conditioned by the double separation of economics from politics and the real from the nominal, and indifferent to the speculative quantification of qualitative processes, they found our argument bizarre and our projections off the wall. Our presentation, though, didn't really try to predict the future, at least not in the technical sense advocated by Karl Popper, 1963. Instead, we attempted to delineate the limits of differential accumulation and to understand the boundaries they impose. And that is what we have done with further analyses and details in the present volume. To reiterate, differential accumulation is a qualitative creating of capitalist power that is speculatively quantified through the algorithm of capitalization. It is a conflictual process and is therefore open-ended. It doesn't have to happen. If dominant capital increases its power, the rate of differential accumulation will be positive. But if this power stays the same or decreases, differential accumulation will be zero or negative, respectively. This is the general theoretical setting. Now, using this framework we demonstrated, 1. That differential accumulation has proceeded more or less uninterruptedly for the past half-century and possibly longer, 2. That, historically, this accumulation occurred primarily through amalgamation and stagflation, and, 3. That these two power regimes have grown increasingly countercyclical. This theoretical, empirical framework enabled us to make our 1999 projection. As Figure 17.1 shows, by the late 1990s amalgamation was reaching historical highs while stagflation was approaching historical lows. The situation seemed ripe for reversion. There was no structural reason to expect differential accumulation to collapse, and since its two regimes were at historical extremes, it seemed safe to expect mergers to recede and stagflation to resurface. And that is exactly what happened in the decade since this projection was made. Out of bounds. But correct projections do not mean that the social future is somehow foreseeable, let alone predetermined. The capitalist nomos is a creature of society, articulated and imposed by the ruling class on those who are ruled. No matter how deterministic it may seem, this nomos is never ironclad. Created by humans, it can be changed and indeed replaced by humans. In the language of Gabriel Garcia Marquez, it is unrepeatable and therefore unpredictable since time immemorial. As long as dominant capital continues to rule, and as long as the logic of that rule remains unchanged, we can expect differential accumulation to oscillate between breadth through merger and depth via stagflation. Furthermore, since the breadth potential eventually is self-exhausting and since dominant capital is already in the final, global envelope, it seems reasonable to expect future stagflation cycles to become more frequent and deeper. But, then, there is no certainty that dominant capital will continue to rule in the same way or that it will continue to rule at all. Over the past century, capitalists have managed to impose the belief that their regime is natural and therefore unalterable. They have constructed a power architecture that is more sophisticated, encompassing and supple than anything the world has ever seen. And they have successfully concealed the state of capital by erecting an anti-scientific front that fractures the consciousness and dresses up the power institutions of capitalism as if they were mere technical aspects of a narrow economic narrative. This edifice of power and deceit hinges on the normal rate of return and the ability of dominant capital to beat it. As long as business as usual sabotage and dissonance keep capitalists convinced that profit is normal and the growth of capitalization natural, and as long as dominant capitalists are able to exceed the normal and increase their power, the state of capital holds steady and its patterns remain deterministic. But this determinism is not an external law of nature or a historical law of motion. Instead, it is merely the determinism of the capitalist rulers. The patterns of this determinism reflect the consensus of those who dominate society. They show the conviction of the rulers that they are in command and that those whom they command cannot resist. This conviction, though, is never certain. Confronted with sufficient opposition, whether explicit or implicit, it can crumble. And when it does crumble, the result is to shatter the determinism of the rulers, the patterns of their differential accumulation and, possibly, the entire state of capital that defines their rule. Postscript, January 2009. The research for this book was completed in early 2008. Since then, the capitalist world has been rattled by what many consider to be the deepest crisis since the Great Depression. The global shakeup has brought one aspect of our framework into sharp focus. It has shown that differential accumulation is by no means predetermined, and that it can fail. The open-ended nature of the process is demonstrated most vividly by the increasing threat of deflation. As we have seen, over the past half-century, the capitalist Creo rider has been shaped by the differential accumulation of dominant capital, whose growing power is fueled by the inversely oscillating regimes of breadth and depth. Although the two regimes differ markedly, both depend on rising prices. Breadth through merger requires relatively low inflation, while depth through stagflation depends on high and rising inflation. This requirement was fulfilled in the post-war era, the longest period of uninterrupted inflation in human history, figure 16.1. But the inflationary backdrop also points to the limits of capitalist power. As noted in the introductory and concluding chapters, power is confidence in obedience. It represents the certainty of the rulers in the submissiveness of the ruled. In modern capitalism, this certainty is manifested in the ability of capitalists to control and systematize the upward movement of prices. And it is this ability along with its associated confidence in obedience that is totally lost during deflation. When prices start falling and the architecture of power begins to disintegrate, the ruler's confidence fizzles and history suddenly seems open-ended. And indeed, challenges to capitalist power often emerge when they are least expected. That was the case in 1929 and again in 2000. By the beginning of the third millennium, dominant capital seemed unassailable. Using mergers and acquisitions, it had penetrated and transformed most developing countries into emerging markets. It had integrated former communist regimes into the logic of capitalization, and in the core countries it had imposed its own private regulation while undermining public institutions of welfare and government. With the exception of small enclaves such as Cuba, Myanmar, and North Korea, it had managed to subjugate and incorporate the entire world population into its all-encompassing nomos. It was exactly at that high point, when the experts celebrated the end of history and the global village, that deflation suddenly struck. Mergers receded in the early 2000s, yet inflation, instead of rising, fell precipitously. This was no laughing matter. If disinflation turned into outright deflation, dominant capital would be bound to suffer differential decumulation. And that was just for starters. Deflation threatened to bring down the entire chain of debt obligations, whose size relative to GDP was much larger than it had been on the eve of the Great Depression. Had prices started to fall and debt to deflate, the spiral could quickly have become unstoppable. The initial response was denial. Deflation simply was too dire to contemplate. Ignore the ghost of deflation, recommends Financial Times columnist Samuel Britton. Apart from Japan, he observed, the world has not seen deflation for 70 years, as if the world's second largest economy can be treated as an anomaly, and 70 years as a magic threshold beyond which deflation can never return. Deflation is an overblown worry, declares James Grant, editor of Grant's Interest Rate Observer. Believe in ghosts, goblins, wizards, and witches if you will, concurs financial expert Adrian Douglas, but don't believe in deflation occurring anytime soon. There is little to worry about, says Fed Chairman Alan Greenspan. The United States is nowhere close to sliding into a pernicious deflation. Of course, denying the problem does not solve it. And, so, for those who remain fearful, the experts promise that whatever the risk, it could easily be defused. The good news, announces former member of the Federal Reserve Board, Angel Wayne, is that monetary policy never runs out of power. There's a much exaggerated concern about deflation, laments Nobel laureate Milton Friedman. It's not a serious prospect. Inflation is still a much more serious problem than deflation. Today's Federal Reserve is not going to repeat the mistakes of the Federal Reserve of the 1930s. The cure for deflation is very simple. Print money. The same assumption underlies the soothing speech by Fed Governor Ben Bernanke, given in 2002 to the National Economist Club. In his address, properly titled Deflation, Making Sure It Doesn't Happen Here, Bernanke explained that deflation is always reversible under a fiat money system. The US government, he assured his audience, has a technology called the printing press that allows it to produce as many US dollars as it wishes at essentially no cost. Quoted from various sources in Bichler and Nitzan 2004b, 294 to 296. But denial and promises didn't work, so the experts called for action. The Federal Reserve has won its long war against inflation, wrote chief economist of Goldman Sachs Bill Dudley and managing director of PIMCO Paul McCulley. But to ensure an enduring legacy, Mr. Greenspan now needs to solve a different problem. Inflation is too low, rather than too high. The inflation rate should be high enough to allow the economy to take a shock without falling into deflation, Dudley and McCulley 2003. And Greenspan was more than ready to comply. He quickly reduced interest rates to levels not seen since the 1960s and equally quickly realized he was pushing on a string. In recent months, inflation has dropped to very low levels, he complained to the Joint Economic Committee of the Congress. Indeed, we have reached a point at which, in the judgment of the Federal Open Market Committee, the probability of an unwelcome substantial fall in inflation over the next few quarters, though minor, exceeds that of a pickup in inflation. Greenspan 2003. This was probably the first time since the 1930s that the Fed had pronounced lower inflation unwelcome. In the end, though, it was the brinkmanship of the weapon dollar, petrodollar coalition that saved the day. The coalition managed to put the Bush clan back in the White House, inflame the Middle East, raise the price of oil and provide the necessary spark for inflation. That spark, though, merely helped delay the day of reckoning. By 2007, storm clouds had started to gather again, and by early 2008 all hell had broken loose. Assets markets have gone into a free fall, followed by crashing commodity prices, collapsing employment and production, and broad inflation indices that are rapidly approaching zero. The threat of deflation, having been ridiculed by Nobel laureates and dismissed by central bankers, is back with a bang. Given the gravity of the situation, governments the world over have suspended their commitment to free markets and sound finance in favor of massive bailout packages for dominant capital, large fiscal stimuli, unprecedented injections of liquidity and other policy rituals. In addition, there has been some increase in televised violence from the erupting conflicts of the Middle East, to riots in Thailand, Greece, and Korea, to promises of simmering discontent in Russia and China. So far, though, policy and conflict have done little to lessen the deflation scare. Even the U.S. Federal Reserve Board sounds unnerved. Having reduced its interest rates to practically nil, it is now contemplating pleading directly with the public. According to this plan, the Fed will announce a positive inflation target. This announcement will then cheer up the depressed public and lift its inflationary expectations, and the inflation monster, having been invited in so politely, will rear up its beautiful head and give the Fed what it wants most: prices that go up. U.S. Federal Reserve Board 2008, GUHA 2009. These nervous calls to the omens suggest that capitalism again faces a historical crossroads. Renewed inflation will restore differential accumulation for dominant capital, initially through depth and perhaps later through breadth. But if the ruling classes are grabbed by panic and the power architecture disintegrates into deflation, the effect could be deeply transformative. And that wouldn't be the first time. During the 1930s, falling prices shook the capitalist world and eventually led to its complete creoriding. Back then, the transformation ended up strengthening the state of capital. The imposition of capitalization on almost every aspect of social life, the ascent of dominant capital and the growing synchronization of breadth and depth helped create the most powerful mega-machine the world has ever known. But the transformative outcome of deflation was not predetermined then, and it isn't predetermined now. If prices start to fall in earnest, dominant capital might be seriously weakened, perhaps to the point of losing control over its very mode of power and the mega-machine that sustains it. Whether it can continue to rule, though, and in what way, remains an open-ended question. The answer to this question depends not only on what dominant capital does and how it does it, but also on the creativity, ability, and courage of those who resist it in the hope of creating an alternative, humane future.